unless the articles of association say so. But public limited companies are required to hold an annual general meeting. Private companies are not required by law to do so. But if the articles of association states that there ought to be an annual general meeting, then such an annual general meeting must be conducted. So then number 2, we need to study the notice. Remember, we say that one requirement for holding any meeting, regardless of the type, is having a proper notice. Of question 1, May 2019, it says, discuss the procedures involved in applying forensic auditing in fraud investigations. 8 marks. The procedures involved in applying forensic auditing in fraud investigations. Here again is another straightforward question. Procedures involved in applying forensic auditing and fraud investigations. We are still on May 20. This is May 2019. Question 1C. It says, discuss procedures involved. These are procedures involved in applying forensic auditing in fraud investigations. In fraud investigations. Now, what is forensic auditing? Forensic auditing, candidates, is the application of accounting records in the collection of evidence for the purpose of securing prosecution in a judicial forum. Let me write that down. Forensic auditing. Forensic auditing is the application of accounting methods. The application of accounting methods to the tracking and collection of evidence, usually for investigation and prosecution of criminal acts like embezzlement or fraud. All right, usually for investigation and prosecution of criminal acts such as embezzlement of funds, embezzlement or fraud. Embezzlement or fraud. So forensic auditing may also be referred to as forensic accounting. It is the application of accounting methods to the tracking and collection of evidence, and this evidence may be used for investigative purposes or for prosecution of criminal acts like fraud. In this question, we are to discuss the procedures involved in fraud investigations. So we are going to outline the procedures. And candidates, it's important to note that forensic auditing is the application of the accounting methods. So if you are preparing to sit for the advanced auditing paper, you are conversant with these methods. This is what you've been learning since you began the CPA course. We've been learning how to make records, to record transactions. We've learned how to prepare books of accounts, to prepare the what we call business papers, the source documents, how to transfer information from the books of accounts to the trial balance, the financial statements, and so on. We understand the accounting process, all right? The accounting process, you are well conversant with the accounting process or accounting generally. So here, how do you conduct fraud investigations? Step number one. Number one, I will just list the procedures. Number one is develop. First step, develop the profile of the company under investigation, of the company or the firm under investigation. Now, a profile is simply a short description of the company, including the company personnel. So you come up with a brief description about the company. That is the first step. Company profile, including the personnel, the company's personnel. Step number two is to identify weaknesses. Identify weaknesses in the internal control procedures. Identify weaknesses in the internal control procedures. This internal control system we covered in detail in the previous paper in auditing, how to tell that a company's internal control system is weak. There are signs of a weak internal control system which you can capture as a forensic accountant. So you can identify the weaknesses, list down the weaknesses. For example, you may find a company that does not prepare control accounts, for example, right? Because preparation of control account in itself is a control measure, an internal control measure. A company that does not prepare control accounts, then that company's internal control system may be weak. Another control could be preparation of the bank statements. If you observe that a company does not prepare bank reconciliations, okay, does not prepare bank reconciliations, then that is a sign of a weak internal control system for cash. So there are many signs that you may capture as an investigator in the process of identifying weaknesses. So identify all the weaknesses in the internal control system. That is step number two. Step number three is to perform trend analysis. Perform trend analysis and analytical procedures. Analytical procedures to identify, the purpose is to identify significant transactions and significant variations. To identify significant transactions and variations. For example, if you do ratios, you conduct ratios, accounting ratios on the balances provided, so that you can see abnormal variations or unusual variations or significant variations. For example, the liquidity ratios for several years, you can tell if there are variations that are not normal. All right, we know the ideal liquidity ratios for a given industry. So you compare the company's ratios vis-a-vis that of the industry to identify significant transactions or variations in the trend analysis. And this is through preparation of analytical procedures. Number four, identify changes in patterns. Changes in patterns of items like purchases or sales. Identify patterns. The changes in patterns. Identify changes in patterns. The changes in patterns may be as a result of fraudulent activity. So you need to observe and record down the changes in patterns of purchases or sales. Number five, identify significant variations. Identify significant variations of, here we talked of purchases, we have sales, we can say variations of raw materials, particularly where consumption seems excessive. All right, identify significant variations of raw materials, particularly where consumption seems excessive. Consumption. So these are five procedures. Number one, develop the profile of the company under investigation. I've said company profile would simply be a description of the company, what the company does, the mission of the company, and so on. The vision of the company, objectives of the company, the industry in which the company operates, any key information regarding the company. Then you also come up with a profile of company's personnel. You can draw an organizational structure that will help you understand the management structure of the company. That is step number one. Step number two, identify weaknesses in the internal control system. I've given an example. Step number three, perform trend analysis. Number four, identify changes in patterns of purchases and sales. Identify significant variations of raw material, especially where consumption seems to be excessive. Number six, identify unusual accounts and unusual account balances. Like, for example, a situation where you have credit balance on closing debtors, like closing credit balance on accounts receivables. Normally, the debtors account or the account receivables has to have a debit balance. Debit balance. Debtors are assets, and assets always have a debit balance, closing debit balance. But if you have a situation where the debtors closing balance is a credit balance, then that is unusual. The same would also happen for the accounts payables balances. If you have an account payable balance being a debit balance, then that is unusual account. So identify unusual accounts. We know liabilities accounts must have a credit balance at the end of the accounting period. That is liabilities plus capitals. Then the assets must have debit balances and so on. So if you have a situation where some accounts have unusual account balances, then you need to identify such. This is number 6. Another procedure that can be performed, this is 6. Number 7 is review accounting records. Review accounting records for unusual transactions. Not executed at normal commercial rates. If there are amounts within the accounting records that have been arrived at by using commercial rates that are not normal, then you need to review those records. For example, if you have the rates provided by the suppliers, okay, because items are bought from suppliers. If you identify that there are rates that have been applied apart from the rates provided by the suppliers, then you need to review those accounting records. Then number 8, the 8th procedure is review source documents. Or accounting documents. Review source documentation or documents like invoices for discrepancies and discrepancies and inconsistencies. Check the source documents like invoices. Are there discrepancies? Are there inconsistencies? There could be discrepancies of many kinds or inconsistencies. So check if there are any inconsistencies or discrepancies within the source documents like invoices, like the delivery notes, and so on. Then number 9, once these have been identified, these discrepancies and consistencies, let me write here 9, once identified, trace the individual responsible for the fraudulent transactions. Okay, it's not easy. It's not difficult to identify the individuals responsible for such fraudulent transactions. Remember, we've been identifying discrepancies, we've been identifying mistakes, we've been identifying weaknesses within the control system, within the source documents, within the account balances. So once these have been identified, procedure number 9, identify the individual responsible for the fraudulent transactions. That is the next procedure, obvious procedure. Next procedure is to identify the individual. Remember, forensic auditing. We defined it as the process of tracing, of tracking, of checking the accounting records using accounting techniques to identify or to gather evidence, all right, forensic evidence, for the purposes of securing an investigation or prosecution in a judicial forum. So we have an individual here, assuming this individual has been traced. Trace the individual. Trace the individual responsible for fraudulent transactions. Number 10, obtain information. Obtain information regarding all the information regarding all the individuals. It can be an individual or individuals, regarding all the individuals involved. Look, dig deep. Dig deep. If it is an individual in the accounts department, get information regarding that individual. If it's a network of individuals who are in collusion, then get in all information regarding these individuals within that network. So that is very important procedure. Procedure number 11, inspect all transactions. Inspect all transactions conducted or performed, transaction, let me say transaction of similar nature, all transactions of similar nature conducted by the individual or individuals. After obtaining information regarding all the individuals, you may find some information. Then that information should be inspected and identify if there are similar transactions of similar nature conducted by the individual or the individuals. Then number 12, perform further analytical procedures. Perform further analytical procedures. Analytical procedures targeting these other areas to identify additional discrepancies. That is procedure number 12. Procedure number 13, quantify the loss, because this is fraud. If the company has lost money as a result of these fraudulent activities, then put a figure to the loss. I quantify the loss. Quantify the loss. State how much is involved in these fraudulent activities. Then lastly, number 14, you can, as a last procedure, interview the suspected individuals, and the purpose is to obtain a confession. That is, interview the suspected individual or individuals to obtain a testimony or a confession. Let me say, to obtain a confession. So that is the procedure that can be followed. Procedures can be followed or involved in applying forensic auditing in investigations, in fraud investigations. So this would earn you how many marks? This can earn a candidate 8 marks. These are 8 marks. Simply identifying or listing down the procedures. And you can see these procedures flow in a certain logical sequence. First, we said develop the profile of the company under investigation. 2, identify weaknesses in the internal control system. 3, perform trend analysis and analytical procedures. 4, identify changes in patterns of purchases or sales. 5, identify significant variations of raw materials, particularly where consumption seems excess. 6, identify unusual accounts and account balances like closing credit balance on accounts receivables, or we said the closing debit balance on accounts payables. That is an unusual account. Then 7, I review accounting records for unusual transactions not executed at normal commercial rates. 8, and on this point you've heard of cases before where a pen has been bought at 500 shillings. That is a pen which we know goes for 15 shillings. In some quarters it has been bought at 500 shillings. So those are rates that are not normal. So when you are reviewing accounting records and you come across unusual rates, commercial rates, then you will have to go back and review such records. I gave an example of rates provided by suppliers, where suppliers have provided rates and those rates have not been used in the company's accounting records. Then you check such areas. There could be room for fraudulent activities. Then 8, we said review source documents like invoices for discrepancies and inconsistencies. These candidates we covered in basic accounting, where we saw there are errors that can be deliberate, others may not be deliberate. Okay, we check for such discrepancies and errors in source documents. Number 9, once identified, trace the individual responsible for the fraudulent transactions. At this point now, after identifying the discrepancies, the areas that the fraud could have been committed, then you need to identify those individuals or the individual that is behind the fraudulent transactions. After identifying the individual who may also be working in collusion with other employees, then obtain information regarding all the individuals involved. Obtain their information. Number 11, inspect all transactions similar of similar nature, all right? Inspect all transactions of similar nature conducted by the individuals. Then perform further analytical procedures. These procedures, remember, we had conducted in our previous step, but having obtained information, new information, all right, after this inspection, then perform further analytical procedures targeting these other areas to identify additional discrepancies or inconsistencies. Then lastly, quantify the loss. Because this is fraud, the company may have incurred losses occasioned by these fraudulent activities. Put a figure to the loss. Then finally, interview the suspected individuals to obtain confession. So that is how the candidates were required to answer question 1C of May 2019. So candidates, that will mark the end of today's lesson where we began to revise the paper that was tested in May 2019. In our first lesson, we have covered lesson number 1. In our next lesson, we are going to tackle question number 2. So before you attempt the next lesson, please try to answer the question on your own. When you come to the next class, we will compare notes here on the board. Bye-bye. Question 3B reads as follows. Your firm is the auditor of Deluxe Tea Holdings Limited, a company which is planning to list on the National Securities Exchange within the next 6 months. The listing rules of the Securities Exchange require compliance with corporate governance principles to which the directors are unsure as to the company's compliance status. The directors have requested for your firm's advisory on this matter. Additional information: number 1, the company's board comprises 10 members, 6 executive directors and a non-executive chairman and 3 other non-executive directors. The chairman and one of the non-executive directors are former executive directors of the company and on reaching the retirement age were requested to take on non-executive roles. Number 2, the company has established an audit committee and all the NEDs are members, including the chairman of the board who chairs the committee. Number 3, all the 4 members of the audit committee were previously involved in sales or production-related roles. Number 4, all the directors have been members of the board for at least 4 years. Number 5, as the chairman does not have an executive role, he has the sole responsibility of liaising with the shareholders and answering any of their questions. The company has not established an internal audit function to monitor internal controls. Required: identify 4 corporate governance weaknesses faced by Deluxe Tea Holdings, and for each weakness provide a recommendation to address it. How many marks? 8 marks. So there are 2 parts in this question. One is to identify 4 corporate governance weaknesses, and 2 is to provide recommendation to address it. And just the same way we answered part A, we are going to answer part B. We have 2 columns. The first column will be for the corporate governance weaknesses. On one side, we have corporate governance weaknesses. Then on the other part, we'll have recommendation to address. Recommendation to address it. Recommendation to address it. I'll use my blue pen. 2 columns. These are 2 columns. So, on one column, we will identify the corporate governance weaknesses, and the other column we will suggest recommendation to address the weakness. Now, candidates, this is a question testing on the candidate's knowledge in corporate governance. Students who appear in the advanced auditing paper are presumed to have passed the strategic governance and ethics paper, because that paper is tested in section 5 of CPA, and this paper, advanced audit and assurance, is tested in section 6. So candidates were required to carry the knowledge that was acquired in strategic governance and ethics paper in answering this question. And the same way, these are the part of the question, part A, students who are required to use the knowledge that was gained in the lower auditing and assurance paper that was tested in section 4. So these questions are similar in 2 ways. One way is that the knowledge required is knowledge that was acquired in prior sections. In the other way in which these 2 questions are similar is that in both questions, students were to identify weaknesses and suggest ways to address the weaknesses. Here, the weakness was in the system, the internal control system in relation to purchases. Here, the weaknesses are in relation to corporate governance. So candidates, there is no way a candidate can answer this question without having knowledge in corporate governance principles. Okay, in this question, there is no way you could answer this question without having knowledge of an ideal purchasing system. Okay, the controls, ideal controls in a purchasing system. So let's go ahead and point out the weaknesses. Note number 1. The company's board comprises 10 members, 6 executive directors, a non-executive chairman, and 3 other non-executive directors. That means that this company comprises of 6 executive directors and 4 non-executive directors. That is a weakness. The board is not appropriately composed. There is no balance between the executive directors and the non-executive directors. That is a weakness which we need to note down. Number 1, the board is composed of 6 executive directors and 4 non-executive directors, and that means that the balance between the executive and non-executive directors is not appropriate. Balance is not appropriate in order to make objective decisions. Objective decisions cannot be made because the board is not properly composed. So what is the suggested recommendation to address this problem? recommendation. Half of the board should be comprised of the non-executive directors, okay, a half of the board should comprise non-executive directors. So how do you address it? You can say recruit and appoint additional independent non-executive directors. That is a way in which that problem can be addressed. That's it. Let's move on to identify any other weakness by reading through. We read the second sentence, note number 1. The chairman and one of the non-executive directors are former executive directors of the company, and on reaching the retirement age were requested to take on non-executive roles. The chairman and one of the non-executive directors are former executive directors of the company. Former executive directors of the company. Now, there lies another weakness, corporate governance weakness. All right? Due to the fact that this chairman was a former executive director of the company, then that raises a question of independence. Can this chairman be independent? That's an issue that has to be addressed. So let me put down the weakness. We say number 2, as former executive directors, they were previously employed. They were previously employed by the company and may not bring the required independence to the board. As former executive directors, they were previously employed by the company as executive directors. So they may not bring the required independence to the board. How do we correct that kind of weakness? Number 2, only independent non-executive directors, only independent non-executive directors with required or relevant experience and skills should be appointed to the board. Okay? Should be appointed to the board. That is corporate governance principle. only independent non-executive directors with relevant experience and skills should be appointed to the board. So how can that be addressed? Simply replace, right? We say replace, 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 replace those not independent. And a suggestion should be made in the next annual general meeting that those who are not independent, maybe half of the directors who are not independent, be replaced. Then in the subsequent annual general meeting, the other bit that is not independent can be replaced. So that is a solution to that problem. Moving on, this is the second point. Moving on to point, let's point out, do we have any other? Note number 2, the company has established an audit committee and all non-executive directors are members, including the chairman of the board who chairs the committee. Okay, a member. The chairman, the company has established an audit committee and all the non-executive directors are members, including the chairman of the board who chairs the committee. The chairman of the board chairs the audit committee. Right there, there is a problem. Okay, there is a problem. Number 3, the chairman and the non-executive directors, the chairman, let me put it this other way, the chairman, comma, a non-executive director, a non-executive director is audit committee chair. The audit committee chair. Now, candidates, the audit committee should comprise, we know that, should comprise independent non-executive directors. We all know that an audit committee has to comprise independent non-executive directors, those who are not engaged in the day-to-day operations of the company, because these are meant to check the controls that are put in place by the executive directors. So it is not good for the audit committee members to comprise the executive directors. The audit committee should comprise independent non-executive directors. In this case, the chairman of the board, can you imagine? The chairman of the board is at the same time the chairman of the audit committee. That is a weakness, corporate governance weakness. So how can that be addressed? Number 3, the chairman should relinquish the role of chair to the audit committee, and one of the newly appointed independent non-executive directors be appointed instead of this chairman. We said here that half of the board should be NEDs, recruit and appoint additional independent NEDs. So out of these that have been appointed here, then one of them should be appointed to replace this chairman of the board, who is at the same time the chairman to the audit committee. That is number 2. Number 3. Let's read through again and identify any other weakness. That was number 2. Number 3, all the 4 members of the audit committee were previously involved in sales or production related roles. That is a weakness. How is it a weakness? All the 4 members of the audit committee were previously involved in sales or production related roles. All. We know that the members, at least one of the members of the audit committee should have experience in financial matters. All right. Here we learn that all of them were previously engaged in production or sales roles. So that is a weakness. At least one of the members on that committee should have knowledge and experience in financial matters. That is a weakness. So let's point it out. Number 4, all the 4 members of the audit committee were involved in production / sales roles. We know that at least one member should have recent and relevant financial experience. None of them has financial experience, but all of them have experience in production and sales. That is a weakness. Let us recommend ways in which this can be addressed. This is number 4. When recruiting new independent non-executive directors, at least one should have recent and relevant experience in financial matters. Should have relevant experience in financial matters, should have experience in financial matters. When recruiting new independent non-executive directors, we said here recruit and appoint. That is number 4. Number 4. Let me check again. Marks are located here. Identify 4. Okay. Corporate governance weaknesses, and for each weakness provide recommendation to address it. We already have the 4. 4. 1, 2, 3, 4. Recommendations 1, 2, 3, 4. But candidates, there are more. For the sake of revision, let's identify the rest. That is not number 2, where that's not number 3. All the 4 members of the audit committee were previously involved in sales. Let's look at note number 4 if you can get any other weakness. All the directors have been members of the board for at least 4 years. All the directors have been members of the board at least 4 years. That is a weakness. That one is a weakness. 4 years is too long to have just the same people being on the board. That is not a good corporate governance practice. Okay, it's not a good corporate governance practice. So let's note the weakness. This is number 5. Number 5, all directors have been members of the board for at least 4 years. 4 years. Let me add, without being subjected to re-election. Without being subjected to re-election. It's important that the shareholders subjects these board members to re-election. It should not be automatic that they be directors, so that the board comprises of members who are appropriate. Okay, so let's propose recommendation number 5. Number 5, directors should be subjected to directors should be subjected to regular re-election process. Re-election process by the shareholders. That is a recommendation. Then number 6. Number 6. That was not number 5. Number 4. Number 5 reads, as the chairman does not have an executive role, he has the sole responsibility of liaising with the shareholders and answering any of their questions. The company has not established an internal audit function to monitor internal controls. Those are 2 weaknesses. 1, the fact that the chairman has the sole role. Okay? He has the sole role of liaising with the shareholders. That is not good corporate practice. The role of liaising with the shareholders lies with the entire board. Is not a sole responsibility of the chairman as it is in this case. That is one weakness. The other weakness is the fact that the company has not established an internal audit function to monitor internal controls. That is another weakness which we can identify. Number 6. Number 6, the chairman has the sole responsibility for liaising with the shareholders. This role should be played, I said, should be played by the entire board. This role should be played by the entire board, not solely the chairman to the board. The solution, recommendation number 6, all members of the board should be involved in satisfactory dialogue with the shareholders, e.g. in the annual AGMs. Or the board should appear before the annual general meetings so that they can have a dialogue with the shareholders. Then lastly, we have read that the company does not have an audit function, internal audit function. The last sentence there, the company has not established an internal audit function to monitor internal controls. Now, candidates, how do you not even write this one down? See this paper, just copying what is on this question paper to the board. And these to me are 3 marks. Okay? The question says, identify weaknesses, corporate governance weaknesses. That is the required. If you go to the note number 5, it says the company has not established internal audit function. That's obvious. It's a weakness. All right? So you note it down and get the marks. Just identify, is writing down, just copying from the question paper to the answer sheet. So you note down, this is number 7. The company does not have an internal audit function. That's our weakness. What is the answer? The answer is establish an internal control function. Okay? Number 7, recommendation. Establish an internal control function. Internal control function is, we know candidates, this will help the audit committee. This will help the audit committee discharge their responsibility of monitoring monitoring internal controls, Candidates, what's the point of having an audit committee, but you do not have an internal audit function? Because we know the internal audit function or the internal audit department or the internal auditor reports directly to the audit committee. And the audit committee may need feedback or information from the internal audit function for it to monitor internal controls, because this committee is not involved in the day-to-day operations of the company. They have to rely on the work done by the internal audit function. That is good corporate governance practice. So these are, again, additional points. 1, 2, 3. 1, 2, 3. Candidates who are required to propose 4 corporate governance weaknesses and recommendation to address the weaknesses. So that will mark the end of our today's paper. We have successfully completed question number 3, and you can see, candidates, the examiner can set a question from anywhere, all right? Can set a question from the previous papers, like this one is what you covered in strategy, governance and ethics. This is a question, this part A is a question that is lifted from the section 3 audit and assurance. So it's important to carry over knowledge. Okay, when you are appearing before these papers, don't lock the other knowledge you covered in your previous papers. You may require all the resources in terms of the knowledge covered in previous subjects. At times you may be called upon to rely on common sense, all right, on your experience in life to answer some of these questions, all right. So that is as far as question 3 goes. Thank you for being attentive. I want you to go through this question again, then broaden the scope. Look at similar question. In this question, the examiner tested the purchasing system, controls in purchasing system. Next time, the question may be from the sales system or the cash system. So familiarize yourself with all the systems in the accounting, subsystems in the accounting, the whole of the accounting system. Thank you, and I will say bye-bye.
Our eLearners is another time that we are meeting so that we can progress with our revision. And remember, we are revising November 2019 sitting. And today I would like us to look at question number 4. Question number 4, that is November 2019 question number 4. Question 4, we have part A and part B, and we are going to start with part A. So part A reads like this. Bill Sign is a retired engineer. He set up factory complex in an industrial area on 30th September 2017 to fabricate mechanical and auto spares at a cost of 48 million. However, operations commenced on 1st January 2018. The cost comprised the following. So we have factory building, office within the factory building, reinforcement of concrete floor to affix the factory, the machinery, land, architect fee, parking bay, electrical wiring, conveyor belt, lift and escalators, special shafts for lifts. He also provided the following additional information. Number 1, additional structures and works constructed and utilized from 1st January 2018 were as follows. So we have residential house, workplace nursery, a drawing and design room. Number 2, to improve the performance in the factory, an Oracle database that provides crowd service was constructed at a cost of 450,000. The computers in the drawing and design room had computer-aided design CAD application installed at a cost of 270,000. Number 3, a building that has been constructed at a cost of 12 million was leased from Jaram Manufacturers Limited for 5 years. The annual lease rental were agreed at 2.8 million. Nabil imported processing machinery from China at a cost of 5.2 million and installed in the building. Number 4, 2 warehouses were constructed at a cost of 2,250,000 and utilized from 1st September 2018. Number 5, the following assets were purchased or constructed during the year. We have furniture and fittings including 220,000 for the workplace nursery, library, display furniture stocked with mechanical engineering volume, computers and electronic adding machines, motor vehicles, lorry, tuk-tuk for the messenger, backhoe loader, additional processing machinery, and mobile clean. Required capital allowances due to the bill for the year ended 31st December 2018. This is about capital allowances, and as we know, capital allowances are many. We have more than one, and it depends now on the investor that we are provided with. So the investments that are done, they are the one that guide somebody when computing the capital allowances. For instance, if you have done an investment of a factory, then ID, investment deduction, need to be calculated. If we have invested in computers, then we need to know that again, we need to calculate wear and tear allowances. So because there are many, we are supposed to be guided by the investments that are done. So let's see the capital allowances that we are supposed to calculate at this point. So let's start with ID 2018. So we start with particulars, qualifying cost, and ID 100%. The items that qualifies for ID in my question, the first one is factory building. Factory building, and this factory building is costing 18,750. 18,750. 18,750. The second one is office, which is within the factory building. If the office is within the factory building, it can qualify for ID or IBD. So if its cost compared to the total cost of the factory building is less than 10%, then it qualifies for ID. But if it is more than that, then it qualifies for IBD at a rate now of 25%. IBD at a rate of 25%. If you take 6250, you divide by that total, outright you find that this is more than 20%. It's more than 30%. And therefore, this one will not qualify for ID. It will go to IBD. Then we have the third one, reinforcement of concrete floor, that is ID, concrete floor. And this concrete floor is 1650. 1650. 1650. The other one is land. Land does not qualify for capital allowance. Architect fee ID. Architect fee, that is ID 2430. 2430. Then we have parking bay ID. Parking bay, that is ID 990. 990. Then we have electrical wiring ID, that is ID 1480. 1480. Conveyor belt again is ID. Is ID, that is 1200. 1200. Lifts and escalators, that is WTA class 4. Special shafts, that's ID. Shafts, that is 3250. 3250. Additional note, the bill provided the following additional information. So we have number 1, this is about industrial building, so that is IBD, and I want ID, so I skip that. Number 2 is about computer softwares, so they qualify for WTA at a rate of 20%, so I skip that. Number 3, a building that has been constructed at a cost of this 12 million was leased, so we cannot get ID on that, but we imported and fixed a processing machine. So we have processing machine on this building which costed 5.2. 5.2. So that qualifies for ID. Number 4 is about IBD. Number 5, furnitures, that is WTA. Fixtures WTA, computers WTA, motor vehicle WTA, lorry WTA, tuk-tuk WTA, backhoe loader WTA, additional processing machine, again the ID, that is 9 million. 9 million. Mobile crane is WTA class 1. So allow me to go to IBD now. IBD. So this is total ID for 2018. So allow me to move to IBD 2018. IBD again, we are supposed to maintain a number of columns, and they are as follows. So we can have like particulars here, qualifying cost, rate, then IBD. So those columns are enough. So let me start with the one that is in the list, that is office. Office 6250, but I will calculate its IBD at a rate of 25%. So it is 6250. We multiply by 25%. 1562,500. 1562,500. Then from there, the other form of a building is not one. We have residential house. 960. This is 10%. 10%, so 96. Then we have workplace nursery and design room, which is 1200 and 720. So 10% again, 10%. So this is 120 and 72. 120 and 72. Number 2 is about computer software. So that is WTA. Number 3 we are done. Number 4 we have warehouses constructed at a cost of 2250. So we have warehouse 2250. Warehouse 2250. The rate is still 10%. But these warehouses, they were used from September. So we have September, October, November, December. So those are 4 months. September, October, November, December, 4 months. So 2250 times 10% times 4 divided by 12. So this is 75,000. 75,000. So according to me, those are the items that I can see, which again qualifies for IBD. So I go to the total. So total IBD for 2018. I'm free to move to WTA now. We have WTA 2018. So we can create the following columns. Particulars. We have class 1 at a rate of 37.5%. Class 2 at a rate of 30%. Class 3 at a rate of 25%. And class 4 at a rate of 12.5%. When calculating WTA, we normally start with opening balances if they are there. If they are not there, you ignore. In my question, we are starting this company afresh. So I have to ignore them. So the first item, I have lifts and escalators that are costing 4 million. That is WTA class 4, 4 million. Then from there, note 1 or note 2, I skip. Note 3, I skip. Note 4, I skip. Note 5, I have furniture. Furniture that costs 620,000. Then I have fixtures that cost 480,000. Still class 4, for 80,000. Computers and adding machines. This belongs to class 2, 840,000. Motor vehicle. So these are class second-hand BMW. This is class 3. And this is a non-commercial vehicle. So non-commercial vehicle, the price should be restricted to 2 million. Lorries 4 tons. This is class 1, 1.8. 1.8. Tuk-tuk is class 3. 180. 180. We also have backhoe loader. This is a heavy earth moving equipment that is self-propelling. So class 1. Heavy earth moving equipment that is self-propelling. And we have also mobile crane, which is also a heavy earth moving equipment that is self-propelling. So do I see any other item that qualifies for WTA? Any disposal? The answer is no. No. So what we need to do now, because if we had disposals, we have to less. Now that we don't have disposals, so we just get the totals. The first one is 1800 plus 3680 plus 1900, 7380. So 814. 2 million plus 180, 2180. So 4620 plus 418. 4620 plus 418. I'll get 51. 51. So then we calculate WTA 2018. So we have 7380 times 0.375. So we have 2,767,500. So balance is 7380 minus that, you get 46,500. The second one is 840 times 0.3. You get 252. So 840 minus that, you get 588. 2180 times 25%, you get 545. So difference 2180 minus that, you get 1635. So 5100 times 12.5. So you get 637,500. So 5100 minus 63, 637,500, you get 44,62,500. And remember, we are calculating capital allowances. So what we want is these figures. So we don't, these are balances of the values of the assets remaining after capital allowances. But what the examiner wants is this capital allowance. There is also capital allowance relating to note number 2. That is computer software. Computer softwares. So computer software. Computer software, we calculate it at a rate of 20% times into bracket 450 plus 270. So the computer software, it will be equal to we have 450 plus 270, you get 720 times 20%, you get 144. So computer software, so we calculate computer softwares qualifies for capital allowance at a rate of 10%, at a rate of 20%. So we can finalize. So the totals are, we have 18,750 plus 1650 plus 2413 plus 990 plus 1480 plus 1200 plus 3250 plus 5200 plus 9 million. We have 43,950,000. Then you have 16. Sorry, that is 1562,500. 1562,500 plus 96 plus 120 plus 72 plus 75. I have 1,925,500. So that is the capital allowance. So in my question, we had 3 major capital allowances. That is ID, IBD, and WTA. And that is what we have just done. So allow me to move to part B of the question. It reads like this. The following information has been extracted from the records of Leatherman Limited, who are regional suppliers of electronic equipment and appliances, for the year ended, that was December 2018. So we have operating profit before tax and other incomes, investment income, leasing of electronic equipment, and we have rental income. Additional information is also provided. Like we have investment income comprising interest income from Post Bank, fixed deposit account with Loada Bank, savings account. Then we have dividend from B&M Company Limited and Kampuni Sacco Society Limited. Number 2, we have rental income is arrived at after deducting the following expenses among others: mortgage interest on property, purchase of water meters, caretaker salaries, displacement of iron sheets with roofing tiles, withholding tax on rental income. The following expenses were considered before arriving at the operating profit before tax and other incomes: salaries and wages, retirement fund contribution, depreciation, bank interest, provision for bad debts, legal and professional fees, repairs and maintenance, salary expenses, donations, compensation, instrument tax paid for the previous year. Then construction of the watchman booth at the gate. Number 4, salaries and wages comprised of directors' allowances 300,000, directors' watchman salary, and salaries to other staffs. Number 4, bank interest include that of an overdraft taken by senior manager of 40,000 on the managing director residential house mortgage of 6,000, and the rest loan belong to the bank. Provision for bad debts is also analyzed, whereby we have this analyzed figure that was posted to the income statement of 10,000. Number 7, we have legal and professional fees comprise correction of trade debts, renewal of lease 99 years, accounting fee, audit fee, tax appeal, and staff loan collection. Audit fee relates to an inquiry by the Revenue Authority which revealed discrepancies that led to higher tax liability and penalties. Number 8, sundry expenses constitute staff Christmas party of 17,000, tax of 17,000, tax penalty for rate filing of 3,000, school fees 40,000, and other allowable expenses of 90,000. School fees was for the director's son, and the company agreed not to debit in the income statement. Number 9, donations were to the county governor political party campaign kitting. Number 10, compensation was to staff member who had not been issued with safety equipment and uniform as he carried out at the current premise, leading to him being badly injured. For 10 marks, the adjusted taxable profits. So, this taxation of a company, again indirect method. So what we are going to do, so we have Latheran company computation of taxable profit or loss for the year ended that 1st December 2020. So that is 2018. So you have particulars and we have sharings here. As I have said, these items are given after reporting an accounting profit. So the operating profit or accounting profit is amounting to 3.8 million. So as usual, we add back disallowable cost. Add back disallowable costs. These disallowable costs If you start with note 1 is about investment income, so no expense there. Note 2 is about rental income, again no expense there. But number 3 is where we have expenses. And we have salaries and wages. We know they are incurred purposely to generate the taxable income, so it is allowable. Retirement fund contribution is also allowable. Depreciation is not allowable. Depreciation of 400,000. It's not allowable. Then bank interest 180, that is normally allowable. But note 5 says bank interest include that of an overdraft taken by senior manager of 40. So that is not allowable. So bank interest relating to senior manager, that is 40. That 40 is not allowable. Then and on the money and the one relating to residential house, again not allowable. The one relating to residential house, so of 60,000, again that one is not allowable. It's personal in nature, that is why we are not allowing it. Provision for bad debts, we have the analysis at note number 6. At note 6 we have bad debts written off, which is allowable for customers, but for staffs it's not allowable. Bad debts relating to staffs, that one we cannot allow. 14,000. The other thing is under this provision, and we know provision, we need to know whether it is for general or specific. If it is for general, remember it is not acceptable, but for specific it is acceptable. If you look at the provision brought forward, which is for general, 3% of the account, that means it's general. We started with 8, but when clearing at the end of the period we have 9. So there is increase in general provision of 1,000, because it is 9 minus 8, which is 9, which is 1,000. Then I progress. Legal and the professional fee. Legal and the professional fee, normally it is allowable. But when you go to note number 7, we have some disallowables there. It's analyzed at note number 7, whereby correction for trade debts, that is allowable. Renewal allowable. Accounting fee is allowable. Audit. But audit, if you look at that paragraph immediately after that, it says audit fee related to inquiry by KRI which revealed discrepancies that led to higher tax liability and penalty. So that audit fee, then it will not be allowed. Audit fee. But normally, audit fee is allowable. If you come across it, it is an allowable expense. Tax appeal is not allowable. Tax appeals, 30,000. Staff loan correction, no. Staff loan correction. Staff loan correction. Staff loan correction, that is 5,000. But if it is to customers or clients, that is allowable. That is allowable. From there, we go to repairs. And the repairs are normally allowable. We have also surgery expenses allowable. Donations, under note 9, we are told that donations were to county government political party. No, donation to political party is not allowable. Donations. But if it is donations to registered charitable organization, that is allowable. Like donation to Children's Home, Red Cross, AMREF, those ones they are allowable. But political party, no. So these surgery expenses is also analyzed at a note number 8. And it reads like these surgery expenses, remember normally it is allowable. But you can include something there which is not allowable. For example, surgery expenses constitute staff Christmas party, that is allowable. It is allowable in the company, so you tax the staffs. Tax penalty. Tax penalty is not allowable. Tax penalty. Tax penalty of 3,000 for late filing. School fees 40 and other allowable expenses of 90. School fees was for director's son and other and the company agreed not to debit, so it was not subtracted, so you cannot add it back. So the other one is compensation. Note 10, compensation was to staff member who had not been issued with safety. That is our fault, so we cannot allow that. Compensation of how much? 92. 92. Construction of watchman booth at the gate, so that is not allowable. This is a capital cost, which is 240. That's a capital cost. Any other disallowable cost? Any other? Bank interest, salaries, but salaries not for comprise of director's allowances allowable, director watchman salary, this is allowable in the company. Then we tax the director as part of the income, and staff and salaries to other staff, that is also allowable. They are helping us to generate the taxable income. So that is the end of the disallowables. So allow me to go to I raise capital allowances. I don't see any asset around, so we don't have capital allowance. But we have now incomes. So we need now to less. We less the non-taxable. And in this case, we will not less them in fact because they are not included. So we need to add them because they have not been included. So what we need to do is to add them. So the first one, we have rental income. Rental income, in this case, rental income under note number 2, we are told that it was subject to a withholding tax. And we know very well, rental income subject to a withholding is subject to a withholding tax. Rental income that is less than 10 million per annum, but above 144,000 per annum, it is subject to a withholding tax of 10%, which is final. This was subject to a withholding tax 10%, which is final. So it is not taxable. We just need to leave it like that. But if it was above that, we need to take the incomes, we less the costs. So we move to the other income, the other item, which is dividend. These dividends, we have dividend income, and that is investment income. And this investment income is analyzed at a note number 1, whereby we have interest from post bank. Interest from post bank. Interest from post bank is subject to a withholding tax of, is tax exempt. Interest from post bank. So I can analyze this and investment incomes. So we are saying for rental and investment income. For rental income, we are simply saying that 10% withholding tax is final. So because it's paid every month. Then we have leasing income is taxable. Leasing income is taxable, which is 50,000. That one we tax. Then we go to interest income. Interest we have from post bank. Post bank. This is tax exempt. From fixed deposit. Remember, interest received by companies, withholding tax is not final. So this one from fixed deposit, 246,500. 246,500 we multiply by 100 divided by 85, that is taxable. And again from savings, which is 170 times 100 divided by 85. We are doing that because we tax the gross, not the net. Then from there we have dividend. This dividend received from companies or circles, 5% withholding tax is final, so they are not taxable again. So we have 246,500 times 100 divided by 85. You get 290. This one is 170 times 100 divided by 85. You get 200. So we don't have any other income, so we get the taxable income, taxable profit for the year. Taxable profit for the year. Just confirm everything. So we have that. So now we can just get the taxable income. So we have 3.8 plus 400 plus 40 plus 60 plus 14 plus 1 plus 15,000 plus 30 plus 5,000 plus 150 plus 3,000 plus 92 plus 240 plus 50 plus 290 plus 200. You get 5390. And that is the taxable profit. If you ask me to get the tax liability, this is a company. So tax liability, it will be 30% times 5390. So times 0.3, I get 1670. Because companies are taxed at a corporate tax rate prevailing in the year of income. So I just multiply that one by 30%. That is for resident company. If it was a non-resident company, we tax it at a rate of 37.5%. Now we come to the end of our question today. And as usual, I will give you the assignment. Remember, for the purpose of proper preparation, we need to do more and more questions. So what I would like you to do is I will give you assignment from our revision partner so that you can revise on your own. In our revision partner, we are under the topic of taxation of incomes of persons. That is employment income and business income. So I'll expect you to address like the following questions for practice purpose. That is May 2014, question 3A and C. That's about taxation of partnerships. We also have that is partnership. That is December 2013. But we have a company that is December 2013, question 2A and C. Taxation of Light Traders Limited. That is a taxation of a company. So you can also attempt that on your own. Yeah, there is also another question. December 2012, question 2 is about Lemuru Enterprises Limited. So can you do that for practice purpose? This is what we have done about taxation of companies, but can you attempt that for more and more practice? So that marks again the end of our class today. So let me stop my class at that point. We meet next time so that we can proceed with the blocks. So thank you.
Welcome to Manifested Publishers.
Hello learners, welcome back to Manifested e-learning platform. We are still continuing our previous lesson on reading and reading comprehension. The title of the comprehension was Gathoni's grandfather. So in our previous lesson, you were learning about the vocabulary words, the words that you will meet in the story and their meanings. You are supposed to understand the words first before we read them in the comprehension. So for this lesson, we are now going to read the story. So make sure that you are paying attention, and you will also, because at the end of this lesson, I will require you to answer questions about the story. Now, as we said earlier, that the title of the comprehension is about Gathoni's grandfather. Therefore, the story is all about a grandfather who belongs to a child called Gathoni. So Gathoni's grandfather. Gathoni came from a large family. She had many brothers, sisters, uncles, aunts, and cousins. However, in school, Gathoni used to hear her friends talking about their grandparents. She had never met her grandparents. One day, Gathoni asked her father, "Father, do I have grandparents?" "Your grandparents are my parents and the parents of your mother. Sadly, they died when your mother and I were still children." Gathoni felt a little sad. "Can you tell me something about them?" This question led to an interesting conversation. "I will tell you about one of your grandfathers. That is my father," her father said. Nobody knows where he came from. He just arrived at my grandfather's home one morning." "Just like that?" asked Gathoni. "Yes, just like that," her father said. "He was a young boy and he did not know the name of his parents. He did not even know his own name. Nobody was able to find out where he came from. My grandfather, who is your great-grandfather, guessed that the boy was an orphan, so he welcomed him into his home." "What did people call him?" asked Gathoni, with a lot of curiosity. Her father explained that since the boy did not know his name, the villagers said they would look for a name for him. In the meantime, he was given duties, looking after goats and sheep during the weekends. After a short time, the goats and sheep increased in number. One member of the clan said that they should call him Nyingi. Nyingi is a Swahili word that means many. Nyingi became his name, and my grandfather adopted him as his son. Thank you for the information. I will look for more information about family in my encyclopedia, said Gathoni. So I'm going to read the story once more as we learn more about few concepts that are arising from the story. Now, the title of the story is Gathoni's grandfather. Therefore, we are going to learn more about Gathoni's grandfather. So, Gathoni came from a large family. She had many brothers, sisters, uncles, aunts, and cousins. However, in school, Gathoni used to hear her friends talking about their grandparents. She had never met her grandparents. Now, in the first part of the story, we are now introduced to Gathoni's family. The writer is telling us Gathoni came from a large family where she had brothers, sisters, uncles, and aunts and cousins. But Gathoni did not have grandparents. She only came to learn about grandparents from her friends at school. Sometimes we learn things from friends. When you are at school, there are things you do not know when you are at home. But when your friends are talking about them, you now want to know more about that. So it is the same case with Gathoni. She had her friends talk about their grandparents at school, and she had never met her grandparents. Let's see what happened next. So one day, Gathoni asked her father, "Father, do I have grandparents?" Then, now Gathoni has now made a step ahead. She has gone to ask her father about the whereabouts of his grandparents because she has never met them. "Your grandparents are my parents and the parents of your mother. Sadly, they died when your mother and I were still children." Now we see Gathoni's father is now telling Gathoni about the grandparents. He's telling Gathoni that the grandparents are his parents and also the parents of Gathoni's mother. That tells us that grandparents are the parents of either your mother or your father. So Gathoni's father continues by telling her that the parents died long time ago when Gathoni's father and Gathoni's mother were still very young. So Gathoni felt a little sad. "Can you tell me something about them?" This question led to an interesting conversation. Now Gathoni wants to know more about her grandparents. What happened to them? Why did they die so early? So it led to an interesting conversation, a discussion about the grandparents. So I will tell you about one of your grandfathers. That is my father. Her father said, "Nobody knows where he came from. He just arrived at my grandfather's home one morning." Just like that, asked Gathoni. Now Gathoni still wants to know more about his grandfather. And in this case, his father is telling her about the story of her grandfather from his father's side, the father of his father. So, "Nobody knows where he came from. He just arrived at my grandfather's home one morning." Just like that, asked Gathoni. "Yes, just like that," her father said. "He was a young boy and he did not know the name of his parents. He did not even know his own name. Nobody was able to find out where he came from. My grandfather, who is your great-grandfather, guessed that the boy was an orphan, so he welcomed him into his home." Now, the part that I have read, we are now introduced to the great-grandfather of Gathoni. A great-grandparent is a parent to your grandparents. Remember that our grandparents also had parents, so we shall call them our great-grandparents. So my grandfather is your great-grandfather. Guess that the boy was an orphan. Remember that an orphan is a child whose both parents are dead or died. So he welcomed him into his home. "What did people call him?" asked Gathoni with a lot of curiosity. Being curious, you want to know more about something, you are anxious, you want to now understand. The boy came, he did not know his name, he did not know the name of his parents, and what happened? If he did not have a name, what did you people call him? So her father explained that since the boy did not know his name, the villagers said that they will look for a name for him. In the meantime, he was given duties. He was given some tasks to perform. So the tasks are this: looking after goats and sheep during the weekends. After a short time, the goats and sheep increased in number. one member of the clan said that they should call him Nyingi. Now, this particular boy was given duties. He was supposed to look after goats and sheep during the weekends on a Saturday or a Sunday. But after a short time, the goats and sheep now increased in number. They became many. So one member of the clan said that they should call him Nyingi. Nyingi is a Swahili word that means many. Nyingi became his name, and my grandfather adopted him as his son. Now, after this boy came to the village and they assigned him some duties of looking after the goats and sheep on a weekend, he was later adopted by Gathoni's grandfather. Thank you. Nyingi is a Swahili word that means many. Nyingi became his name. He was now given a name. He was called Nyingi. And then word Nyingi is a Swahili word that means many. And my grandfather adopted him as his son. Now, Gathoni's great-grandfather adopted Nyingi as a son. Thank you for the information. I will look for more information about family in my encyclopedia, said Gathoni. Now, Gathoni wanted to know more about family, and instead of asking his father about family, she decided that she'll get an encyclopedia, and the encyclopedia will give her more information about a family. Now, an encyclopedia is a book that gives information about many things. When you want to know about families, you want to know about plants, about animals, you get it from an encyclopedia. So that's all about Gathoni's grandfather. We have been introduced to Gathoni's grandfather, and in the story we have also come to learn about his great-grandfather. Now I want us to answer questions on the comprehension that we have read, but before that I shall answer with you the first 3 questions, then you shall do the rest. Now the questions are here. The first question, write 3 words about family from the passage. Write 3 words about family from the passage. Write 3 words about family from the passage. The question has already guided you on what you're supposed to do or where you're supposed to get your answers. Remember that questions from a comprehension or a passage, their answers are always in the passage. So write 3 words about family from the passage. You go back to the passage and get 3 words about a family. Now, from our very first paragraph, we are able to get the answers to our question. Now, Gathoni came from a large family. She had many brothers, sisters, uncles, aunts, and cousins. However, in school, Gathoni used to hear her friends talking about their grandparents. She had never met her grandparents. Now, from the very first paragraph of our passage, we already have some names that talk about family. We have brothers. So we have brothers. Then it has also talked about sisters and uncles. So the question only asks us about 3 words about family from the passage. Now these are just some of the words that are in the passage about family. We still have more. We have grandparents, we have great-grandfather, we also have aunts. Then the second question, what made Gathoni feel a little sad? What made Gathoni feel a little sad? So what made Gathoni feel a little sad from the story? What made Gathoni feel a little sad? So you go back to the story and look for a place where Gathoni felt a little sad and you read the part. So from the story, the part where Gathoni felt a little sad is on paragraph 1, 2, 3, the fourth paragraph. So you read the fourth paragraph. And I'll read, Gathoni felt a little sad. Can you tell me something about them? This question led to an interesting conversation. Now, before Gathoni felt a little sad, there is something that she was told by his father that made her feel sad. So let's find out from the story, the third paragraph. Your grandparents are my parents and the parents of your mother. Sadly, they died when your mother and I were still children. Gathoni felt a little sad. So, what made Gathoni feel a little sad? Gathoni felt a little sad because both grandparents had already died. After his father gave her the news that the parents had died when they are still young, it made her feel sad. Remember, news about death, about sickness are sad news. They do not make us happy, and that is why Gathoni felt sad. So Gathoni felt sad because his father told him the news about the death of his grandparents. So what made Gathoni feel a little sad? Gathoni felt sad about the death of her grandparents. So Gathoni felt sad about the deaths of her grandparents. That is what made her feel sad. So I'm only going to answer the first and the second questions, which I have done. Make sure that when answering the questions from the comprehension, you go back to the passage. And if the answer is not in the passage, you are going to think of a possible answer. Then you write your answer. Remember that we think using our minds. We do not think using our heads. So, where you'll be required to think, please do so and give your answers. Meanwhile, I want you to copy the questions that are right on the board and you will answer them. Now, here are the questions from the passage. Only 3 questions. And the instructions are guiding you on what to do. Answer the following question. Number 1, why did Gathoni's great-grandfather welcome the boy into his home? Why did Gathoni's great-grandfather welcome the boy into his home? So you'll write the answer. The second question, what tells us that the boy looked after the goats and sheep well? What tells us that the boy looked after the goats and the sheep well? And lastly, why do you think it was important to give the boy a name? Why was it important or necessary for the boy to be given a name? So finish the work and also go through your answers just to ascertain some mistake that you might have committed. Otherwise, thanks for being good listeners. Hope to see you next time.
Hello Dana, welcome to Manifested online platform. My name is Joseph Kimani. So today I want us to continue with our topic number 2. In topic or in our previous class, we looked on various subtopic in that particular topic number 2, whereby we managed to cover on various issues. One, we looked on how an entity should report on investment property. 2, we looked on issues to do with the event after the balance sheet date. We also looked on the issues to do with employees benefit. Now, in today's class, I want us to continue with the same topic number 2, and we look on the issue to do with the income taxes. That is income taxes, which is governed by IAS 12, income taxes. Now, in this particular topic here, we are going to define, and also we look on how an entity or maybe how a company should account for 2 types of taxes. One, we do have what we refer to as the current tax, and number 2, we do have what we refer to as the deferred tax. So therefore, those are the 2 types of taxes which we are going to look on how they are supposed now to be accounted for by a reporting entity. But even before you look on those 2 types of taxes, when talk about income tax, as far as a company is concerned, this is the amount of tax which a company is supposed to pay to the government based on the profit which is reported by a company at the end of the financial year. Because what we need to remember from commercial law is that a company is deemed to be a legal entity. So mean that a company then has to pay tax just like any other individual now to the government. Now, first of all, to start with the first type of tax here, that is the current tax. This refers to the actual amount of tax which now a company is supposed now to pay to the government in respect now to the trading activities of a certain reporting period. So mean that this is the actual amount of tax, payable to the tax authority, in respect to the trading activities, activities of a certain accounting period, So therefore, a current tax will refer to that amount of tax which now a company is supposed to pay. And also what we need to remember from taxation is that this particular amount of tax which the company is supposed to pay should always be based on what refers as the taxable profit. And also from taxation, you must be in a position to remember how we compute the taxable profit. So therefore, the current tax, therefore, we say is the actual amount of tax which is supposed to be paid. Now, in this particular case, we also need to look on how this particular tax is supposed now to be recognized by a company. That is recognition of a current tax. Now, this tax which now a company is supposed now to pay in a certain accounting period, according to IAS 12, it should be accounted for as an expense. So mean that the amount of current tax, this will be accounted for as an expense, in the income statement, statement. And that's why whenever we are to prepare the income statement, what we do is that once now we get the profit before tax, we are supposed to proceed and we less the current tax. So the reason why we less that current tax, it is because that tax is an expense, in the income statement. Also, according to IAS 12, if at all maybe we have any unpaid tax,
any unpaid tax, or what we refer as a accrued tax. This is basically the tax now which the company has not paid, maybe at the end of a certain accounting period. Now, this particular tax which has not been paid, according to IS 12, it should be accounted for by the reporting entity as a current liability, liability. Now, on the other hand, there are some cases whereby a company may have paid more tax than it was supposed to pay, meaning that in such a case, then we may be having what we refer to as a prepaid tax. Now, such a prepaid tax, then this should be accounted for by the reporting entity as a current asset, because by the end of the day, the company can be able to recover that particular tax from what? From the government. But on the other hand, what you need to remember is that whenever now we are to determine the actual amount of tax which is supposed to be paid by a company, we have said that that tax, or basically now the current tax, which you have said is the actual amount of tax, this is always computed, or it is determined based on the taxable profit. It is determined based on the taxable profit. Now, in this case, when we talk about what we refer as the taxable profit, this we say is that particular profit which is computed by the company based on what we refer as the existing tax laws, meaning that for us to be able to compute the taxable profit, we take the taxable incomes and then we less only the allowable expenses. So therefore, the amount of tax which is supposed now to be paid, it is determined, or it is computed based on the taxable profit. And therefore, what you need to note is that as at the end of the year, the amount of tax which will be charged in the income statement is usually a provision. A provision, meaning that the amount of current tax which is charged in the income statement at the end of the year, at the year end, is usually a provision. A provision. Now, in this case, the reason why we say that that particular amount is a provision, it is because the amount of tax which is supposed to be paid, it will always be based on taxable profit. Now, what we know from taxation is that for a company to be able to compute the taxable profit, that profit is always computed from the accounting profit. Now, in this case, there is a difference between taxable profit and basically accounting profit. Before we go back to this, so when talk about what we refer as a accounting profit, we say that this is a profit now which is computed by the company based on the accounting concept and also the accounting policies applied by an entity. And therefore, once an entity prepares the income statement at the end of the year, that profit which is reported there, or what in other terms we refer to the profit before tax, that is the accounting profit. It is the accounting profit. And the tax, or the actual amount of tax which is supposed to be paid, is never determined on this. Rather, it is determined based on taxable profit. And therefore, what we are saying is that once now the income statement has been prepared at the end of the year, then the profit which will be computed will be the accounting profit. And therefore, that particular amount of tax now which we provide for in the income statement, it will actually be a provision, because now the taxable profit can only be determined after the preparation of the income statement. So therefore, that is very, very important, that this particular amount of current tax which we charge in the income statement, it is not the actual amount of tax which will be paid, but rather it is a provision. And therefore, once now that provision has been provided for, or the amount of current tax has been provided for, then that will give rise to something known as over provision, or other provision, provision of current tax, of current tax. So in our case here, we need to know how this over provision and also under provision arises. Maybe we start with what we refer as the over provision of current tax of current tax. Now in this case, this will actually realize if the amount of tax or the amount of current tax which was provided for at the end of the year is then more than the amount of tax which was actually supposed to be paid. Like maybe let's assume that when the income statement was being prepared at the end of the year, the amount of current tax which was provided for maybe at the end of the year 2018 was something like 20 million or something like 20 million, because what we have said is that whenever the company is preparing the income statement at the end of the year, that amount of tax which it will be including there, it is just a provision, because we have said the actual amount of tax to be paid can only be determined after the income statement has been prepared. So therefore, assuming that the amount of tax which was provided for was 20 million, and once now the actual amount of tax is determined now based on what we refer as the taxable profit, that actual amount of tax or the actual amount of tax, then it is determined to be something like 15 million. Then in this case, you'll see that the amount of tax which was provided for at the end of 2018 was 20 million, but the actual amount of tax which was determined to be payable to tax authority, then in this case has been determined to be what? To be 15 million. So mean that in this case then the amount which was provided for in the income statement is 5 million more than the actual amount of tax which was paid. Now that 5 million here, we refer to that as an over provision of current tax, over provision of current what? Tax. Now this particular over provision of current tax, in terms of how we account for it, it is supposed to be carried forward, and then it will be used in reducing the amount of tax which will be provided for in the next financial year, meaning that the amount of over provision, in current tax should be carried forward definitely to the next financial year, and should be used to reduce the amount of current tax provision, or to reduce the amount of current tax to be provided for in the next financial year, or basically in the next year. So mean that if, for example, maybe in the year 2019 the company will make a tax provision, or maybe the current tax provision of something like 25 million. Now this particular over provision in the previous year then will be used in terms of reducing that particular provision, meaning that if now in the year 2019 the amount of current tax to be provided for will be 25 million. Then what you are saying is that because in the previous year, that is in the year 2018, we had over provision of 5 million. Now that particular over provision then will be deducted, or basically will be used to reduce that particular amount to be provided for, meaning that in this particular year 2019, then the amount of current tax to be deducted from the profit before tax, then in that case it will be 20 million. So therefore that is very, very important to know how the over provision of tax will arise, that is over provision of current tax arises, and also how we account for that. Now on the other hand, we have said that we may be having what we refer to as other provision of current tax, under provision of current tax. Now, under provision of current tax arises if the amount of tax which was provided for at the end of a financial year is less than the actual amount of tax which is supposed to be paid. For example, let's assume that in the year 2018, the current tax provided for at the end of 2018 is maybe 20 million, but once now the actual tax is determined, the actual amount of tax is determined, then that is determined to be something like 25 million. So then in this case you'll see that the company provided for amount of tax which was equivalent to 20 million, but the actual amount of tax which was determined now based on our taxable profit then was 25 million, meaning that then in our case here we will be having what we refer to as a other provision of current tax, which in our case now will be 5 million. Now, this particular other provision of current tax, just like over provision, this is supposed now to be carried forward to the next financial year, and it should be added to the amount of tax which will be provided for in the year 2019. So mean that the other provision of current tax should be carried forward to the next year, and should be added, that is very, very important, should be added to the tax provision in that year, meaning that like assuming in the year 2019 now, which is the next financial year from the year 2018, let's assume that the amount of current tax to be provided for is Kenya shillings maybe 28 million. Now in the year 2018 here you'll see that we had what other provision. Now this particular other provision, we have said that it should be carried forward now to the next or basically to this year, and then it should be added to the amount of tax which will be provided for. So mean that to that then what you are supposed to do is to add now the other provision of current tax in the year 2018, which is an amount of 5 million. And that means that the amount of tax then which you are going to charge in the income statement, or which will be deducted from the profit before tax, then in our case will be an amount of 33 million. So therefore that how over the provision of current tax arises, and basically that's how we are supposed now to account for that. So therefore, as far as now the current tax is concerned, I think those are the various issues which are very, very important. That current tax, we have said, is the actual amount of tax which is supposed to be paid to the tax authority in a given accounting period. And what you have said is that that particular amount of current tax then to a reporting entity, then it is an expense in the income statement. 2, we have said that if at all maybe there is an unpaid tax, then to the company that is a current liability. If now we have a prepaid tax, then that is a current asset. Then on the other And you also need to remember that that particular amount of tax or the amount of current tax which is deducted from the accounting profit is always a provision, because essentially what you have said is that for us now to be able to determine this actual amount of tax which is supposed to be paid, that can only be determined based on the taxable profit, and this profit can only be computed after the company has computed the accounting profit. So therefore, once now a provision has been made at the end of the year, then you have said it can give rise to over provision and also under provision. So therefore, in that case, you need to know how the over provision of current tax arises, how we account for that, how the other provision of current tax arises, and also still how we account for that. So therefore, as far as the current tax is concerned, that basically what you need to know. Then I want us we proceed and we look on the other type of tax, and that is the deferred tax. Deferred tax. Now, in this case, when talk about deferred tax, this is one of the area which most of the students do have a challenge in, but it is a very, very simple concept now to understand. Now, when talk about deferred tax, this is actually defined under IAS 12 as an accounting device which is now used to measure the tax effect of a transaction with what referred as the accounting accounting impact. Or in very simple terms, when talk about deferred tax, we can say that this is the amount of tax which was supposed to be paid in the current financial year, but it has been deferred and it will be paid on a later period, or it is an amount of tax which an entity or a company was supposed to recover in the current financial year, but it has been deferred and it will be recovered in the future. So therefore, in very simple terms, that is what referred as a deferred tax. But in terms of how this is defined under IAS 12, we have said it is an accounting device, used to match the tax effect of a transaction, with its accounting impact, Now, in this case, what you need to note is that a deferred tax will arise as a result of the difference between what referred as accounting profit and what referred as a taxable profit. And even before we look on how deferred tax arises, I want us to differentiate between those two profits, that is what referred as accounting profit and the taxable profit. Now, when talk about the accounting profit, this is what in other terms we refer to as the profit before tax, and this is a profit which is computed in terms of preparing the income statement, of which now for us to compute this profit here, we computed based on the various accounting policies and also the various accounting concepts adopted by an entity. So therefore we say that the accounting profit is the profit which is computed, or a profit which is based on the accounting concepts and policies adopted by an entity, And what that means is that whenever now we are to compute now this particular profit here, that is the accounting profit, we take all the incomes of a business and then we less all expenses, meaning that the incomes now which we take into account, they may be taxable incomes or may not be taxable what? Income. Still we less all expenses which may be allowable and which may be desirable. So that profit which now is reported by an entity after preparing the income statement, we refer to that as accounting profit. Now on the other hand, we have the other type of profit known as taxable profit, known as a taxable profit. Now when talk about taxable profit in taxation, this is a profit we talk of, and therefore we say that this is a profit which is computed by an entity based on the existing tax laws, meaning that for us to be able to compute this particular profit here, we take only the taxable incomes and then we less all what? We less all the allowable expenses. So therefore we say that this is a profit, is the profit computed based on existing tax laws, and therefore what I've said is that for us now to be able to compute this particular profit here, we only consider taxable incomes and allowable expenses. So mean that it is computed using taxable incomes and allowable expenses, or basically what in other terms we refer to as deductible expenses. Now what we have said is that the reason why we have a deferred tax is because these two profit will be what? Will be different. And that particular difference between the two profit, that is the difference between what we refer to as accounting profit, the difference between accounting profit and the taxable profit may be classified into two what categories. One, we do have what we refer as the permanent difference, and number two, we do have what we refer as the timing differences. So therefore that difference between the accounting profit and taxable profit may either be permanent difference or a timing what difference. Now we need to know what is the meaning of those two terms. One, we have what we refer as the permanent difference. Now when talk about a permanent difference, we say that this is the difference between the accounting profit and taxable profit, which arises because we have certain items of incomes and expenses which are considered or which are taken into account in the computation of accounting profit, but those items of income and expenses, we don't take them into account in the computation of taxable profit. Now a very good example of that is what we refer as depreciation, what we refer as penalties and fines, because what we know is that for the purpose of computing now the accounting profit or that profit which is in the income statement, items such as depreciation, items such as fines and penalties, all those items are treated as expenses. But when we come back to taxation, we know depreciation, we know fines and penalties, they are desirable what expenses. So therefore, as a result of that, those two differences, those two profit will be what? Will be different. So therefore, we have said that the permanent difference, this is the difference between accounting profit and taxable profit and taxable profit as a result of various items items of incomes and expenses incomes and expenses, income and expenses taken into account in the computation of accounting profit, taken into account in the computation of accounting profit, but not in a computation of taxable profit, profit. Now, those particular items of incomes and expenses, I've said that good examples will include, examples of such items include what we refer to as fines and penalties, We have what we refer as depreciation on property, plant and equipment, what is abbreviated as PP. We also have what we refer as impairment loss on goodwill, Now, what we know from taxation is that all these particular expenses here, we say that they are disallowable expenses. But what we also know is that when preparing the income statement of a company, we take into account all these particular items of expenses here in the computation of the profit, or in the computation of the accounting profit. So therefore, as a result of that, the accounting profit and the taxable profit will be different. And basically that difference we refer to it as a permanent difference. And what we say is that this difference will only occur when those items are taken into account in the computation of accounting profit, but not in the computation of taxable profit. But that difference will never occur again. That's why that difference, we refer to it as a permanent difference. So we say that this difference occurs only once. Meaning that once the difference between the accounting profit and taxable profit arises, it will not reverse in the future. It will not reverse in what? In the future. As a result of that, this difference do not give rise. This difference do not give rise to deferred tax. Does not give rise to deferred tax. Do not give rise to deferred tax. And effectively what that means is that for the computation of deferred tax, we don't consider the permanent difference. Now, the other difference between now the accounting profit and taxable profit, we have referred to that as the timing difference. Now, when talk about this difference here, it is a difference between accounting profit and taxable profit, which arises as a result of taking into account various items of income and expenses in the computation of accounting profit and taxable profit, but in different accounting period. For example, we may be having an item of expense which is taken into account in the computation of accounting profit, maybe in the year 2019, but that item of expense will only be allowed for tax purpose, maybe in future, like in the year 2022. What that means is that difference between the accounting profit and taxable profit, which arises in the year 2019, it will then reverse in 2022. So therefore, this difference here is the one thing which gives rise now to timing. It gives rise to deferred tax. So first of all, we have said that this is the difference. Between the two profit, the difference between the two profits profit, that is definitely the accounting profit and taxable profit, which arises as a result of taking into account various items of income and expenses, income and expenses, take into account various items of income and expenses in the computation of two profits in different accounting period, And therefore, what you have said is that this particular difference here, that is the timing difference, it is the one which will give rise now to what we refer to as a deferred tax. And I want to illustrate using a very, very simple illustration here how a deferred tax will arise, so that as we move forward, you'll be in a position to understand how a deferred tax do arise. Like maybe let's assume in the year 2018, a company reported accounting profit. Remember, we have said that to talk about accounting profit, this is what in other terms referred to as a profit before what? A tax. Maybe the accounting profit was 15 million, and then you are told in the same year, that is the year 2018, the depreciation on a certain asset, which now was charged in the income statement, was maybe 5 million, and then we also told that during that year, the capital allowance maybe was like 8 million, and then still we are told the tax rate during that year maybe was 30%. And then what we are then required to do is to compute now the deferred tax. We compute deferred tax. Now, what you have said is that for us now to be able to compute now the actual amount of tax which is supposed to be paid, that actual amount of tax should always be computed on the taxable profit. But in this particular case, first of all, for us to be able to compute this deferred tax, we say that during this year 2018, this company was supposed to pay all the amount of tax which was supposed to be paid, and the amount of tax which was supposed to be paid this tax will be based on the profit, on the profit, because generally what you have said is that the tax which is supposed to be paid should be based on the profit. Basically, when we talk about profit, or generally when we talk about profit, you are talking of the accounting profit, meaning that the amount of tax then which was supposed to be paid during this year will be given by the profit which was reported by that company, and then we multiply that with the tax rate, which is 30%, and that will give us 4.5 million. So during the year 2018, using the profit which was reported, that is the accounting profit, then this company was supposed to pay a tax of 4.5, but that is not the tax which will be paid, because the actual or the current tax which is supposed to be paid, we have said it is computed based on taxable profit. So therefore, what we need to do from this information, let's compute the taxable profit. We compute the taxable profit. Now, the taxable profit in this case, what we know is given by what we refer to as accounting profit. This we need to remember from what you did in taxation. Accounting profit in our case is given as 15 million. For us to compute the taxable profit, to this we need to add back any desirable expense which was deducted in arriving at that profit. Now, meaning that we need to add all desirable expenses, expenses. Now, from this information which we have here, where we have depreciation and capital allowance, we know that depreciation here, this is a desirable expense. Is a desirable what? Expense. Means that for taxation purpose, depreciation is treated as non-deductible or desirable expense. So therefore, what we need to do here is we come back and or we add back depreciation. We add back depreciation, which in our case is an amount of how much? 5 million. We add back that. And then once we add back, we are going to get 20 million. And then to that, we are supposed to less the allowable expenses, which have not been deducted in arriving at that what? Profit. Now, in our case, what we know is that when computing the accounting profit, a capital allowance is never included there as an expense, because this is considered in taxation, or basically when computing the taxable profit. So this capital allowance we know is allowable expense, but it has not been deducted in terms of arriving at that a profit. So therefore, our allowable expense here is a capital allowance, and which is an amount of 8 million, So once now we deduct that, in our case we are going to have 12 million. So this is now what referred as the taxable profit. Basically, in our case, therefore, you can see that our accounting profit, which is 15 million, is different from the taxable profit. And therefore, using this taxable profit, we can be able to compute the current tax. Remember, from our definition, we have said that the current tax is the actual amount of tax which is supposed to be paid. So therefore, the actual amount of tax which was supposed to be paid, actual tax, will be equal to 12 million times the tax rate, which is 30%, and this will give us 3.6 million. So therefore, what we need to do here, if you compare these two taxes here, if we compare those two taxes, we have said that in the year 2018, based on the profit which was reported by the company was supposed to pay a tax of 4.5, but that is not the actual amount of tax which will be paid, because the actual amount of tax which is supposed to be paid should always be based on this profit, meaning that the actual amount of tax which the company will pay to tax authority or maybe to the government is an amount of 3.6, and therefore you can see that the company then has paid less tax than it was supposed to pay, and therefore the difference between those two figures there is now what we refer to as deferred tax, tax. So therefore, the deferred tax in our case will be equal to what was supposed to be paid as tax minus 3.6 million, and that will give us now a difference of 0.9. Now this 0.9 here is what we refer to as a deferred tax. Remember, what we have said is that in very simple terms, deferred tax is the tax which was supposed to be paid during the current year but has been deferred, it will be paid on a later period, or is a tax which the company was supposed to recover during the current period but has been deferred and it will be recovered on a later period. Because like in our case here, you can see the company was supposed to pay 4.5, but how much tax will be paid? 3.6, meaning that then the company has paid less tax than it was supposed to pay, meaning that this 0.9, then it is a tax which was supposed to be paid during the current year, but it will be paid in what? In future. Now, according to IAS 12, a company is required to provide for this, for this, meaning that whenever the company is preparing the income statement, it should take now this particular accounting profit here, that is 15 million, the company is supposed to deduct what? 3.6 million. 3.6, now remember here in our case, is the current what? Tax. Is the current tax, the actual amount of tax which is supposed to be paid. But other than deducting that particular amount of 3.6, the company is also supposed to deduct an amount of 0.9. Now this 0.9 is known as deferred tax. Tax. Basically, deferred tax is not a tax which will be paid during the current year, but we have said this is just like a provision, because during the current year the company was supposed to pay 4.5, but it has paid 3.6. So therefore the company should provide for less tax it was supposed to pay during the current year, because by the end of the day it will have to be paid in what? It will have to be paid in future. So therefore, in very simple terms, that's how a deferred tax is, or basically deferred tax do what? Do arises. So we are going to come to an end at that point in our first class. So in our next class, I think we will come back and we look on various aspects or more aspects of deferred tax, because we do have various approaches which are used in terms of computing deferred tax: income statement approach, a balance sheet approach. We look on those particular approaches as we look on more aspects. So therefore, for the time being, we take a short break and then we come back in our next class.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri and I am a practitioner within the financial services industry in Kenya. Ladies and gentlemen, today we are going to discuss financial modeling and data analytics practical paper. The focus is on the pilot paper which came out in March 2023. So the section we're going to discuss is section 2, which has a total of 60 marks. Question 21 reads as follows. Jeff Mark, a potential investor from United Kingdom, is considering investing in a technology startup in Nairobi, Kenya. The investor has approached you as a financial analyst to perform a discounted cash flow valuation to determine the company's fair value. You have been given the following information. Number 1, projected revenue for the target company for the next 5 years, 5 million, 6 million, 7 million, 8 million, and 9 million respectively. Number 2, selling, general administration and other expenses is expected to be 45% of sales. Number 3, depreciation is expected to be 5% of sales. Capital expenditures are expected to be 450, 600, 750,000, 900,000, and 1 million in the next 5 years, respectively. Number 5, changes in net working capital are expected to amount to 150,000, 200,000, 250,000, 300,000, and 350,000 in the next 5 years, respectively. The startup has a cost of debt of 10%. The capital structure of the company is 30% debt, 70% equity. The company has an outstanding debt, that's note number 8, of 500,000. The net borrowing over the 5-year period is expected to be 0. We move on to number 9. The terminal growth rate is 5%. The risk-free rate is 7%. That's note number 10. Number 11, the expected market rate of return is 15%. Number 12, the industry beta is 1.5. The startup has a tax rate of 30%. The examiner is requiring you to calculate the free cash flow to firm, FCFF, value of the firm in Excel. So I will be able to work with you while we discuss the solution on my right hand side over here. So let's navigate on that side. So we start over here. The starting point is to determine the formula or to compute the formula. The formula for calculating free cash flow to firm is as follows. So FCFF, put it in capital, in caps, FCFF is given as, you need to compute the net income, and then you add non-cash charges. I shall be able to explain what all of these terms are. Non-cash charges, and then you add
interest 1 minus tax, or what we can say is after tax interest expense. So interest into brackets 1 minus tax T, allow me to put like that, can be able to just put it in full tax like that, and then you deduct the fixed capital investments FCINV, we'll denote it as that, FCINV, fixed capital investments, and then, ladies and gentlemen, we deduct the working capital investments, WCINV. So I will walk you, or we will walk together. I will put it in a columnar format over here where we're going to discuss all of these items over here. So we are being informed that it is a 5-year period. That should be our starting point before I actually explain what all of these terms are. So we are saying that we have the years, we can start from over here, year 1, moving through to year 5, right there. So we drag it like this for 5 years. Don't worry about that. In Excel, it might indicate like that, but you just click this button autofill here. So if you want to copy the cells, do you want to fill series? I want, or we want to fill the series. But there, you can clearly see it actually gives us a 5-year period there. So then we will walk through over here towards our left here by indicating the items over here that will lead us towards calculating the net income. So how do we calculate the net income? The net income is just the sales less cost of sales. You're supposed to get the gross profit, then you less expenses, you get the EBITDA, you deduct the depreciation, and then you deduct taxes to get the net income. So, ladies and gentlemen, for net income, we shall be able to compute it right away, because from the question we haven't been given what net income is. As for non-cash charges, this is just depreciation and amortization. And from the question, if we navigate back to the left over here, you can be able to see that we have note number 3. Depreciation is expected to be 5% of sales. So that one is well covered in the question. Getting back, we need then to identify the interest component. And this one we're looking at after-tax interest expense. This is important and needs to be added back because we are only interested in that interest component that is due to the bond holders. So we need to get the after-tax interest expense. Then we proceed on by computing the fixed capital investments. The fixed capital investments represents the capital expenditures. Every firm has to have fixed capital investments or capital expenditures in the sense that they need to buy equipment, they need to buy property, they need to buy plant, you name it. So that fixed capital investments, of course, you need to deduct the sale proceeds of long-term assets for you to be able to get the fixed capital investments. And from the question, we have been given that item. When I get to the left over here, you can see that we are provided with that note under note number 4. Capital expenditures are expected to be 450,000, 600,000, 750, 900, 1 million in the next 5 years respectively. Our next item is the working capital investments. So we navigate back to the right. Working capital investments. This represents the change in working capital from 1 year to the next. So the change in working capital has also been provided in the question under note number 5 right here. The changes in net working capital are expected to amount to 150,000, 200,000, 250,000, 300,000 and 350,000 in the next 5 years respectively. So once we identify the inputs towards computing the free cash flow to firm, then we can be able to answer the question very well. So the starting point will be to try and determine the net income. The net income we will start with the sales over here. Sales. What is the value of sales? We can navigate back to the right over here, to the left, pardon me. The projected revenue for the target company for the next 5 years is 5,000,006, 7, 8, and 9. There. So we navigate back here. 5. And remember what we said, we just drag that. If it's a sequence, then there's no problem. What did we say? We wait for these autofill options right over here, and we click here, and we can be able to click fill series. So it's not giving us the correct value over here, but if we do this, delete here, we put 6 million here, that, and then we now drag from the both of them over here like this, and you wait for that plus sign. Remember, ladies and gentlemen, wait for the plus sign like that. Then you'll be able to see now it auto-populates. Because we are financial analysts, right here, we just click this comma sign over here. 2 decimal places is too much for us, and so we reduce them using this decimal or this number format right over here. So we don't want to increase, we want to decrease it to now at least 5 million there. 5,000,006, 7, 8, and 9 without decimal places. So the next item that we need to proceed on is to try and determine the cost of sales. From the question, I have gone through the question together with you, and we haven't seen anything or any item that talks about cost of sales. We only have selling general administration expenses under note number 2, and note number 3 talks about depreciation, note number 4 capital expenditures, number 5 talks about working capital expenditures. We don't really have any information about cost of sales. So what do we do with that? We ignore that component of sales, and we can be able to put it like so. So because financial analysts, in modeling, the first thing that we need to note is that we need to ensure that these colors for input values should always be blue. So we come over here and we can click a color right over here, so that now we can be able to ensure that those colors represent input values. Then less cost of sales, cost of sales, like that. Because it doesn't fit, no problem. We just double click when it's like that. We just double click, it will fit. Over here we put dashes over here, 0. That. So if you put zeros like that, shift, we move towards the right, and then control R, it comes. So we can be able to put now the comma format over here. Remember this over here, Alt, then we can be able to say that we want to H. Remember we are on home over here, so we home, then we come over here, so H, and then we want K. This K, you can see K represents the comma over there, so you click K like that, and it becomes dashes there. Remember, the color has to be indicative of inputs. Moving on, the spelling here is not correct. You can see cost of sales. So we proceed on with the next item. Sales less cost of sales, we get our gross profit over here. So gross profit, that. And we want to be specific to show that this is it's a sum, or you're trying to get a computation. This is an answer that you're getting over here. So what do? We can be able to put a top and bottom border over there like that. So it may not really be thick enough. So what do? We try and see if we can be able to put a thick bottom border over here like that. And over here I can decide to also put a thick bottom border like that, so that you can be able to pick and show that that is a solution. So you can see here. So it will be just plus that one, then we deduct that one there, we enter. It has to be black. So we are saying that we want to ensure that our decimal points are going to be the same. So that's what we do. And then shift so that it can autofill. Control R. This should be in bold. Why? Because it's an answer you're getting. And so From there, we get the gross profits. Now we deduct expenses. So we can deduct expenses. We navigate back to our left over here. So this, with your permission, ladies and gentlemen, I can highlight this with a very soft color right over there to show that we've done that. Expenses. Talk about selling, general, administration, and other expenses is expected to be 45% of sales. So we say, in short, allow me put S, G, and A expenses. S, G, and A expenses. So you can come over here, put S, G, and A expenses. And we can see, we navigate back to our left over here, you can see it's what percent. Note number 2, selling, general, administration, and other expenses is expected to be 45% of sales. So we navigate back, 45%. So we put 45% like that. Then, of course, we do something like that. And we just directly plus 0.45 that times sales. That. Enter. And you can see that we need then to move using the formula. You can just shift Control R. And you're saying that here we need to put blue sign here. That. Then we toggle back, or we go back and highlight this because it's already been done. Can highlight there. And we say that that is the pro forma EBITDA because there's nothing, no other expense that is over there. Other expenses has been factored in there. So we can say that that is the pro forma EBITDA. Pro forma EBITDA. EBITDA. What is EBITDA? Earnings before interest, taxes, depreciation, and amortization. And we say that once we get the 5 million, we deduct this over here because these are expenses. Allow me then to put a negative sign so that we can be able to indicate that that is being deducted. That. So that is a negative sign. So shift, it changes the sign. Control R changes the sign. So pro forma EBITDA, our pro forma EBITDA over here is going to be plus that, and then we add. We are adding because this is a subtraction sign or a deduction sign. That, go there. We get that. And then Control R. Because it's a pro forma EBITDA and it's a solution, it's an answer, so we bolden this. Control B comes immediately. After that, we are informed that there is another component here we need to deduct. Note number 3, depreciation is expected to be 5% of sales. Fine, that's what you have been informed. We just put depreciation here. Depreciation. And we can be able to indicate that it's 5% so that anyone who is looking at the model can be able to relate. 5%. And you're saying that it's just 5% of sales. That's what the question says. So we just put plus minus, just so that we can be able to get a negative sign like that. 0.05 multiplied by the sales gives us 250, like that. Control R. And we put blue color, like that. So what are we going to get after deducting depreciation? There's nothing to do with the interest. That's why we went directly to depreciation. Earnings before interest, taxes, depreciation, and amortization. So we deduct the depreciation. And once we deduct depreciation over here, we can be able to get the pro forma EBITDA on taxes. Pro forma EBITDA on taxes, so that we can be able to deduct now the taxes thereon. That. And we just add them going down. Plus that, plus that. Get 2.5. Shift, move to the right, Control R. Remember one thing, guys. I want the format here to be the same as the one here. So we just put it like that. Format painter, put it over there like that, so it can be able to bolden. Once we have the pro forma EBITDA on taxes, we then deduct the taxes. So taxes. And what is the tax rate? We can just navigate back to the question right over here. But before we navigate, before we move down and see taxes, we can highlight this and say that this one is done. So here we have capital expenditures, note number 4. Note number 5, changes in working capital. The startup, note number 6, startup cost, cost of debt, 10%. Capital structure of the company, note number 7, 30%, 70 equity. The company's outstanding debt of 5 million. The net borrowing over the 5-year period is expected to be 0, so that one is not it. Terminal growth rate, risk-free rate, expected market rate of return 15%, industry beta 1.5, startup has a tax rate of 30%. So this one, ladies and gentlemen, we are going to use it several times, and so I do not want to highlight it right away. So we go back over here and say taxes here, we can put it in brackets here, it's 30%. 30%, then we close the bracket. 30% plus 0.3 multiplied by that value, 750,000. So we then now complete the taxes part, Control R. That's what we get. The taxes are 30%. From the question, I can just check again if there is anything else we've left out. Projected revenues, selling general administration expenses, depreciation is expected to be 5% of sales. Note number 4, or information presented number 4, information given to us number 5, all these will be used up when we are computing the free cash flow to farm. So I can confidently say that we have used all items that give us the net income. So here, I can come back here and say that this is net income. Net income. And we're saying that the taxes right here should also be color blue. So the net income will be, we get the pro forma EBIT down taxes, we deduct the taxes which are at 30%. So plus that. And remember what we said, that this should be, because it's for consistency's sake, put it also negative. So you can put negative like that. Then you can just ensure consistency like so. Plus that, then we add the taxes. We're adding because essentially you are deducting right over here. So 1.75. So then Shift Control R. So what we do, we want to ensure consistency, so we bold that, do Control B, and then we want to ensure that it shows that it's actually an answer that you're getting. So we come over here, we can just thick bottom border over there, and even this other one over here, you can also put a thick bottom border so that it can, yes, like that. So the pro forma EBIT down taxes, we also need it to appear like so, thick bottom border, and we want to ensure that it's also going to be the same as the net income. So you can come format painter and do the same right over here, that, and also the gross profit like that. So we have these titles over here: gross profit, pro forma EBITDA on taxes, and net income. Once we've reached there, we go now on to formula for FCFF, our formula here. Highlight it in red. Our net income, we add non-cash charges. We said non-cash charges represent depreciation and amortization. And then we didn't have any information about interest, so we ignore it. And then we deduct the fixed capital investments, which represents the capital expenditures, and then we deduct the working capital investments here. So I can come just down over here after the extract of the income statement and say FCFF computation. FCFF computation. That bold, Control B. And we'll start from the net income over here. So net income. That. And we just pick the values right over here. Plus this one. Enter. And then we just shift, move towards the right, Control R. We put this in bold because this is our starting point for FCFF. There. What is the next item? Our next item is non-cash charges, depreciation and amortization. We add that. So depreciation, non-cash charges, this is the depreciation over here, non-cash charges, that, put a hyphen on that, non-cash charges. Here we just add our depreciation here, what we got here. And we are saying that we will now get a positive value. We need to add back a positive value. So plus, minus that value. So that it can be positive because we are adding non-cash charges, not adding the negative component. So we just fill that out towards the right. The next component for computing free cash flow to farm represents interest 1 minus tax. So we don't have any interest component in the question provided. So we move on to the next item, the fixed capital investments. And we are saying that the fixed capital investments will be the capital expenditures. So come down over here, fixed capital investments, fixed capital investments. So we don't want it to be bold, we want it to be like that. And then we move to our left here, we see what information we have towards fixed capital investments. We have capital expenditures are expected to be 450,000, 600, 750, 900 and 1 million in the next 5 years respectively. So we have 450, 600, 750 and the rest. So we have 450,000 right here. We have it like that. Then we have 600,000. 600,000, just confirm. Yes, 450, 600, 750 and 900. 600,000. Then we said 750 and 900. Then 900. There. So just finally to confirm, just very quickly, 900 and 1 million in the next 5 years. So I can highlight that. Next 5 years. So it's 1 million is the next value. To ensure that we have the same formats, just use that. Then we do it like that. Once we have fixed capital investments, we need to have working capital investments. So working capital investments. So our working capital investments, let's check what we have from note number 5. The changes in net working capital are expected to amount to 150, 200, 250, 300 and 350,000 there. So we're increasing multiples of 50,000. Starting from 150,000. So we have 150,000, then 200,000, at 50,000, 250, 300,000, then we are filling out 350,000. Like that. In terms of the formats, we want them to be the same. So once we have that, we can then confidently come down here and say that you're going to compute the FCFF. So free cash flow to farm, FCFF. FCFF. These values are going to be bold. That. So in financial modeling, we say that these have to be blue color. So we use blue right there. And the FCFF from the formula, just need to recap the formula again, just get the net income plus non-cash charges. So we are adding the net income and the non-cash charges and the interest 1 minus tax. Then we deduct fixed capital investments and deduct also working capital investments. So that's what we're exactly going to do. We start by the net income, we add non-cash charges, then we are supposed to add the after-tax interest expense, which has not been provided, and then we deduct fixed capital investments. So we're going to deduct directly fixed capital investments, and we deduct working capital investments there. So how much do we have? 1.4 million there. Shift, fill it out, and we have our free cash flow to farm for the next 5 years. For presentation, we need to ensure that this should be put in, we need to put grid lines, or rather borders. So we just put it in borders. Here we come to all borders, like so. And then we can then, of course, now put over here a thick outside border like that for presentation purposes there. That. So once we have it like that, we do the same onto the free cash flow computation. So we just put it to like so, border, but before that we put all borders, and then we put now the thick border right there. That. So this means that the FCFFs are increasing as you move from years 1 through to 5. So it's important for us to put the years over here again, 1, 2, and so on and so forth, so that we can be able to relate now the information with the number of years. Then we put field series. So then, calculating the value of the farm would require us to compute the capital, the required rate of return. Why do we need the capital rate of return? The required rate of return, pardon me. We need the required rate of return because we are going to use the weighted average cost of capital to compute the terminal value component. And weighted average cost of capital requires us to have the weight of equity times cost of equity. Now the cost of equity is where we're going to derive it from capital asset pricing model, which you're saying is CAPM. So we can have a working here, CAPM. Which we're saying capital asset pricing model, which is the required rate of return, is given as the risk-free rate, RF, you can put it like that, and then the risk-free rate plus we get the return on the market, and then subtract risk-free rate, that, and multiply that with a beta. So multiply that with a beta. Now, how do we write beta? We just come to insert right here. Go to symbol. You can see symbol right here towards the right. You can see beta is already there. You just click that one there. You say insert times the beta. Close. So all of these inputs towards computing CAPM or the required rate of return will be computed right here. So we start by identifying the risk-free rate. Moving to our right here, our risk-free rate over here is 7%, note number 10. I can highlight that over here. So it's there. So 7% plus 0.07, then plus, because we are adding this, what is called the equity risk premium, return on the market minus risk-free rate, plus, so we open the brackets, RM minus RF. So our RF is 0.07. Then we add now our RM, rather we need to put it the other way around, RM minus RF. So our return on the market is how much? Expected market rate of return is 15%. So 15% is what you're going to slot over here. 0.15 minus 0.07. Why? Because saying RM minus RF, our RF is already 7%. We close the bracket and that component is being multiplied by, you can see the multiplication sign over here, the beta. And the beta is how much? Let's go back to the question. The industry beta 1.5. So we go back and multiply by 1.5 there. We have 0.19. To put it into percentage terms, we can go back to home, put it like that, 19%. That is our capital asset pricing model or our required rate of return. When calculating the value of the firm, we need to discount the free cash flow to firms, these values here, by the weighted average cost of capital or WACC, not by the required rate of return. Please note that when getting the value of the firm, we discount the free cash flow to firms against the weighted average cost of capital and not the required rate of return as presented here. So then where are we going to use this? We are going to use it in our next step right here. The weighted average cost of capital. Weighted average cost of capital, the WACC, which is given as weight of equity times cost of equity plus weight of debt times cost of debt, then we subtract 1 minus tax. Close the bracket there. So here there is also a multiplication sign. So you can just put it for clarity's sake, clarity purposes. Times cost of debt times 1 minus tax. That's how we compute the weighted average cost of capital. A little adjustment right here. There. So we put pen to paper plus what is the weight of equity. We can toggle back to our question. Weight of equity. Note number 7. You can see it there. The company is 30% debt, 70% equity. So you can say plus 0.7, which you're saying is 70%, that's the weight of equity, times cost of equity. Where is the cost of equity? We have just computed the cost of equity, which is the same as the required rate of return, times that. Then we put it in brackets like that, like so, and add the weight of debt. If the weight of equity is 70%, then 1 minus 0.7 will give us the weight of debt. 0.3, you need to put brackets so that the formula can work. Times cost of debt. The cost of debt has been given to us in the question. Let's confirm. So that's the tax rate, the industry beta, market rate of return, risk-free rate, terminal growth rate. The company has outstanding debt of 5 million. Net borrowing over the 5 years is expected to be 0. It's okay. The capital structure is 30% debt, 70% equity. The startup has a cost of debt of 10%. Note number 6. 10%. So we go back. Times 0.1, like that, times 1 minus tax. So the tax rate, you can see it over here, note number 13, 30%. So with your permission, I can put 0.7. 1 minus 0.3 give us 0.7. We get 0.154. To convert it into percentage, there, 15%. As I had mentioned earlier, that the free cash flow to firms should be discounted against the work and not the required rate of return. So you've seen where we have used this capital asset pricing model, required rate of return value. We have used it, if you come to the formula section here, this part over here, you can see E24. So we are in E24. You can see it here. It's right here. It only assists us to compute weighted average cost of capital. So then, can we be able to proceed on with the terminal value computation? Yes, we can. So we come over here, terminal value, which we're saying is going to be given as the FCFF, free cash flow to firm, for period, the last period over here. So you can put 5 there, that, and then we try FCFF period 5, like so. So then we reduce it. You can actually reduce it over there. So if it doesn't reduce, we can come on to this part over here where we come to insert symbol there as an option, and then we identify where 5 can actually be from down over here. So we don't need to reduce it right now. We understand that it is just the terminal value for the last period. So we can just put 5 there. And then we discount that, come to home, and then we divide that or discount it against work minus G. Put small g. What is this G? It is the growth rate. So this can be margin center, put it at the center there, and on the top there like that, is equals to that. Terminal value is free cash flow to firm for period 5 divided against work minus G. So you put it at the center there like that. So let's calculate the terminal value. TV is, so we pick the FCFF for period 5, which is down over here. You can see it. This is period 5. Pick that. So plus that value. And then we divide that against WACC minus G. So that minus. Do we have a terminal growth rate value? Let's go back to the question. So we can see note number 9. The terminal growth rate is 5%. So we subtract 5%, 0.05, and then we close the bracket. How much is the terminal value? That is the terminal value. So we can put it, and we can bolden that, put it like so, put that value there, double click there, 21 million. What are we saying about this terminal value? We are saying that we expect the free cash flow to firm to continue growing like this, period 5, continuously into the foreseeable future. But we discount it back to the beginning of period 5 using this terminal value computation. And you can see we've discounted it using WACC minus G. This WACC minus G represents a capitalization rate that discounts the free cash flow to firm from period, whichever period, if it's period 20, period 30, like that, back to the beginning of period 5. And so we are saying that the terminal value is 21 million. So then we need to discount these free cash flows from period 1 back to period 0, this one back to period 0, and period 3 back to period 0, so on and so forth, like that, including the terminal value. So how do we do that? We are saying the present values include this one discounted against 1 plus WACC power 1. So plus that one divided by, open the brackets, 1 plus WACC, that value, that power 1. So we need to format so that it can be consistent with other values within the Excel worksheet there. So we can drag this up to period 4. But we need to ensure that we are going to hold our work here to be constant. So in this case, we need to drag to ensure to lock this value of E26. F4. Just press it directly, it will just lock it. Enter. So if that one is locked, then we can redrag this back again to ensure that it's okay. So these present values, this is power 1. This one, because it's the second period, should be power 2. So let's insert power 2 over there. Shift power 2. That. This one should be power 3. Agreed, guys? Yes. This one should be power 4. That. So what should we do with period 5? This one here. So should we just go ahead and just drag this? So we shift it like that and then Control R, fill it out like that. So that now we can be able to say that we're picking this value over here discounted against 1 plus WACC power and power 4. Or you can even change it over here to power 5, like that. What have I just said? I have said that we need to get the terminal value here. And the terminal value computes or discounts the cash flows, or these free cash flows, from period 5 moving at a steady rate and moving ahead back to the beginning of period 5. So we cannot be able to discount this one because it has been covered right over here by getting the terminal value. So we need to change this. So we are going to discount this one, not the period 5, but this one, terminal value component, and we are going to discount it based on period 4 values. period 4. So I just drag it like that. So it's this one, which is E30. So it's E30 discounted against 1 plus work power 5, not power 5. Remember, I have said we are discounting to the beginning of period 5, but period 5 is not over yet. So we discount it correctly against power 4. Beginning of period 5 is the same as the end of period 4. If you have 31st December 2021 and 2nd of January 2021, like that, when you're opening, the closing values becomes the opening values in the next period. So that's the same analogy we're going to use here. And so we're going to discount it based on period 4 because period 5 has not been completed. We discounted it against the beginning of period 5. So because it's not complete, we use period 4. And that's why we're discounting against period 4. Enter. So total present values, we can get the total present value. Total present value, we just add them, plus sum, select that, so it's getting the sum of that value. Enter. So that represents the present value here. I can put it maybe perhaps in a different, we can even highlight it like that and put it in a different color, like so. So that present value represents the value of the farm. So this, instead of writing the total present value, we can be able to also change it and say, we don't need to change, we just say value, farm value. Farm value or farm value. There, bold. Total present value or farm value is that. To be able to get the value of equity, total value of equity, we get the farm value minus the value of debt or debt outstanding. That's how we get the total value of equity. Because we have the farm value given to us over here, we just need to get the farm value, deduct the debt outstanding, if any, so that we can be able to get the value of equity. Copy this, then you place it right down below. And we can say that the farm value, which is that value there, we subtract the debt outstanding. Let's navigate back to the question. We can see the debt outstanding under note number 8. The company has outstanding debt of 5 million. The net borrowing over the 5-year period is expected to be 0. So we go back to the solution. So we subtract 5 million. 5, that. So that is our answer there. So for consistency, just use that. We format painter, come there, and we ensure that this one is also bold. That. You can also make sure that this one stands out as well. This one also stands out. That. Like that. This one also. That. So just recapping what we've done, you can go back to the question. We first of all went ahead to create a pro forma income statement, which we've done right here. Sales, less cost of sales, and so forth, so that we can be able to get the net income, or the net incomes rather. With the net incomes, we can then use the formula which is presented right above over here, the net income plus non-cash charges plus interest, 1 minus tax, minus fixed capital investments, minus working capital investments, so that we can be able to compute the free cash flow to firms, which we've done right here. And in so doing, I can confidently come and say here, as the way we've been highlighting here, that we have used the changes in working capital, there, I highlight that. The startup cost of debt, we have used that when computing the weighted average cost of capital, right there. The capital structure of the company, 30% debt and 70% equity when computing the weighted average cost of capital, which is right down here. Right down here. So we pick the weights right here. Then the cost of equity, which we said was computed using the capital asset pricing model, required rate of return. And then the weight of debt, which we've also used, as well as the cost of debt. Cost of debt was actually used right there. So you can see I've highlighted that appropriately. The capital structure, 30 debt, 70 equity. You can see we've highlighted that, we've used that. The company has an outstanding debt of 5 million. And the net borrowing over the 5-year period is expected to be 0. We have used that when computing the value of equity right here. So you get the firm value minus debt outstanding, so that you can be able to get value of equity. So we have used that. You can highlight it as well. The terminal growth rate, we have used the 5% terminal growth rate at this point right here, where we used the free cash flow to firm for period 5 discounted against weighted average cost of capital, or WACC minus G. This G represents the terminal growth rate. And you can be able to see I have used the 5% here under the formula bar right here. So that has been used, 5%. The risk-free rate, expected market rate of return, industry beta, and startup as a tax rate of this have all been used when computing the required rate of return. The terminal growth rate is the only one that remains, which we've used as well, and we can say that we have used the entire information that has been provided to us by the examiner. And so, as we conclude, we can say that the value of the firm is 16,912,676 and the total value of equity is 11,912,676. Thank you for being with Manifested Publishers. God bless you.
The question reads, Pendo Limited makes 3 types of metallic doors, security, house, and office, which are made from the same basic materials, steel bars and iron sheets. The standard unit cost and selling prices of the 3 types of doors are as below. So we have security, we have house, and then we have office. So we've been given information on direct materials, direct labor, and then unit selling price. Additional information, note 1, the sales for the month of December 2018 are as follows. The door type and then units. For security is 200 units, house is 200 units, and office is 160 units. Note 2, owing to an industrial dispute, suppliers of the iron sheets have estimated that only 5,124 square meters of iron sheets are available for the period. The iron sheets cost 1,000 shillings per square meter. Required, advise the management of Pendo Limited on the production mix of the 3 types of doors. Question B is about making decisions to do with the limiting factors. And the limiting factor is any factor that limits the firm from realizing its main objective. In this case, the main objective of the firm is to make 3 types of doors, that's security, house, and office. So we are told that these types of doors uses 2 raw materials, that is steel doors, steel bars, and iron sheets. So we have a limitation on iron sheets which may not fully be available in the production of all the 3 doors. So we need to analyze and give advice to the farm at what quantities the farm should produce. So to give advice to the farm, we are beginning with knowing whether we have enough iron that can be used in the production of all the 3 products. And if we have any shortfall, then it means that what is required is less than what is available. Once we have determined that, then we move on to determining which product is, in this case, which door will be more profitable to produce than the other. So in such circumstances, the farm should identify those doors that are more profitable and then give more weight on those that are more profitable and less weight to those that are less profitable. And therefore, our first step is simply to calculate what we refer to as the shortfall. Calculation of the shortfall. Shortfall. So what's shortfall? Shortfall is simply showing whether we have a shortage or not. If there is no shortage, then there is no decision that we will make. But if there is a shortage, then there must be a decision that the farm needs to make, because it will not have enough to help it produce what it wants to produce. So shortfall is simply the difference between in this case, the iron that is required and that iron that is available. If iron required is more than that which is available, it means there will be a shortage, and therefore the farm will not be able to produce all that it requires to produce. We have door type. And then we have security. The first door type is security. The second is house. The third one is office. And then we need to show the total. So in note number 1, under additional information, we are told that the sales for the month of December 2018 are as follows. So this farm expects to make the sales as we've been given, which is the same as what the maximum demand. So we have sales representing the maximum demand for security is 200 units. So these are sales in units. For house is 200. For office is 160. So for sales, I'll have workings down here. Workings. So we want to know, we have been told in note number 2 that owing to an industrial dispute, suppliers of iron sheets have estimated that only 5,124 square meters of iron sheets are available for the period. In our first part, we have iron sheets that have been given, and it's given in shillings. We've been told that the iron sheets cost 1,000 shillings per square meter. So we want to know what is the quantity of iron sheets that is required in the production of 1 unit. That is in one production of 1 unit of this product, or in this case doors. So we say that if we need 1,000 shillings, Iron sheets cost 1,000 shillings per meter. If 1,000 shillings are required in the purchase of 1 meter of these iron sheets, and when you look at security under direct materials, iron sheets costed 10,920. So what about 10,920? How many meters were used in the production of 1 unit of this security door? So to calculate that, we are simply taking 10,920 times 1 meter and we divide that by 1,000. It will give us the number of meters that are required to produce 1 door of, in that case, security. So 10,920 divided by 1,000, this gives us 10.9 meters. 10.92 meters, meaning to produce 1 security door, we require 10.92 meters. This is security. Then we do the same for house. How many meters will be required to produce 1 door of house? We are told to buy 1 meter, you require 1,000 shillings. What about 11,760? How much will be required? So we are simply taking 11,760 times 1, we divide by 1,000, which will give us 11.76 meters. That is for house. And then lastly we do for office. For office. So for office, if it takes 1,000 to get 1 meter, then what about 10,500? This is the same as 10,500 times 1 divided by 1,000, which will give us 10.5 meters. So we bring it here. Meters required per unit. Meters required per unit for security is 10.2, so 0.92, we multiply that. For house is 11.76, multiply that. Then for office is 10.5, we multiply. So we simply multiply and then we'll be able to get the total. So why are we multiplying? Meters required per unit. To produce 1 unit, you require 10.92. What about producing 200 units? So it is simply multiplying. That is 10.92 multiplied by 200. This will give us 2,184. These are meters. So this is meters total, meters required. Total meters required. So that will be 21,684. Then 200 times 11.76. This will be equal to 2,352. And then lastly we have 160 multiplied by 10.5, which is 1,680. So the total, we now take the total of this plus that, plus 2184, which will give us 6,216. So it means that if this farm is to produce all the 3 types of doors, then it requires 6,216 meters. It will require 6,216 meters. But we have what is available. So we want to compare with what's available and what is required. So we have meters available. So meters available according to the question is 5,124. When we subtract this, we are getting what we refer to as a shortfall, which is now the difference minus, this is 62.16 minus 51.24, 10.92. So the shortfall is 1,092. Shortfall meaning there is a shortage of 1,092 meters. So we can now prove that iron sheets is a limiting factor. Iron sheets is a limiting factor. So that's the shortfall. After determining the shortfall, we are now moving on to calculate the contribution per limiting factor. We calculate contribution per limiting factor. This is part B, contribution per limiting factor. Contribution per limiting factor. So to calculate contribution per limiting factor, this equals contribution per limiting factor equals contribution per unit. We divide this by limiting factor per unit. So to calculate contribution is just selling price per unit minus variable cost per unit. So we'll have it in this format. We have door type. We have security door, we have house, we have office, so door type, security, and then office. Security, house, then office. So we begin with the selling price per unit. We were given the selling price per unit for security. Is 24,500. For house is 26,040, and then office is 26,600. We less variable costs. I'll do this under our workings, variable costs. variable costs I'll do for security, for house, and for office. So the variable costs given, we have direct materials, steel bars and iron sheets. And then we also have labor, machining, and spraying. So we simply get the total. So for security, we are simply taking 3,500 plus 10,920 plus 2,100 plus 980. This will give us total variable costs. Total variable cost for security, 3,500 plus 10,920 plus 2,100 plus 980, which is equal to 17,500. Then for house, we have 1960 plus 11 plus 11,760 plus 1,400 plus 560. This equals plus 560. This will be equal to 15,680. And then for office, we have 4,200 plus 10,500 plus 2,660 plus 840. Which will equal to 4,200 plus 10,500 plus 2,660 plus 840. That is 18,200. 18,200 shillings. So those are our variable costs. We bring these figures here. So we have 17,500. 15,680, then 18,200. Subtract that to get contribution per unit. Per unit. So contribution per unit for security is equal to 7,000. For house is equal to 10,360, and for office is equal to 8,400. We calculate contribution per limiting factor, contribution per limiting factor. Contribution per limiting factor. So we say that contribution per limiting factor is contribution per unit. So our contribution per unit, so these are in shillings. Contribution per unit is 7,000 for security. So we'll have 7,000 divided by the limiting factor per unit, that is for security. From our first table, the limiting factor was the number of meters and for security was 10.92. So we divide this by 10.92 meters. These are shillings. Then for house, the contribution per unit is 10,360 shillings. We divide this by the limiting factor for house, which is 11.76 meters. 11.76 meters. Then for office, we have 8,400 shillings. We divide by the limiting factor, which is 10.5 meters. So this will give us contribution per limiting factor. For security, we'll have 641 shillings. For house, we'll have 881 shillings. Then for office, we'll have 800 shillings. Once we have the limiting factor per unit, we now rank the products. So we'll do the ranking. In ranking, we are simply ranking the product either as number 1, number 2, or number 3. So the one that has the highest contribution per limiting factor will be number 1, and the one that has the lowest will be number 2, and so on. So according to what we have, house has the highest contribution per limiting factor, and this will be our number 1. Can remove these workings. This will be our number 1, followed by office, which will be 2, and then security will be number 3. So what does it mean? It simply means that since the farm is limited by the number of meters that it needs to use to produce these doors, then it has to consider producing house because it is more profitable. If we have any number of meters remaining, then we should use it to produce office, which is our number 2. And if we have any other remaining, then we can produce security. That's what it means. So let's now calculate the production mix. Production mix for the farm. We determine the production mix of the farm. So we need to show the ranking. We show the door type. We'll show the meters required. And then units to be produced. So the ranking is 1, 2, and 3. So the first door type is house. According to the ranking, then number 2 is office, and number 3 is security. Then meters required, we did this in step number 1. The meters required to produce house is 2,352. 2,352 meters. Those are the meters required to produce a house. Then office is 1,680. 1,680. Our maximum must equal 5,000. The available was 5,124, meaning we cannot go beyond that. So we have 5,124. So that means we can produce all the units of house door type, and the units that were to be produced according to the question in note number 1 is the sales for the month of December 2018 are as follows. So we need to produce 200 units of house. So since we only need 2,352 meters, we'll be able to produce all the units of house, which are 200 units. We can also produce all units of office. Why? Because we only need 1,680 and the units for office were 160. So we need to know how many meters are remaining from the 5,124. So we already have used 2,352 plus 1,680. From 5,124, we still have 1,092 meters, which we can use to produce security door type. So security required 2,184 meters, but we only have 1,092, meaning we cannot produce all units of security door type, and therefore we need to determine how many units we need to produce. So according to the question in still part number 1, for us to produce 1 unit of security, we require 10.9 meters. These are workings for security door type. So 10.92 meters are required to produce 1 unit of the product. But what we have is only 1,092 meters available. Then how much units can we use these meters to produce? So we are simply taking 1,092, we multiply by 1, we divide by 10.92 to know the number of units that we'll produce because of the limited meters. And this will give us 100 units. So meaning we can only produce half of the units, and therefore we are only producing 100 units of this product. And this is how we were to answer this question number 2. So question number 2 was in 2 parts. To give a summary, the first part required you to make a decision to do with make a decision on economic order quantities, which is the optimal economic order quantity that you should advise the firm to purchase its products at. And in part 2, we are making decisions to do with the limiting factors. So you can read more on, in part number 1, read more on a single price model, where in case you are only given 1 discount, then how do you advise the management where only 1 discount is given? And then for part 2, we have other decisions like make or buy decisions. We have acceptance or rejection of orders. Then we also have decisions where you are either I've talked about make or buy decisions, acceptance or rejection of orders, and dropping a product. So you can read more on those other decisions that are likely to be set in the upcoming exams. And that is the end of our question number 2, which marks the end of our session. So bye-bye. I welcome you to our next session, which will be handling question number 3.
Welcome to Manifested Publishers. We offer KASNEB study materials and video lectures.
Hello candidates, welcome to today's revision session. We continue to revise the paper that was tested in May 2019. So far we have done question 1, question 2. Today we move to answer question 3, and as always, please make sure you answer this question before coming to this session. Don't attend this session before you do question 3, which we want to solve here on the board. The question is in 4 parts, A, B, C, D. Part A says, describe 4 forms of dividend payments that a company could utilize to pay its shareholders. Forms of dividend payments. This is May 2019 question 3. A. Forms of dividend payments. Forms of dividend payment. By now, I know you are aware that the reason why investors put their money in a company in form of shares is because of the return expected on such investment. This return is known as dividend. When you invest in a company, then at some point the company will reward you for the investment. That reward is known as dividend. And this dividend can be paid in different forms. The question is requiring the candidates to identify 4 forms of dividend payment. The first common form is cash dividend. Cash dividend. A company may pay dividend in cash, and that is dependent on the availability of cash. If the company has cash, then at its disposal, then that cash can be paid in to pay the shareholders. And many companies pay dividends in form of cash, and sufficient cash is available only when a company prepares a cash budget to estimate the required amount for the period for which the budget is prepared. So the company will only pay the dividend in cash if the cash is sufficient and the cash is also available. And that cash can only be available where a company has estimated in advance through a cash budget. So where cash dividends are expected to be paid is important for the company to operate within the budget. A budget has to be prepared earlier, estimating the amount of dividend that is expected to be paid to the shareholders in form of a dividend at the end of the year. The next form of dividend can be what we call scrip dividend. Scrip dividend. Now, this is where equity shareholders are issued with the transferable promissory notes for a shorter maturity period. And promissory notes are given where the company is facing liquidity challenges. Promissory notes are issued to the equity shareholders in form of dividends where the company has shortage of cash. This happens when the company has shortage cash, liquidity problems. In the first case, there is availability of cash. The shareholders are paid cash. In the second case, the shareholders are issued with transferable notes and with the shorter maturity period, and this only happens when the company is experiencing liquidity problems. Then number 3 is the stock dividend. Stock dividend. This is a payment. This is payment of additional stocks, additional let me say shares of common stock, additional shares of common stock to ordinary shareholders. Instead of paying dividends in cash or paying dividends in form of scrips, the company can decide to give the existing shareholders additional shares, okay, additional shares of common stock. Then number 4 is property dividend. As the name suggests, property dividend is where now the company, instead of paying cash or shares, the company can decide to pay in form of assets, especially where such assets are no longer required within the business. The assets are no longer needed in the operations of the business, and at the same time the shareholders have no problem being paid in form of stock. So this is just payment in form of assets. I can say this takes place in form of assets. This takes place in form of assets. The payment of dividends takes place in form of assets. It happens where the firm has assets which are no longer needed in the firm, and the shareholders and let me say, and the shareholders are willing to be paid dividends in form of assets, because there are some shareholders who would just want money, okay, cash. So candidates, these are some of the forms that dividends may be paid: cash, scrip, stock, property. So if you are a shareholder, you can either be paid cash, given a check or cash money, money transferred to your account. Doesn't matter how it is done. It can be check, it can be cash. The money can be transferred to your account. Scrip dividend is where now you are given a promissory note which has a short term maturity period. Then that we've said happens only when the company is experiencing liquidity problems. There is no money at the moment, so you are given a promissory note, say 3 months or 2 months, which matures in 2-3 months, which you can be transferred into cash within 2 or 3 months. Then you may also be paid in form of shares, given additional shares, or you can be given assets. So these are some of the ways in which dividend may be paid. Or cash dividend, we say that many companies pay dividends. Many companies pay dividends in form of cash where there is sufficient cash set aside, on the basis of cash budget prepared earlier. That's what I said. So that's what we just write, because it says describe 4 forms of dividend. So these are the 4 forms. Then moving on to part B, Mazeras Limited is considering an investment of 20,000 shillings that will generate a perpetual after-tax annual cash of 2,000 shillings. Perpetual after-tax annual cash dividend, annual cash flow of 2,000 shillings. The required rate of return is 8%. Roman 1. The required Roman 1, the investment's profitability index, 3 marks. Roman 2, advise the company on whether to undertake the investment based on profitability index in B1 above. So profitability index, how do you calculate profitability index? Profitability index is determined by, this is part B, Roman 1. Profitability index, the question is the investment's profitability index PI. Profitability index PI is an investment technique that is used in making investment decision, and this is determined by dividing the present value of cash inflows after tax, then we divide by initial investment. That is the formula. Profitability index is equal to the present value of cash inflows after tax divided by initial investment. The initial investment, we have it in the question, is 20,000 shillings. We need to calculate the present value of the cash inflows, cash flows. And we know the formula for the present value of cash inflows. In this question, the cash flows are generated in perpetuity. The formula for present value of cash flows that are generated in perpetuity is simply the cash flow divided by the rate. The cash flow divided by the rate. The cash flow here is 2,000. The formula, let me, for the purpose of revision, the formula is the present value of cash inflows in perpetuity is equal to the annuity divided by the rate. The annuity, we have it is 2,000 shillings. The rate, we have it in the question, is 8%. 8% converted into a decimal is equal to 0.08. So this will give us the present value of cash flow in perpetuity. You have 2,000 divided by 0.08 is equal to 25,000 shillings. So 25,000 shillings is the present value of cash inflows after tax. So we'll have 25,000 divided by the cash inflow from the question is 20,000. This will be equal to 25 divided by 20 is equal to 1.25. That is the PI. Then Roman 2, we are expected to advise. Roman 2, advise the company whether to undertake the investment based on the profitability index. So based on this profitability index, should the company invest in the project or not? Candidates, we know that the decision criteria, the criteria you use when making decisions under PI is that when the PI is greater than 1, then accept the project. If the NPV is less than 1, then that project should not be accepted. If the PI is equal to 1, then the investor is indifferent. He can either choose to invest or not choose to invest. So we can see here the PI is greater than 1. So the advice is, because the question is advise the company whether to undertake the investment project. So the answer is the company should undertake the investment project because the PI profitability index is greater than 1. It's greater than 1. That is the criteria you use. That is Roman number 2. Roman 2. Then C, explain 2 advantages of using private placement when issuing long-term debt. 4 marks. Advantages of using private placement when using long-term debt. When using long-term debt. Candidates, private placing can also be used when issuing equity. In this question is all about debt. Advantages, this is C, advantages of using private placing when issuing long-term debt. Long-term debt can be bonds, okay, debentures, and so on. So, and the question is specific to long-term debt. I've said the method can also be used when issuing equity or ordinary shares. So, before I give the advantages, I will define private placing. You are not required to define it, but I'll define it for the purposes of revision. Private placing is an offer made to limited, is an offer made to limited number of private or institutional investors who do not require the protection of a registered prospectus. So I would want you to go and read more on private placing, especially for equity, okay, for equity, and public placing. So what the difference? You go and read more on this, get to know the difference between private placing and public placing. But private placing is an offer made to limited number of private or institutional investors who do not require the protection of registered prospectus. In your reading, you will discover that for you to do public placing, then you need to have a prospectus that has to be registered. There is a process in doing so. So what are the advantages of using private placing? Number one, advantage number one, private placing does not require public disclosures. Does not require public disclosures or regulatory approvals For you to issue shares for you to make public placing, then you have to get approval from the Capital Markets Authority. You need to get approvals, follow procedure as laid down by the national. If it's a public, a listed company, then you have to also get approvals from the Nairobi Stock Exchange and all that. But for private placing, disclosures and regulatory approvals are not necessary. Then number two, borrowers can say borrowers retain absolute control. Borrowers retain absolute control of the placement and can retain or maintain a long-term relationship with the bond holders. If a company has issued bonds, remember we are talking about bonds, debt. The one who buys the bonds is a bond holder. The company that places the issue is a borrower. So there is a long-term relationship that can be maintained because the company will retain the absolute control of the placement. Then related to these two, we have another point that we can add. This is in relation to cost. This method of raising capital is not as costly as raising capital using the public offers. So the method private placing, you can say private placing is less expensive, and less expensive, you are comparing it to the public placing. So candidates were required to give 2 points. I've given 3. Now let's move on to part D. This is part, I did part C. Yes, this is part B, part C. We can now do part D. It says John Malech deposits the following amounts at the end of each year in a savings account, paying an annual interest rate of 4%, compounded semi-annually. Compounded at an annual interest rate of 4%, compounded semi-annually. So we have year 1, 4,000, year 2, 8,000, year 3, deposited 7,000, year 4, 10,000. You are required to do what? To calculate the value of the account, at the end of year 4. How many marks? 3 marks. The required again, the value of the account at the end of year 4. So this is a question testing the candidate's knowledge on compounding, which is the opposite of discounting. John Malech deposits amounts at the end of each year. So in year 1, Malech deposited 4,000. In year 2, Malech deposited 8,000. In year 3, deposit 7,000 at the end of year 3. Then 4,000 at the end of year 4. So how much did Malech have in his account at the end of year 4? And the question says that interest is compounded semi-annually. The annual interest rate is 4%. The annual interest rate is 4%, and this annual interest rate of 4% is compounded semi-annually. This is part D. Before I answer this question, candidate, when calculating future value of cash flows that are compounded more than once, we call it multi-period compounding. There is a general formula, which is future value is equal to the present value times 1 plus R over M raised to N, where FV is future value, PV is present value, R is equal to annual interest rate, let me say where R is equal to annual interest rate, and M, this M is equal to the number of times per year. Per year interest is compounded. The number of times interest is compounded. In this question, the number of times is 2, because it's semi-annually. Semi means 2, and N is equal to the number of years deposit is held. The number of years the deposit is held. This is the general formula. In another question, you may be told is compounded quarterly. It may also be compounded monthly. Interest can also be compounded weekly. You can compound it daily. Interest can also be compounded hourly. So this is the general formula. I'm just writing it so that you can revise. Make sure you have this formula in your head, because the examiner does not give formula in your exams. You have to extract it from your brain. Now let's come back to the question and see how we can apply this formula to this specific question. So what you need to have this formula in your head, because then you need to know how to apply it. In this case, we are told John Malechi deposits the following amounts at the end of each year. Candidates, I want you to underline the words at the end of each year, because the investor may also deposit this money at the start. The difference, it's different. Depositing money at the start and depositing money at the end of the year, the calculations are different. So you underline that. So that if having that, say that we can now apply this formula, we need to calculate the future value of these deposits after 4 years. The first deposit of 4,000 was made at the end of year 1, meaning this 4,000 was in the bank for only 3 years, because at the end of year 1, then this money was held in the bank for the whole of year 2, for the whole of year 3, for the whole of year 4. So those are 3 years. So let us compute the value of the first deposit for the 4 years, okay? For the 4 years at the end of year 4. We compute the value of the first deposit at the end of year 4. So first deposit. First, let me just call it first deposit. The formula, the future value will be equal to the present value, which is 4,000, into 1 plus R. R, we said, is the annual interest rate. The annual interest rate is 4% into decimal 0.04. We divide by M. M is the number of times per year interest is compounded. This interest is compounded twice. So we divide by 2, then we raise it to n. This should be n times m. N times m. It's supposed to be n times m. So we raise it to m times n. We've seen that n is the number of years deposit is held. Number of years deposit held. Number of years deposit held. The number of years is, we've seen the first deposit is held for 3 years at the end of year for the whole of year 2, year 3, and year 4. So 3 years times m. M is the number of times per year interest is compounded. The number of times per year. The number of times per year. We've seen it is semi-annually. So we multiply by 2. So this will give us the amount after 4 years on the first deposit. So I'll first calculate this factor. This will be 0.04 divided by 2. I raise it, going to raise it to 6, then I multiply by 4,000. multiply by 4,000. This is equal to shillings 4,505 raised to the nearest decimal. Then I do the second deposit. Second deposit. What is the future value? The second deposit, the amount was deposited at the end of year 2. The amount there is 8,000 at the end of year 2. Then at the end of year 2, this money was held in the bank for how many years? At the end of year 4, if the amount was deposited in the bank at the end of year 2, then that money was in the bank for only 2 years. That is year 3 and year 4, only 2 years. So we're going to have 1 plus 0.4 divided by, this is 0.04, we divide by 2, then we multiply by that is number of years deposit held. Number of years deposit is held is 2 years. Number of years, our n, 2 years in the second case, times 2. 2 is constant because 2 is m, number of times per year, which is semi-annual. Semi-annual. So I'll first get this factor, then multiply by 8,000. So this is a 0.04 divide by 2 plus 1. This is 1.02. This gives me 1.02. Then I multiply it. I raise this to 4. It's 1.08 times 8,000. 8,000. So the total amount after 4 years is 8,659 to the nearest decimal. Then the third deposit. Third deposit. The future value will be equal to how much was deposited. 7,000 was deposited times 1 plus 0.4 over 2 raised to the amount that was deposited at the end of year 3 only lasted in the bank for 1 year. That is year 4. At the end of year 3, the money lasted in the bank for the whole of year 4. So that is only 1 year. So we'll multiply this by 2. Remember 2 is the n, that is number of years deposit is held. Supposed to be 1. The one that was deposited at the end of year 3 lasted in the bank for only 1 year. Then we multiply by 2, which is constant here. 2 is the m. Okay, number of times per year interest is compounded. So I'll come here and determine the amount. 1 plus 0.4 over 2, we had seen that 1 is equal to 1.02. We raise it to 2. Then multiply by 7,000. This is equal to 7,283 shillings. Then there is this fourth deposit. There's this money that was deposited in the bank at the end of year 4. What is the future value? The future value will be equal to the amount, which is 10,000 into 1 plus 0.4. We divide by 2. this money was in the bank for how long? This money was deposited at the end of year 4, and we are doing the valuation at the end of year 4. So we'll have it at 0. The money was in the bank 0 years, okay, times 0 years times 2, okay, 0 years times 2, and using your primary school mathematics, you can see this number is raised to 0. This number 1.02, I don't need to calculate, but if I was to calculate, if you are to calculate 1.02 raised to 0 is equal to 1. Any number raised to 0 is equal to 1. So we'll have 1 times 10,000, which is still equal to 10,000 shillings. This is equal to 10,000 shillings. The money was deposited in the bank at the end of year 4. We are calculating the total value at the end of year 4. So this 10,000 did not earn any interest by the time we are doing this calculation. So these are the amounts, and the question is the value of the account. So the value of the account, value, how do you calculate value of the account? The value of the account will be equal to the 4,505. We add the amount that was in the bank for 2 years. We have it 86, 59. We add 72, 83, then we add the 10,000. So this will be the total money in this account. So I come here and take 4505 plus 8659 plus 7283 plus 10,000. The total money is 30,447. 30,447. And I can see here the total deposits. This is the answer. So I just wanted to check out of curiosity how much interest was paid. This is 4,000 minus 8,000 minus 7,000 minus 10,000. So I've deducted the deposit. So the total interest is 1,447. So that would earn the candidate how many marks? 3 marks. All this translates to 3 marks. 3 marks. These are 3 marks. So in this question, candidates, this formula is very important. Make sure you memorize this formula, because you may be asked to calculate the interest or the future value of an amount where the compounding is done quarterly or monthly or weekly. So 3 marks. Then coming to part C, there are supposed to be 2 points. We gave 3 points. These are 3 points. How many marks? These are 4 marks. Part B, the PI, that's the formula for PI, and this is the calculation and the answer, earning 3 marks. 3 marks. That is B1. Then advise the company. Advise the company should undertake the investment project because the profitability index is greater than 1. So that is a mark. Saying the company should undertake the project, 1 mark. Giving the reason, another mark. The total, 2 marks. These are 2 marks. That is B2. Coming to A, describe 4 forms of dividends payments that a company should utilize to pay shareholders, 8 marks. 8 points, 8 marks. 1, 2, 3, 4, total 8 marks. So we have 8 marks plus 5 marks, giving us 13 marks plus 4 marks, that will be 17 marks plus 3 marks, the total 20 marks. That's how to earn marks in an exam. So we have completed answering question number 3. I want you to go and answer question number 4. But before that, go through the question. Go through this question before attending the next class or doing the other question. Go through this question. Do what I've told you. Read on public placing. Compare the difference between public placing and private placing. What are the advantages of public placing? Read that topic. Then I've told you in D, memorize that formula. Then try to answer other questions from the past papers. I want you to go and answer more questions. This is a very important topic. The topic tested in D is a topic on time value of money. Candidates, what you are learning under time value of money in ATD, this is what you will still need all this knowledge in answering questions in financial management in section 3 of CPA. You also need the same understanding in answering questions in advanced financial management. That's why in this book, ATD, Fundamentals of Finance, we have provided 21 questions. Students who are appearing in the ATD Fundamentals of Finance, we advise them to do all these questions. Then they can mark. The answers are provided at the back of this book. So make sure the 21 questions are done before you appear in your final exam. So keep on revising. That is the only way you will be able to answer questions comfortably in the exam. Try to answer these questions and you will not regret. You will be in a position to answer any question in the exam. Thank you for attending our today's lesson. We have answered question number 3. In our next lesson, we'll answer question number 4. Bye-bye.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners.
Hello candidates, welcome to Manifested Publishers eLearning portal. Today is a new session. We've been doing question number 1 and 2. Today I'll introduce you to question number 3 of the same paper, that's May 2021, of Management Accounting. So my name is Celestine Wadabusi. I instruct you to have calculators so that we'll work together as we move on. Question number 3 comprises 2 parts. We have part A and part B, and part A reads, describe the 3 main stages of the activity-based costing. That is ABC system. What are the 3 main stages? Part A of question 3, 3 main stages. 3 main stages of activity-based system. So the 3 main stages include Roman 1, organization of the major activities. Organization of the major activities of an organization. Then stage 2, determination of cost drivers. Stage number 3, collection of costs into cost pools. And I can add you one more stage, absorption of service costs to production departments. So in ABC costing system, we assume that there are activities that cause cost to be incurred. So the first stage in activity-based costing is identify these major activities assumed to cause cost to be incurred. So once you have identified these major activities that are assumed to cause cost to be incurred, we collect them. Those that are of the same nature are put together into what we refer to as cost drivers. And therefore, our second step is determination of the cost drivers. Cost drivers is a group of activities that cause cost to be incurred. Once you have determined the cost drivers, the next thing is what are those costs that are incurred when these activities work. So we determine what we refer to as cost pools. A cost pool is simply a collection of costs that is associated to a specific cost driver. Like when we have activities of, we have a group of activities that is causing cost to be incurred, and then we identify the related cost to those activities into one group. We refer to that as a cost pool, which is our stage number 3. And once we've determined the cost drivers and cost pools, the last stage is to absorb the service cost. We transfer all the service cost into the production departments. And those are the 3 stages or the 4 stages of activity. So the question only required 3. I've added you one more. Part B reads, BICS Limited reapportions the costs incurred in 2 service cost centers, namely material handling and inspection, to the 3 production cost centers of machining, finishing, and assembly. The following are the overhead costs which have been allocated and apportioned to the first cost centers. So we have machining, finishing, assembly, material handling, and inspection. We've been given the amount which is in millions. Then estimates of the benefits received by each cost center are as follows. We have machining, finishing, assembly, material handling, and inspection. So we have the details for material handling and details on inspection for all other departments. They required calculate the charge for overhead to each of the 3 production cost centers, including the amounts reapportioned from the 2 service centers using Roman 1, the continuous allotment, in brackets repeated distribution method. So we want to begin with the Roman 1. This is part B, Roman 1. Part B of question 3, Roman 1, we are required to apportion overheads using continuous allotment or repeated distribution method. In continuous allotment method, we normally assume that we have service departments and we have production departments. So service departments are providing services to each other as well as to production department. So when we have such happening, it means that we have to do what we refer to as reciprocation of one service department with the other service department. And therefore, the process normally involves repeated apportionment until we ensure that we have zeros in the service department. And to do that, we'll use a table that will help us to do the apportionment. So we'll have space, then we have basis of apportionment. We'll have the department, machining. We have machining. We have finishing. We have assembly. We have material handling. And then we'll have inspection. So we'll have a table. So the values are in shillings. The values are in shillings. So we'll have these in shillings. So we have a table that is showing the basis of apportionment, machining, finishing, assembly. So in the question we were told that machining, finishing, and assembly are production departments. Material handling and inspection are service departments. When you look at the question paper under estimates of benefits received by each cost center are as follows. Material handling is providing 30% to machining, 30% of its services to machining, 25% of its services to finishing, 35% of its services to assembly, and it is providing 10% of its services to inspection department, which is a service department. Then we have inspection is providing 20% of its services to machining, 30% of its services to finishing, 45% to assembly, 5% to material handling, which is a service department. So we need to identify the allocated and apportioned overheads which are given in the question. We have a note, the following are overhead costs. So we have allocated and apportioned overhead costs. Allocated and apportioned overhead costs. For machining, this is in millions. In millions, shillings, in millions. Sorry, Shillings is in millions. Shillings in millions. It is in shillings in millions. Shillings are in millions. Also show that millions. And then this is also shillings in millions. In millions. So for machining, we have 400. That's 400 million. This is 200 million, 100 million, 100 million, and 50 million. That is the allocated and apportioned overheads. So we need to identify the basis for apportionment, but before we find the basis of apportionment, remember we have two service departments, material handling and inspection. So in continuous allotment method, it doesn't matter which service department you begin with. You can either begin with the material handling or inspection. So let's begin with by apportioning material handling. You simply write apportion material handling. Remember, apportioning is simply referring to division of a value to various departments that used that service. So material handling had 100 million. This is what it means. It simply means the 100 million incurred under material handling was incurred simply because material handling was providing services to machining, finishing, assembly, and inspection. And therefore, we are to transfer 100 million to these other departments that use the service in the ratio provided. I'll use this for our workings. This is our working space. Sorry, workings. Just have workings. And this is working number 1. Basis of apportionment for material handling. So material handling is providing 30%. We have the ratio of 30% to 25% to 35% to 10%. 30 to 25 to 35 to 10. So we are to identify the right ratio that we need to, which we'll use under the basis of apportionment. And for us to find the ratio, we are simply to use the lowest figure that is divisible in all these values. And the lowest figure is 5. So 5 will be divisible in this. So 5 will be into 30, 6 times, to 25, 5 times, to 35, 7 times, and to 10, 2 times. And that will be our basis of apportioning this amount. So we'll have 6 to 5 to 7 to 2. So when we take 6 plus 5 plus 7 plus 2, it will give us a total of 20. So we remember we are apportioning material handling with 100. So to calculate the amount for finishing department, this is working 2, finishing department. This is material handling ratio. Finishing department will be equal to 6 over 20 times 100. 6 over 20 divided, multiplied by 100. And this will give us 30. So we apportion that 30 to machining. We do the same to, sorry, this was machining, not finishing. This was machining. And then to finishing department, we'll simply take 5 over 20 times 100. 5 over 20 times 100 will give us 25. So we'll have 25, and you do the same for the others. Take 7, divide by 20 times 100. It will give us 35 to assembly. And then 2 over 20 multiplied by 100, which will give us 10 to inspection. So we have transferred the whole of this amount, and therefore we make it a negative, but we now add the value in the inspection column, and this will give us 60. Then we apportion. Next is to apportion inspection. We apportion inspection. And what is the ratio for inspection? This is working 3. Inspection ratio. Inspection ratio. So according to the question, we were told that inspection provides 20%. So we have 20 to 30 to 45 to 5. The lowest figure that can be divided in all these is 5. So 5 into 20 is 4, into 30, 6, into 45, 9, and into 5, 1. So we have the ratio of 4 to 6 to 9 to 1. And so to find for machining, remember the amount that we are apportioning is 60. We are taking 4 plus 6 plus 9 to get the total. 4 plus 6 plus 9 plus 1, which will give us 20. And to apportion for machining, we will take 4 divided by 20. We multiply by 60, which will give us 12. Can show that under working number 4, machining. We are simply taking 4 over 20 and we are multiplying by 60, which will give us 12 shillings. 12 shillings. We do the same for finishing. This will be 6 over 20 multiplied by 60, which will give us 18. Then for assembly will be 9 divided by 20 multiplied by 60, which will give us 27. And then to material handling is 1 divided by 20, and then we multiply by 60, which will give us 3. We make this a negative. Why? Because we have transferred the whole of that figure to other departments. So under material handling, we still have 3. Our intention is to ensure that we have zeros in the service department. And therefore, we say we repeat the process. So we repeat to apportion material handling. And what are we apportioning? We are apportioning in the ratio of 6 is to 5 is to 7 is to 2. And what we are apportioning is 3 to ensure that it becomes a 0. So we'll have 6 plus 5 plus 7 plus 2, which is giving us 20. We take 6 divided by 20 times 3. This will give us 0.1, which can be rounded off to 1. Then 5 divided by 20 times 3 will give us 0.75, which is equal to approximate to 1. Then 7 divided by 20 times 3 will give us 1.05, which is 1. And then 2 divided by 20 times 3 will give us a 0. So here we have a 0, and here we have transferred the whole of this. And that simply means our solution has been reached, and we simply get the sum. So when you get the total, our service departments have zeros, so this is a 0, and we are now supposed to get the total for the production department. We get the total for production department. So for machining, we have 400 plus 30 plus 12 plus 1, which will give us 443. Then we have 200 for finishing plus 25 plus 18 plus 1, which will give us 244. Then 100 plus 35 plus 27 plus 1 equals 163. And then we'll be done with part 1 of that question. Then part 2 of the question. Part 2 of the question, we are required to use algebraic method. Algebraic method is any method that can help in solving a pair of equations. So a pair of equations here is referring to a simultaneous equation. So in this case, we'll use simultaneous equations method or simultaneous equations method where we will have to solve using elimination method. So it is normally an alternative method to continuous allotment, and therefore it should yield the same results. And how do we do this? So let's do part 2. This is question number 3 part B, Roman 2. Roman 2. We are using the algebraic method. Algebraic method. This was continuous allotment method. Continuous allotment method, and this is algebraic. So we are required to formulate 2 equations. Why 2 equations? We have 2 service departments. So when we have 2 service departments, we are required to formulate 2 equations. And each equation should state the original or the allocated or apportioned overhead cost and the proportion of the other department that is apportioned or to be apportioned to it. So when you look at this paper, we have material handling, which is providing 10% of its services to another service department, which in this case is inspection. And inspection is providing 5% of its services to material handling, which is also another service department. So we are to formulate 2 equations as follows. Let material handling total cost be represented by X. So we are representing material handling by X, and then we let inspection total cost be represented by letter Y. So X is representing material handling and inspection is represented by Y. So we want to formulate the equation for material handling, which is represented by X. So we'll say material handling, or X, equals the original and the allocated amount that is to be apportioned or allocated to material handling. From this table, you can see that it is 100 million. So the equation is formulated into 2 parts. One, it must have the total, the original total or the allocated, plus the proportion of the other service department. Proportion of the other service department. When you look at that question, we have machining, finishing, assembly, material handling, and inspection. Material handling is being provided by inspection with 10%. Material handling is providing services, 30% of its services to machining, 25% of its services to finishing, 35% to assembly, and 10% to inspection. And then inspection is providing 20% of its services to machining, 30% to finishing, 45% to assembly, and material 5% to. So the other proportion, or the proportion of the other service department, so the other service department here is inspection, and inspection is providing 5% of its services to material handling. So we'll have the original amount plus the proportion of the other. So the other service department, inspection, which is plus 0.05y. And then we also formulate for inspection represented by y will be equal to the allocated amount to it is 50. In this case, not 60, it is 50. So we take 50 plus the proportion of the other service. So the other service department is material, and the material handling was providing 10% of its services too. So we take 0.1 x. 0.1x. Then we rearrange the equation into simultaneous format. So to rearrange this, we'll have x equals, we'll have x minus, we are taking this, the other side, 0.05y, which will equal to 100. And this will become our equation number 1. We do the same for the second equation. We are bringing 0.1 the other side, so we'll have negative 0.1x plus y equals 50. And this becomes our second equation, which we now solve using simultaneous equations, using elimination method. So to solve this, we want to eliminate values either at x or y. Eliminating values at x, we simply multiply negative 0.1 and the second line by 1. So I've cross multiply. Take negative 0.1, multiply by the first line, take 1, multiply by the second line, and then we'll be able to solve. So negative 0.1 times x is equal to negative 0.1x. A negative times a negative will be a positive. So we have 0.1 times 0.05. We'll have 0.005y equals 100 times negative 0.1 will be equal to negative 10. We multiply 1 by the other line, so this will remain to be negative 0.1x plus y equals 50. And then we subtract. So we take negative 0.1 minus minus. So negative 0.1 minus minus will become, is the same as negative 0.1 plus 0.1, which will give us a 0. And then we have 0.005 minus 1 which will give us negative 0.995y equals negative 10 minus 50 will give us negative 60. Then we find y. So y will be equal to 0, negative 0.995y. We divide both sides by negative 0.995, which will be equal to negative 60 over negative 0.995. Solving that, y will be equal to y will be equal to 60.3. Then we substitute to get the value of x. We can use the first line. So we have x minus 0.05y equals 100. We already have y, the value of y, so this will be x minus 0.05, it is 0.05, not 0.5, yes, 0.05 into bracket 60.3 equals 100. So this will be equal to x minus 3.015 0.05 times 60.3. 3.015 equals 100. So selecting the like times, x will be equal to 100 plus 3.015. So x is just equal to 103. We round it off to a whole number, 103. So first step, we have formulated the equations. The second step is now to do the apportionment. And for us to do the apportionment, we'll use the table as follows. We'll use the table. So we will have space, then we have basis of apportionment, then we have machining, we have finishing, we have assembly, we have material handling, and then we'll have inspection, and each is in millions. So we'll have that table. So we had it in millions of shillings. So it is all in millions of shillings. So we are beginning with allocated and apportioned. And apportioned overhead costs. So the allocated and apportioned overhead costs for production departments will remain the same. So for machining was 400, for finishing was 200, for assembly 100. But now when it comes to material handling, we are not using the original amounts of 150, but we are now using the results of the simultaneous equations. So Y represented inspection and X represented material handling. So for material handling, the amount will be 103 and inspection will be, inspection was 60.3. It will be 60.3. So we begin by apportioning either of the service department. So we say apportion material handling. And the ratio will not be the same as in this case. We are to use the percentages the way they are. So what are the percentages? For material handling to machining was, we'll use 30%, 25%, 35%, 30%, 25%, and 35%. We are apportioning only to production departments. So we are to apportion 103 using these percentages. So we calculate for finishing. For finishing, we'll have, can have the working part, workings. For machining, we are simply taking 30% times 103. So 30% times 103, we get 30.9. And 30.9 is what is to be apportioned to machining. Then finishing will be equal to 25% multiplied by 103, which equals 25.75. So we'll apportion 25.75. And then the last one is assembly, which will be 35% multiplied by 103, and this equals 36.05, which is just equal to 36. We make this a negative, but we don't want, I'll show the reason why I'm not making it a negative now. When you take 30.9 plus 25.75 plus 36, the total you get is 92.65, which we make a negative. And then we come here and apportion inspection. We now apportion inspection. We apportion inspection, and the percentages for inspection were 20%, 30%, and 45%. So we are apportioning 60.3%. Remember, once you've calculated that simultaneous equation, we are not apportioning any amount to the service department. So we are only apportioning to production departments and therefore don't include any service department. So we'll have 20%. This is inspection. 20%. This is inspection. This was material handling. This was material handling. And inspection will be 20% multiplied by 60.3, which will be equal to 12.06. We apportion 12.06 to machining, then get 30% of 60.3 and apportion it to finishing, which is 18.009, and then 45% multiplied by 60.3, which will give us 27.14. Then the total of the all three, 12.06 plus 18.09 plus 27.14 will give us 57.29, which we subtract, but now we show that the balances are zeros. The balances are zeros. We say that the method is not very accurate, and because of the inaccuracy of the method, that's why we are having balances in the service departments, but they ought to be zero. So once you've done that, simply indicate that we have zeros in the service departments. Then we get the sum for the production departments. Get the sum for the production departments. So for machining, we have 400 plus 30.9 plus 12.06, which will be 442.9, which is the same as 443. And then we have 200 plus 25.75 plus 18.09, which will give us 244. Then we have 100 plus 36 plus 27.14, and this is 163. So I say that this method is an alternative method to continuous allotment, and therefore it should yield the same results. So this was question number 2. You can also use other methods. Under the same part 2, we may also be required to use a reciprocal method, and then sometimes direct method. So you need to know how to calculate or to apportion overheads using direct method or direct allotment method and reciprocal method. And this marks the end of our question number 3. Bye-bye and welcome to our next session, where we'll be dealing with the question number 4 of the same paper.
Hello learners, it's another time that we are meeting, another semester, so that we can proceed with our blocks. Remember last time we were revising November 2019 sitting, and today we are still progressing with the same paper. And I would like us to look at question number 3 of the same sitting. That is November 2019, question number 3. That's what we will discuss today. So we have part A and part B. So I'd like us to start with part A. And part A reads like this. In a tax seminar, one of the facilitators noted that TPA, Tax Procedures Act 2015, specifies on information that the commissioner should include in the default assessment to a taxpayer. With reference to the above statement, outline 5 categories of such information. You know, in case somebody defaults or a taxpayer defaults when it comes to complying with the tax rules and regulation, the taxman normally comes in and assess such a person. So in case you are assessed by the taxman, it's likely, so we refer to that as an estimated assessment or default assessment. So what are we supposed to include? So the categories of these are that information, that is information included in default assessment. These are some of the items that are some of the information that we include in this particular assessment. Number 1, amount of tax. Amount of tax involved. Maybe we are assessing you because we noted that you are supposed to pay like 1 million, you did not pay. 100,000, 10,000, that is the original, the principal tax, amount of tax. So in other words, this is principal tax, principal tax. The other information that we need to include here is tax penalties, tax penalties, tax penalty. If you default, remember, because you have violated the tax rules, we are likely to subject you to a tax penalty, which will also demand over and above the principal tax. Number 2, number 3, we have tax interest. Remember, sometimes if you stay more and more, you take more time with that particular money, we also charge you interest, because it's like we have led that money. You maybe, for instance, like a case of VAT, you collected VAT from the customers, then you did not submit that tax to the taxman. So it means you are doing business with that particular money, and therefore you need to give us that money plus interest. So in case of any principal tax that is not paid, the taxman obviously will charge you some interest. The other information that that will be included is the reporting period. Reporting period. And the reporting period is the period that is covered by that particular tax. Maybe it is income tax covering the year 2018. So that period has to be well stipulated. The other item that should be included is the due date. You need to know the due date of payment, the due date of paying. So again, that has also to be clearly stipulated. And that is some of the information that is supposed to be included in that particular copy. Allow me to go to part B. Srimani Kobo is employed as the managing director of Utamu Distributors Limited, a tax-exempt company. During the year ended that 1st December 2018, he presented the following information. Number 1, his basic salary was 120,000 per month. Payee is 48,000 per month. Number 2, he was provided with lunch by the emperor from 1st August 2018 of 4,800 per month. Number 3, he was provided with a fully furnished house fitted with water and electricity. The emperor paid monthly a rent of 45,000. He was deducted 10% from his basic monthly salary for rent. The cost of furniture was 300,000, while the monthly electricity and water bill is 3,500 and 2,800 respectively. The company paid for him life insurance premium of 6,000 per month for each member of his household. From 1st September 2018, he had included himself, his wife, and their son in the insurance policy. Number 5, he contributed 10% of his monthly pay towards a registered pension scheme, while the emperor contributed 15% of his basic pay towards the same scheme. Number 6, he enjoyed free medical treatment under medical scheme operated by the company for all employees. His medical expenses were assessed at 150 during the year. During the year, the company paid a total of 35,000 as school fees for his son studying in county school. This amount was not included in the company income statement during the year. Number 8, on 1st August 2018, the company provided him with the following: a Land Rover, which was acquired at a cost of 1.8 with an engine capacity of 3,000 cc, a gardener and a night watchman whose monthly salary was 12,500 and 15,000 respectively. Number 9, he invested in real estate and earned net rental income of 72,000 after deducting the following expenditures. We have caretaker salaries, fencing, loan repayment, insurance, rent and rate, partition, capital allowances, gross rental withholding tax is spent. Number 10, he received net dividend of 42,500 from Maziwa Cooperative Society during the year. For 10 marks, compute the taxable income. Then for 3 marks, calculate the tax liability. And for 2 marks, comment on any information not used. So, what we have here is Suleimani Kobo. Suleimani Kobo computation of taxable employment income for the year ended that 1st December 2018. So we have particulars here and we have shillings here. We normally start with basic salary. And the basic salary at the note number 1 is 120,000. You multiply this by 12. So we have 120 by 12, 1440. 1440, yes. Then you add benefits. The benefits are he was provided with a lunch by the employer and this is free meals. Free meals is taxable to high income earners. This person is getting 120,000, so it's a high income earner. Free meals. So which is 4,800. You multiply by, so August, September, October, November, December. So times 5. So 48. You multiply by 5. 24,000. Number 3, he was provided a fully furnished house fitted with water and electricity. The employer paid a monthly rent of 45,000. He was deducted 10% of the basic monthly salary for rent. The cost of furniture was 300,000, for the monthly electricity and water bill is this much. So we start with furniture benefit, which is furniture benefit is we given the month. No, so it is 12% times 300,000. 12% times 300,000. 36,000. Then from there, we also have the electricity benefit and water. Electricity and water benefit, which is 35 times 12 and 28 times 12. 28 times 12. So this one is 3,500 times 12. 42,000 under 28. You multiply by 12. 33,600. The other one is he contributed 10% of his monthly pay towards a registered pension scheme, so the employer contributed 15% with basic pay towards the scheme. So this company is exempt from taxation. So if you contribute towards non-registered, that is taxable. So this one is also, this qualifies for, it's a tax deductible. So we go to note 6. He enjoyed free medical treatment under the medical scheme operated by the company for all employees. His medical expenses were assessed at this. This medical scheme is free for all, so it is not taxable. Number 7, sorry. During the year, the company paid a total of 35,000 as school fees for his child studying in a county school. This amount was not included in the company income statement. If it was not included in the company income statement, it means it was not deducted as an expense, and therefore it was taxed on the company. School fees is taxed on the company or on the employee. If it was taxed on the company, you cannot tax the employee. So it was already taxed on the company, so we cannot tax the employee here. Number 8, on 1st August 2018, the company provided the following. So we have car benefit. Car benefit, we compare two figures. The first figure is 24% of the initial cost of the car. Initial cost of this car is 1.8. And this is from August. So this is 5 months. So we multiply by 5, meaning 24% you multiply by 1,800 times 5 over 12. This because this is per annum. So times 5 divided by 12. So you get 180. You compare this with CC. The CC rating of this car, 3,000 CC of this car. This is Land Rover is 86 for a 72 by 5. So 72 you multiply by 5, you get 36. And remember, for benefit we take the higher, so the taxable amount there is 108,000. The other one is we also provided the services of a gardener. And this gardener, we are paying him a monthly of 12,500. You multiply by 5. This is from August, so you multiply by 5. You multiply by 5. And watchman, we are paying 15,000. Again you multiply by 5. So we have 12,500. You multiply by 5, 62,500. 15,000 times 5, you get 75,000. Number 9 is about other income, so you skip. Number 10 is about other incomes, again you skip. So those are the benefits in excluding the housing benefit. So the total here is employment income, which is 1440,000 plus 24 plus 36 plus 42 plus 33,600 plus 180 plus 62,500 plus 75. You get 1893. That is 75,000. Number 9 is about other incomes, and number 10 is also about other incomes. So for the benefits, we have insurance also, insurance premium that we have skipped. Insurance premiums, that is not number 4, whereby it amounts to 6,000 per month. 6,000 you multiply by 12, you get 72. So those are the benefits that we have in our question. Now we get the total. So we have 1440,000 plus 24,000 plus 36,000 plus 42,000 plus 33,600 plus 180 plus 62,500 plus 75 plus 72. You get 1965, 100. So from this is known as employment income. Then from there we earned housing benefit, housing benefit. We compare two figures, 15% times employment income, 1965, 100. So times 15%, 294, 765. At market value of the house is 45,000. You multiply by 12. 45 times 12, you get 540. So the higher is 540. You less owner's contribution. Which is owner's contribution. It is 10% times 1440. So you get 144. So 540 minus 144, you get 396. You earned. So plus 1965, 100. You get 2361, 100. This is known as pensionable income. You less allowable deductions. For the allowable deductions, we have contribution to registered pension scheme. Contribution to registered pension scheme. Note number 5, whereby he contributed 10% of the monthly pay. So 10% times, this is actual. Actually 10% of 1440. So you get 144. Compare this with set limit of 240. So you take the lower, 144. Is the allowable? We do not have any other allowable deduction. So we go to taxable employment income. Taxable employment income. So we have 2361.1 minus 144. You get 2217,100. You earned other incomes, and we want the taxable. In my question, I have investment in real estate, and this investment is subject to a withhold. This income we are getting from real estate is less than 10 million. So it is subject to a withholding tax of 10%, which is final. So that rental income is subject to withholding tax of 10%, which is final. But we have dividend. We have 42,500. It is given at net, so we multiply by 100 divided by 85 to make it gross. So if we have 42,500, you multiply by 100 divided by 85, so you get 50,000. So now we don't have any other taxable income, so this is total taxable income, which is plus 2217,100, which is now 2267,100. 2267. 100. And then from there, part B, we want the tax liability. Tax liability. Computation of tax liability. So we can do it at this point. Roman 2. Computation of tax liability. And the taxable income is 2 million. So we use the, remember this is taxation of an individual, so we use the graduated scale. Under the graduated scale, we have first 147,580, the taxman will take 10%. Then from there, or second 139,043, the taxman takes 15%. Third 139,043, the taxman take 20%. Fourth 139,043, the taxman take 25%. Then from there we take excess. The amount we are taxing is 22,67,100 minus what we have already taxed. What we have already taxed is 564,709, the total of all this. This one you multiply by 30%. This will give us the gross tax liability. We have the first amount, that is 14,758. The second 139,043. You multiply by 15%, you get 20,856.45. Then 139,043 times 20%, you get 27,808.6. 139,043 times 0.25, you get 34,760.75. Then excess 22,67,100 minus 564,709. You multiply by 30%, you get 510,717.3. So total plus 34,760.75 plus 27,808.6 plus 20,856.45 plus 14,758. You get 608,901.1. So this is gross tax liability. Gross tax liability. We less the following. The first one is personal relief. Personal relief, which is 16,896. We also less payee. Payee is calculated from gross, so it is 48 by 12. 48,000 you multiply by 12. 48 you multiply by 12. 576. And the last one I can see we have also insurance relief. Insurance relief, we compare two figures, set limit of 60,000 and 15% of the total premium. Total premium, it is 72 insurance. So 15% times 72, 10,800. So you take the lower, 10,800. The other deduction is on this dividend from 42,500 to 50. So 50,000 minus 42,500. That is withholding tax 75. So 75, that is withholding tax on dividend. Remember, it was paid at deducted at source to control tax evasion. So net tax will be equal to, you have 608 901.1 minus 16 896 minus 576 minus 10 800 minus 75. We have that is we have negative, that is let me confirm, that is 608 901.1 minus 16 896 minus 576 minus 10 800 minus 75. Yeah, we have a negative of 2294.9, and this means that this is net tax, that is tax refundable. Tax refundable. It means that this person was subjected to high pay. This pay is very high, so he was over deducted. Therefore, as at the end of the year, he is the person is entitled to a tax refund. The last item is we are supposed to comment on any information that we have not used. The information that we have not used in our question, to get these 2 marks, there is these school fees. Note number 7. During the year, the company paid school fees of that 5,000 as school fees for his son studying in county school. This amount was not deducted in the company income statement. We have not used that school fees. Why? School fees is taxed on either the employer or the employee. If it was taxed on the employee, we cannot tax the employee. The fact that it was not deducted as an expense on the employer income statement, it means it was included in his income. Therefore, it was taxed on the employer. We cannot tax the employee. So the first item there is school fees. The second one is this medical benefit. Medical benefit here, it is not taxed simply because it is free for all. Where the medical scheme does not discriminate, then it is not taxable. That is the second one. The third one is rental income. This rental income, we have not used it anywhere because that rental income is subject to a withholding tax of 10%, which is fine, meaning it is not taxable again. So those are the items that we can basically comment. So our concept today was taxation of employment income, and that is what we have done. For the purpose of more and more revision, I will give you assignments which I expect you to attempt. For example, May 2014, question 1A and C. So we have Mr. Odipo, computation of taxable employment income. We also have May 2017, question 4C is about employment income, Philip. We also have November 2017, question 3B, taxation of Nelly. You can also look at that. Then we also have some solutions at the back that we have provided. So I expect you to do your own. You give your own solutions, then you can compare with our solutions. So for today, let's stop at that. We meet next time so that we can progress with our blocks. Thank you. Learners, how are you? It's another time we are meeting, and so that we can progress with our revision. Remember, this time we are looking at November 2019 sitting, and we have been seeing what the examiner expected from the last group or from the last students. So as we continue to revise and expect our exam, so I would like us to progress with our paper. So remember we have done question 1. So today we are going to look at question 2. So we have November 2019, question number 2. So question 2 reads like this. Identify 3 ad hoc committees that county procurement entity could establish to ensure that procurement and asset disposal is done in accordance with county government procurement regulations. So in other words, we need to know these procurement committees, the procurement committee. That is number A, procurement and disposal committees. Procurement and disposal committees. And now, remember in procurement, under Procurement Act that was implemented by the government, so we have a number of committees that are supposed to be there, obviously to make sure that the procurement process is carried out in a professional manner or as expected. And we have a number of committees. For instance, we have tendering committee. Number A, we have tendering committees. Under this tendering committee or tender opening committee, that is tender opening committee, whereby this committee is in charge of receiving these particular tenders, and then thereafter we open those particular tenders so that we can see what has been received, whether it has met the standards or whether we have not met the standards. Then we also have another committee that we refer to as a tender evaluation committee. Tender evaluation committee. Tender evaluation committee. And that is a committee that tend to go through those particular tenders to see whether to select, maybe like to shortlist and see those particular tenders that have met the standards or what. We also have another committee that we refer to tender negotiation committee. That is tender negotiation committee. Tender negotiation committee. And this is a committee that tend to bargain with the persons who have applied for those particular tenders to see whether maybe we can get the best and what. So remember, if you want to buy something, sometimes we tend to negotiate or to bargain so that we can get maybe like the best price. And therefore, that is the work of that particular committee. Again, remember that we do all these delegation, separation and what, so that we can make sure that we do not have conflict of interest. Each and every committee carries its own activity. So when you delegate that to a number of committees, you'll find that chances of colluding, they are likely to be minimized. That's why we have a number of committees. But when you want to buy something and you have so many, you have only one person doing that, that person can easily violate the rules. So that's why we advocate that we have a number of people so that we can control the same. We also have another committee we refer to as tender disposal committee. That is disposal committee. Disposal committee that is involved when it comes to selling of assets and what. Because like for government, we do not just sell the assets like that. For instance, like motor vehicles. So if you dispose motor vehicles like that, you find that some of these persons have conflict of interest. So we need to have a committee that will be engaged on the same. Also, there is another committee that is normally established known as tender inspection. Tender inspection committee. Tender inspection committee. And to me, those are some of the major tenders, that some of the major committees that we find under Procurement Act. So allow me to go to part B of the question that reads like this. Discuss 5 laws of the National Treasury in relation to procurement and asset disposal as outlined in the Public Procurement and Asset Disposal Act. So what are the roles of National Treasury with respect to procurement? So number B, that is the roles of National Treasury, roles of National Treasury in relation to procurement. In relation to procurement. In relation to procurement and asset disposal. And asset disposal. And asset disposal. Okay, you know, Treasury deals with finances, and also procurement and asset disposal. We're also dealing with finances, although these are different areas altogether. But I note that Treasury has a take. The National Treasury need to understand what is happening under procurement and asset disposal, because when it comes to buying the government properties, then we are spending money from the National Treasury. When we dispose, that money that is received obviously will go to the National Treasury. So that's why we are saying now, what are some of the roles that the National Treasury need to play in relation to procurement and asset disposal? One of the responsibility is to develop, that is to develop and promote electronic procurement strategies. That is, you will find that currently we are doing most of these activities, they are carried out electronically. So, and it is the work of the National Treasury to help in developing these electronic procurement strategies. Then they are implemented under procurement, because the Treasury is there to protect loss of finances, and therefore they need to come up with strong rules that are meant to ensure that we do not lose funds in any way. The other one is to help in developing procurement policies and standards. That is to help in developing and promoting procurement policies and standards. Procurement policies and standards. So they have a take. Remember the policies that are supposed to be followed, such that in case of any violation, so then that can lead to taking action against somebody. So that also need to be considered. The other thing that the National Treasury do is they also provide technical assistance. That is to offer technical assistance where necessary. To offer technical assistance where necessary, because sometimes if we need any assistance, especially the technical part of it, they need to come in and provide that particular assistance. The other important thing is they also help in implementation, to help in implementation of public, that implementation of procurement management systems, to help in implementation of procurement management systems, implementation of procurement management system. The other responsibility is they also tend to communicate to public entities what is required of them. So when it comes to what is required from procurement entities, they also have a take on the same. So we are simply saying that they need to provide guidelines to public entities on procurement on public entities relating to procurement matters. That is to provide guidelines to public entities relating to procurement matters. They also need to offer guidelines on the same. Those are some of the major roles that are supposed to be played by the National Treasury with regard to matters affecting procurement. So allow me to go to part C of that particular question. And this is about VAT. The question reads like this. The following are summaries of the details of sales day book, purchases day book, and the cash book of Kamata Limited for the month of December 2018. So we have the sales day book, we have the purchases day book, and also the cash book. Then we have additional information. Number 1, J. Kamau was declared bankrupt on 18th December 2018 after having paid 400,000 for the goods purchased on 7th December 2018. Number 2, 10% of the purchases from Jawabu Enterprises were returned by the company due to poor quality. Number 3, credit notes amounting to 280,000 were issued to customers during the month. Number 4, refund to customers in the cash book related to excess amount paid on cash sales. All purchases invoice of 220 from Dubai traders was omitted from the purchases day book. All the above transactions are exclusive for VAT at a rate of 16%. For 12 marks, prepare VAT account for the month of December 2018, showing VAT payable or refundable if any. So we need to prepare the VAT account. So we have Kamata Limited VAT account for the month of December. For the month of December 2018. So on this side, remember we put input VAT, and on this side we put output VAT. So here we can put the date, particulars, and VAT, date, particulars, then you have VAT there. So we start with the sales day book. What we know about VAT payable or refundable is output VAT minus input VAT. So we need to know when we are supposed to calculate output VAT and when we are supposed to calculate input VAT. And output VAT is normally calculated on sales. So we are going to take the first part, which is sales day book, which will help us now to calculate the output VAT. So for the sales day book is as follows. We have December 4th, whereby we have Mwagaza Limited. These transactions are VAT exclusive. So it is 16 over 100 times 650. So we get 16% times 650. We get 104. The second one is J Kamau, 7th. J Kamau, 16 over 100 times 520,000. 520,000. So we get 16% times 520, 83,200. 83,200. 14th, December 14th, we have exports. Exports of 350, and exports are zero rated, so times 0 over 100, so we get 0. Then 20th, Ministry of Sports. Remember, they are also vertible, so 170 you multiply by 16 over 100, so 170 times 16%, you get 27,200. And that is about sales. Sales day book. I go to purchases day book, and purchases qualifies for input VAT. So we have December 1st, whereby we have Jawabu, enterprise. So we have 16 over 100 times for Jawabu enterprise, any note. That is not affecting now. So 16% times 300. So 16% times 300, you get 48,000. Then we have Sonitech imports, December 6th, imports. This imports is 420. And remember, imports, they are subject to custom duty. But this time, I'm not given the custom duty rate, which is normally 20 or 25%. So, I'll assume these goods are, the custom duty is already included. But you are supposed to charge VAT on import based on dutiable value. That is import price plus custom duty. So, this one I'll calculate directly. I multiply by 16%. So 460 you multiply by 16%, you get 73,600. The other one is Karuma. That is 12. Karuma. We have 16 over 116. 100, sorry, times 200. So 16% times 200, 32,000. We have Sarama, 27, Sarama, 16 over 100 times 180, 16% times 180, 28,800. So that's the end of the purchases day book. So I go to the cash book now. In the cash book, I have the cash sales. Cash sales qualifies for output VAT. That is December 5th. December 5th. So cash sales. This is 16 over 100 times into bracket 960 plus 450, and there is a note affecting the cash sales. That is note 4, referred to customers in the cash book related to excess amount paid on cash sales. So that one is not subject to VAT, so you subtract. So you less 176 minus 176. So we have 960 plus 450 minus 176. You get 16% of that, which is 197, 440. 197, 440. The other one is On the payment side, we have salaries. Salaries are not vatable. They are subject to pay as you want. Catering, again the same, not vatable. But we have cash purchases which qualifies for input VAT. So fifth, cash purchases. 16 over 100 times 580 plus 580 plus 640. 580 plus 640. No note affecting that. So 580 plus 640 times 16%. You get 195,200. 195,200. The other one is furniture. Furniture normally qualifies for, if it is used purely to generate more sales, to make more sales, it qualifies for input VAT. So furniture note 7. Furniture 16 over 100 times 160. So 16% times 160. 25,600. The other one is electricity, number 9. Electricity 16 over 100 times 32,000. 16% times 32,000. 16% times 32, you get 5,120. The other one is photocopying also qualifies for input VAT, and this is 14, photocopy. So this is 16 over 100 times 24. So 16% times 24, you get 3840. 3840. 3840. Then from there, let me see the additional information. Number 1, J. Kamau was declared bankrupt on 18th after having paid 400,000 for the goods purchased. So J. Kamau is this one, and we had calculated output VAT. So if he was declared bankrupt, meaning that he cannot pay after paying only 400,000. So it means goods worth 120,000. We need to reclaim that VAT. So we can just put it on this side. That is bankruptcy. On 7th, bankrupts. So 16 over 100 times 120. That is 520 minus 400. 120,000 times 16%. You get 19,200. But this time we want to reduce it because now that money was not collected from the customer. Number 2, 10% of the purchases from Jawabu were returned by the company due to poor quality. So some of these goods, 10% were returned. So that is return out once. So I can subtract it on this side, or I put it on this side, I put it in bracket. So let me just put it on this side. That is return out once. Return out once. 16 over 100 times into bracket 10% times 300. 10% times 300. So that is 30,000 times 16%, 48. So that will reduce now this VAT. Number 3, credit note amounting to 280 were issued to customers. Credit note issued. Remember credit note. Credit note, we say credit note corrects overcharge error, and debit note corrects undercharge error. And therefore, if you are issuing credit note to customers, it means we want to correct the overcharge error. And therefore, it means that we had overcharged those customers. If we had overcharged those particular customers, it means even the VAT that we collected from them, we charged them is more. So to correct it, we are supposed to put it on the debit side so that we can reduce it. So allow me to progress on this side. Let me extend it. So that credit note that is issued to customers will appear on this side. So credit note issued. So this will be 16 over 100 times 280. So 16% times 280, 44,800. Number 4, referred to customers in the cash book relate to, that one we have adjusted. Number 5, a purchase invoice of 220 from Dubai traders was omitted. So it means input VAT is less. So we have omitted invoice here. Omitted invoice. 16 over 100 times 220. So we get 16% times 220, 35,200. So for the VAT now, that's it. So we need to get the VAT payable. So we get the totals first. Let me start with the debit totals. We have 48,000 plus 73,600 plus 32,000 plus 28,800 plus 195,200 plus 25,600 plus 5120 plus 3840 plus 44,800 plus 35,200. So the total is for the debit is 492,160. The total for the credit is 104,000 plus 83,200 plus 27,200 plus 197,440 plus 4,800 minus 19,200. This is 397,440. So it means that the debit side is more. So therefore we have a VAT refundable. VAT refundable of 492,160 is the bigger figure. 492,160. So 492,160 minus that figure, you get 94,720. 94,720. So that is how we calculate VAT. And again, how we prepare VAT account. As usual, I will give you the assignment. Remember, for practical purpose, we need to do more and more revision. So I can give you assignment. For instance, you can check this question. That is December 2012 question 1C is about VAT. You calculate VAT payable or refundable. You are given some of the transactions. Remember also we have a concept of restricting the input VAT. So we can also address May 2012 question 5B and C. It's about restriction of input VAT, especially to those traders who buy goods at standard rate, but when selling, they are selling some goods as exempt, meaning that they tend to overclaim for input VAT. So you can practice that on that question. Then we have also December 2010 question 5B. It's also about VAT payable. Still, we have November 2015 question 5B and many others. Remember, in our revision booklet, we have as many questions as possible for revision purpose. Again, at the same time, we have provided our solutions, but we don't give you the priority of checking the solutions before you have prepared your solution. So solve the question. When you get your solution, then check what we have provided. Compare the two, then for any query you can ask. So for now, let's stop at that. We meet in the next class so that we can proceed with the blocks.
Hello candidates, welcome to the Advanced Assurance and Auditing Revision Series. Today we continue to answer questions from the May 2019 examination sitting. So far, we have answered question 1 and 2. Today we want to turn to question number 3, which is in 2 parts. I'll read part A, which says, KASNEB Limited manufactures custom-made furniture. The company's year end is 31st May. The company purchases its raw materials from a wide range of suppliers. The company's purchasing system is described below. Number 1, when production supervisors require new raw materials, they complete a requisition form which is submitted to the purchase ordering department. Requisition forms do not require authorization and no reference is made to the current inventory levels of the materials being requested. Staff in the purchase ordering department use the requisitions to raise sequentially numbered purchase orders based on the approved suppliers list, which was last updated 24 months ago. The purchasing director authorizes the orders prior to this being sent to the suppliers. Number 2, when goods are received, the warehouse department verifies the quantity to the supplier's dispatch note and checks that the quantity of the goods received is satisfactory. The department then completes a sequentially numbered goods received note and sends a copy to the finance department. Number 3, the purchase invoices are sent directly to the purchases ledger clerk, who stores them in a manual file until the end of the week. He then inputs the invoices into the purchases ledger using a batch controls and gives each invoice a unique number based on the supplier code. The invoices are reviewed and authorized for payment by the finance director, but the actual payment is only made 60 days after the invoice is input into the system required. With respect to the purchase ordering system described above, Roman 1, analyze for system deficiencies, 8 marks. Roman 2, recommend a control to address each of the deficiencies described in A1 above. How many marks? 4 marks. So candidates, here is a question that describes the purchasing system of KASNEB Limited, which manufactures custom-made furniture. The system is described in 3 points. The first point is in relation to the raising of the requisition. The second point is in relation to receipt of goods. We are told in 2, when goods are received, the warehouse department verifies the quantity to suppliers. Then in note number 3 is in regard to payment. In that we have information about the purchase invoices, which are sent directly to the purchases ledger clerk. So candidates were required to analyze for system deficiencies. Now, candidates, to answer this question, a candidate needs to understand how an ideal purchasing system should be. All right, right from the raising of the requisition to the placing of the order with the suppliers, to the receipt of the goods and payment of the goods. So that is very important. You need to understand how the purchasing system operates, and I advise you also to pay attention to the sales system, the cash system, the inventory, and so on. You need to understand how the system, how an ideal system should operate If you understand how an ideal system should operate or should be put in place, then you will be in a position to point out deficiencies in any other system that may not meet the ideal system. So let's check for the deficiencies, and the paper, this is block revision, advanced audit and assurance. The paper is May 2019. You are on question 3. Question 3. This is 3A. Now, candidates, to answer this question properly, is we are going to have the deficiencies in one column and corresponding recommendation on how to address the deficiencies in another column. So in the table we will answer Roman A and 2 simultaneously. So with respect to the purchase ordering system described above, analyze 4 system deficiencies. So in one column, Roman 1, I'll have system deficiencies. Then in Roman 2, I'm going to have control to address the deficiency. This is, we'll have control to address the deficiency. So I'm going to have 2 columns. Let me use my blue pen here. This is one column. This is another column. So it's a column here. All right. It's column like that. Column like that. It's column. Okay. So that a deficiency here, we'll have deficiency 1, then the corresponding control to address the deficiency. That's the best way to answer such a question. So let's point out the deficiencies from Roman 1. We read, when production supervisors require raw materials, they complete a requisition form which is submitted to the purchase ordering department. Requisition forms do not require authorization. That is a deficiency. All right. Then we are told again, and no reference is made to the current inventory levels of the materials being requested. That's another deficiency. Okay. So let's have the deficiency down. That is number 1, that requisition forms completed are completed but not authorized. That is a deficiency. Requisition forms are completed, requisition forms are completed but not authorized. Are completed but not authorized, full stop. When this happens, candidates, there is a risk of fraudulent purchases. There is a risk that the company may make fraudulent purchases because there is no authorization. Another risk is that goods that are not required may be purchased. That's another danger. So requisition forms completed but not authorized, there is a risk of fraudulent purchases. That's a loophole where fraudulent employees can utilize to defraud the company. So how can that be addressed? Because Roman 2, we are supposed to recommend a control to address each of the deficiencies described. We have described one. So how do we, what is the recommendation for addressing this deficiency? Now, it is simple. We can say requisition forms should be authorized. Should be authorized by the production manager. By the production manager prior to being sent to the purchasing department. Prior to being sent to the purchasing department, there has to be authorization by a responsible officer, and that has to be the production manager, because it is the production manager who is the head of the production department. These materials are to be required in the production department. So the production manager should authorize the requisition forms before they are sent to the purchasing department. Otherwise, if that does not happen, then any official any employee in the production department can raise a requisition, and that may lead to fraudulent purchases. That is one point. I want to have a line here. We have this line. That is one point. Then let's point out another deficiency which is closely related to this one. It is in fact in one sentence. It says, requisition forms do not require authorization and no reference is made to the current inventory levels of the materials being requested. No reference is made to the materials being requested. That is a deficiency. And so I can note it down that orders are placed for goods without checking what? That is sentence the second sentence, without making reference to the inventory levels, without checking inventory levels. So that raises a danger of goods. It raises a danger of goods not goods. You can say goods not needed may be ordered. Goods not needed may be ordered, because if there is no reference made to the current inventory levels, then it's a possibility that the company can purchase goods that are already in the store. So before ordering new goods, there has to be reference made. You need to go to the store and check, confirm that those goods are not in the store. If you don't do that, then there is a possibility that the goods that are already in store may be purchased, and that is not proper. So how do you address that problem? How do you address the problem? This is the control. How do you address that problem? the ordering clerks should check the current level of inventory before ordering. In fact, the company should have the minimum stock level and the maximum stock level. So when this order is being made, the ordering clerks can check the levels before placing the order. That is the second point. Then let's read through and see if there is any other deficiency. Staff in the purchase ordering department use the requisitions to raise sequentially ordered purchase orders based on the approved suppliers list, which was last updated 24 months ago. That is approximately, not approximately, but exactly 2 years. It was updated 24 months ago. That is a weakness. That is a deficiency, which was last, the suppliers list approved 24 months ago. So let's put down that deficiency. List of suppliers updated, list of suppliers updated for the last 24 months, for the last 24 months. And what is the problem with that? What is the problem of taking too long to update the suppliers list? The danger here is that the company could be relying on suppliers who are not competent, who are not offering favorable prices, who are not providing quality goods, or who are not delivering the goods in time, because within 24 months there could be new suppliers who come into the market who are even offering discounts. So if the suppliers are not checked or updated, then the company could be losing on high prices by paying goods on high prices. The company could be losing by buying goods that are of low quality or goods that are being delivered after a long period of time. Okay? Or we may have suppliers who are making deliveries within these 24. We could have had new suppliers in the market who are delivering goods as opposed to the old suppliers where the company is supposed to go and pick the goods. So those are the dangers. It's not good to have suppliers not being updated for 2 years. So that is a deficiency. How can that be addressed? How can that be addressed? This is my proposal. Review list of suppliers, list of approved suppliers, list of approved suppliers at least on annual basis, at least on annual basis. That is another point. Let me take you back to the second sentence. Requisition forms do not require authorization and no reference is made to the current inventory levels of the materials being requested. Candidates there are two deficiencies. One we had noted down orders placed for goods without checking inventory levels, and we said goods not needed may be ordered. Another point we can pick from that deficiency is that the company does not monitor inventory levels, and if the company does not monitor inventory levels, then that may lead to stockouts. Company may find itself in a position where there are no stocks of raw materials, hence causing customer dissatisfaction by not meeting customer needs. Remember, this is a manufacturing company, and this company buys raw materials which is converted into finished goods, which are then sold to suppliers, I mean to the customers. So if there are no raw materials, as occasioned by the failure to monitor inventory levels, then there are chances that the company will not have raw materials to convert into finished goods to sell to customers. So that is a deficiency. The company does not monitor inventory levels, which may lead to stockouts, and that is a deficiency. And how can that be corrected? What is the control that is required to address that deficiency? The company should set minimum, let me say, minimum authorized reorder levels inventory items. That is an important control. It's a very important control. Failure to have this control, as I've just explained, the company may not produce the goods that are required to meet customer needs. So you can see here, candidates, we have, the question says, analyze 4 system deficiencies, 8 marks. We have already done that. 4. This is 1, 2, 3, 4. 1, 2, 3, 4. So each system deficiency would earn the candidate 2 marks. So 2 times 4 is equal to the 8 marks shown there. Then for each and every control, these are 4. These will be 4 marks. 1 times 4, which is equal to 4 marks. And as you may have noticed, I have not even moved to the second part. This I've identified these deficiencies from note number 1, and all these are in relation to the purchase ordering system as required by the question. It says, with respect to the purchase ordering system, or note 1, that is a point of ordering. So candidates, you are not required even to pick deficiencies in note number 2 or note number 3 to earn the marks. You only needed to identify 4 controls, 4 deficiencies from the first note number 1. But for the purposes of revision, let us list the other deficiencies from note number 2. Note number 2 for the purpose of revision, because next time you may be required to give more than 4. For the purposes of revision, we are going to answer to identify system deficiencies in note number 2 and note number 3. Let me read note number 2. When goods are received, the warehouse department verifies the quantity to the supplier's dispatch note and checks that the quantity of the goods received is satisfactory. The department then completes a sequentially numbered goods received note and sends a copy to the finance department. When goods are received, the warehouse department verifies the quantity to the supplier's dispatch note, and checks the quality of the goods received if it is satisfactory. Candidates, right there is a deficiency. We are reading, when goods are received, the warehouse department verifies the quantity to the supplier's dispatch note. Is that what should be done? No. When receiving goods, you need to verify the quantity against the purchase order, not the supplier's dispatch note. Not the supplier's dispatch note. You cannot check the goods against the documents provided by the supplier. You check the goods that are being received against what you ordered, and the document is the purchase order. That is a weakness which we can note down. That goods are received without checking them against the purchase order, and there is a risk that the company may receive and pay for the goods that were not ordered. The company may receive and pay for goods not ordered. Because if you want to check if the goods that you are receiving are the goods that were ordered, then you can only do that by checking the goods that are being received against the purchase order. So what is the control? What's the control to address that deficiency? The control to address the deficiency, a copy of authorized order should be sent to the this should be a straight line, supposed to be a straight line. A copy of authorized order should be sent to the warehouse, because that's where the goods are being received. Should be sent to the warehouse, which then will be used to verify against the goods that are being received. Then I can say that this should be checked, should be checked to the goods when received. This should be checked to the goods when received. So a copy of authorized order, it has to be authorized. And remember, this authorized order is to be signed by the production manager. When a copy is being sent, remember we said here that a requisition should be authorized by the production manager prior to being sent to the purchase department. So when sending the order to the purchase department, another copy should be sent to the warehouse, so that when the goods are being received, then the warehouse, right? The warehouse, when they are being received in the warehouse, this copy of authorized order will be used to check against the supplier's dispatch note. Supplier's dispatch note. That is what we do in the purchasing system. Then that is a problem in note number 2. Then we read, the department then completes a sequentially goods received note and sends a copy to the finance department. Sends a copy to the finance department. Note number 3, purchase invoices are sent directly to the purchases ledger clerk, who stores them in a manual file until the end of the week. He then inputs invoices into the purchases ledger using batch controls and gives each invoice a unique number based on the supplier code. So there, right there again, there is a deficiency. The purchase invoices are sent directly to purchases ledger clerk, who stores them in a manual file until the end of the week. Until the end of the week. That is a very long period of time, 1 week. There is a danger that if the purchase invoice is stored in the manual file until the end of the week without posting to the ledger, there is a danger that this invoice may be misplaced. That is a problem. It may be misplaced, and if it is misplaced, then it means that there may be a delay in paying the suppliers. So that is a deficiency. And if the suppliers are not paid in time, that would also mean that the relationship between the company and the supplier will not be good. That is a point where some suppliers may insist that you make the payment first before goods are to be dispatched. So that is a big problem, deficiency. Let me put it down. That purchase, the problem is purchase invoices are manually filed up to manually filed and updated to the ledger weekly, and I've said that that will lead to the risk. There is a risk. There is a risk of misplacing invoices. There is a risk that the invoices may be replaced, may be misplaced. Okay, some of them sometimes get lost in the office. So, and that also raises the danger of the suppliers not being paid, and that may spoil the relationship between the company and suppliers. How do we address that deficiency? How do we address the deficiency? Record invoices in the ledger daily. That should be done daily. And if not possible, they should be sequentially numbered. They should be sequentially numbered before filing. The invoices should be sequentially numbered before filing. Why? When they are sequentially numbered, you can easily tell the missing. If one is misplaced, you can easily tell which one has been misplaced, because the invoices are numbered sequentially. That is one way. But ideally, the invoices should be recorded in the ledger daily. Remember the accounting system. An invoice is a source document, so it has to be posted in the book on daily basis, in the day books, right? The purchases day book, then finally into the purchases ledger. It has to be done daily. It has to be done on daily basis. And that may, for some organizations, that may not be possible because of the volume of invoices that are received. The company may be forced to employ more clerks to do the work, and maybe the cost of employing clerks may outweigh the benefit. So in such a case, we've said the invoices can be sequentially numbered for later posting of the invoices into the ledgers. So that is a problem. Then let's read on. He then inputs, that we are not number 3, he then inputs sentence number 2, he then inputs the invoices into the purchase ledger using batch controls and gives each invoice a unique number based on the supplier code. The invoices are reviewed and authorized for payment by the finance director, but the actual payment is only made 60 days after the invoice is input into the system. Right there, candidates, you can note a deficiency. You see the finance director pays. We are told the invoices are reviewed and authorized for payment. But we all know that before the finance manager or director approves payment of invoices, the invoices have to be agreed to the relevant goods received note. That is not indicated here. Before paying, you need to agree the invoices with the goods received notes, so that you are sure you are paying for what was received. That is not done, and that is a deficiency which should be noted down. Purchase invoices. Purchase invoices are not agreed to the relevant goods received notes prior to authorization and payment. Prior to authorization and payment. And this raises a danger of paying invoices for goods that were not received. The only evidence that goods were not received is this goods received note. Okay? So that's a deficiency. How do we correct it? What is the control? What is the control for that deficiency? What's the control for that deficiency? Purchase invoices should be agreed before the invoices are lodged into the purchase ledger. That is the answer to that problem. Then there is a point I noted, that is the invoices are reviewed and authorized for payment by the finance director. Learners, you should notice that these invoices are not sequentially numbered, and that is a deficiency. So we can put down that point, that purchase invoices are not sequentially numbered. It means that the finance department is unable, means that this means that the finance department is unable to monitor if all invoices have been completely recorded, leading to failure to pay some suppliers on time. Now, if purchase invoices are not sequentially numbered, then the finance department may not be able to monitor all invoices and check if all of them have been paid. So there lies a danger that there could be 1 or 2 or 3 invoices that have not been paid, because there is no way the finance department can monitor and check that all the invoices have been received and paid. Now, how do we correct that deficiency? All purchase invoices should be sequentially numbered and on regular basis, a sequence check be performed, and on regular basis a sequence check of the unrecorded invoices be done. There has to be that exercise of sequentially numbering the invoices and carrying out sequence checks of the unrecorded invoices. So this we've done we've identified 4 more system deficiencies. This is 1, 2, 3, 4, and the corresponding controls to address the deficiencies. This I have done for revision purposes. Otherwise, from the first note, candidates were able to identify the deficiencies, the very first note of the question. So let us now move to question B. Let's move to question B. Question B, I'm going to answer question B on this end. B.
Hello learners, I welcome you to Manifested Publishers e-learning portal. My name is Celestine Wandabusi. We've already done question number 1 of May 2019 sitting, and today I'll be introducing you to question number 2 as we move on. So my instructions are, have your calculator. Let's move on together as we solve, or as I solve, ensure that you are fully participating. So the question is still containing 5 questions, and therefore we are picking from question 2, part 1 of it. So question A, question 2, part A reads, Baraka Distributors Limited purchases and sells a single product branded M. The following information is provided for product M. Note number 1, annual demand for the product is 30,000 units. Note 2, the ordering cost per order is 2,500 shillings. Note 3, the holding cost is expressed as 20% of the purchase price. Note number 4, a new supplier in the market has presented Baraka Limited with a proposal for the following range of quantities and respective price per unit. We have range of quantities from 1 unit to 3,000 units, and prices up to quantity 9,001 to 10,000 units at price 13 shillings. They are required advise the management of Baraka Distributors Limited on the range of quantities to purchase. This question requires us to analyze or to help the company do an analysis where we have an economic order quantity and where the discount is offered. So we normally have two decisions that are made according to the question that we have a multi-level price question. And in the multi-price level question, we normally have several prices given or different discounts given at each quantity. So what we need to do is we need to calculate the economic order quantity at the current situation of this farm to know at what how much they are ordering in terms of quantity. So once we calculate the economic order quantity, we will then be able to know the quantities that need to be involved in the decision-making process. And then we'll calculate the total cost for each quantity, and after we've done with the total cost for each quantity, we simply compare the total costs and we'll be able to advise the management. So the first step in this is calculate the economic order quantity of the current situation of the farm. So economic order quantity is simply that quantity that is considered optimal, meaning it is the quantity that is helping the farm to minimize the total cost. So at how much is this farm incurring in terms of total cost, and if it accepts this quantity discount given, then what will be the total quantity cost that will be incurred? Will it be more or will it be high? So we are beginning by calculating the EOQ. This is question 2 part A. EOQ equals square root 2 DCO we divide by CC, where D is referring to annual demand, CO is referring to ordering costs per order, and then CC is referring to carrying stroke holding cost. That is per unit per annum. So we need to calculate all this from the question. In note number 1, we were told that the annual demand for the product is 30,000. So this will be equal to 2 multiplied by annual demand is 30,000. So our D in that case will be 30,000 times. CO is the ordering cost per order. In note number 2, we are told that the ordering cost per order is 2,500. We multiply this by 2,500 and we divide the whole of this by carrying costs or holding costs. And in note number 3, we are told that the holding cost is expressed at 20% of the purchase price. So we have 20%. And what is the purchase price? The purchase price is that price which is given at the lowest quantity possible. That is from unit 1 to 2000 under the range of quantities and price. We have 1 unit to 3000 and we were told that the price is 21. So that's the original price at which we consider as the purchase price. So we multiply this by 21. From there we simply calculate. This will give us 5,976 units. So the EOQ will be 5,976. That's the first step. Step number 2, we are to calculate the total cost. Total cost at the current situation. So at the current situation is where no discount is given. Where no discount is given. So to calculate total cost will be equal to, we use this formula, annual demand divided by ordering quantity. We multiply by ordering cost per order plus ordering quantity divided by 2 multiply by carrying cost per unit per annum. Then we add the purchase cost. The purchase cost. So this part where we have demand, annual demand of order quantity times ordering cost is representing the ordering cost plus the carrying cost, which is average inventory plus carrying cost per unit per annum plus the purchase cost, which is simply number of units purchased times the purchase price per unit. So we do that. Our annual demand is 30,000 units. We divide this by Q. So at the current situation, our order quantity is the economic order quantity which we've calculated in step number 1, and it is 5,976 units. We multiply this by the ordering cost per unit, which is 2,500. So we multiply by 2,500 plus quantity. This Q is the same as this Q, which is 5976 units. We divide it by 2 to get the average stock, and we multiply by the carrying cost per unit per annum. And we are told that the carrying cost is 20% of the purchase price. Where there is no discount given, the purchase price is equal to 21. So we are getting 20% of 21, and then we add the purchase cost, and the purchase cost is simply 30,000. The purchase cost will be plus 30,000 units multiply by the purchase price per unit, which is 21 shillings. So from there we calculate. We'll have 30,000 divided by 5976. This will give us 12,550 plus 5976 divided by 2 times, which will give us 12,550 plus the purchase cost, which is 30,000 times 21, and this is 630,000. So when you calculate that, the total cost equals 655 100, and this is the total cost where no discount is given. That's step number 2. We proceed on to step number 3 of the same question. So if the company has been given this range of quantities, then which is the right quantity the firm should consider so that it's able to minimize its costs? So once we have calculated the economic order quantity, disregard all the units that are falling above 5976. So according to the brackets, we have 1 to 3,000, we have 3,001 to 5,000, we have 501 to 7,000. Meaning our economic order quantity is falling in this bracket 5,001 to 7,000. So since it is considered the optimal quantity, so we are disregarding all quantities that are in that bracket, and therefore the bracket of quantities that we'll use to make the decision is only the 7,001 to 9,000 and the 9,001 to 10,000. And in this case, we use the lower boundary, not the upper boundary. So our intention is simply to compute the total cost for each order quantity. And therefore, we are beginning with order quantity 7,001. Total cost at order quantity 7,001. So the total cost will be equal to annual demand of order quantity multiplied by ordering cost per unit plus quantity, that's order quantity times carrying cost per unit per annum plus the purchase cost. So what's changing here is the order quantity. So our demand according to the assumptions will remain constant. So we'll have 30 units. We are dividing it by the order quantity in this case, which is 7,001, multiplied by the ordering cost, which remains constant, which is 2,500, plus our Q is 7,001 divided by 2 times the carrying cost is 20% of the purchase price. When you look at the question, the purchase price for quantities 7,001 to 9,000 is 15.5. So we'll have 20% times 15.5. Then we add the purchase cost, which is 30,000 units times the purchase price, which is 15.5. Then we simply calculate. So we'll have 10,000. This is 10,000. 713 plus plus 10,000 852 plus 465 plus 465,000. This will give us a total cost of 5,000. 486,565. So this is the total cost at order quantity 7,001. We also calculate the total cost at order quantity 9,001. So TC will still be D over Q times that, and therefore just substituting that with figures, our D is 30,000. Sorry, can still write the formula. We still have D over Q times CO plus Q over divided by 2 sorry, Q divided by 2 multiplied by CC plus PC, which will be equal to, demand remains constant, it does not change, divide by Q, which in this case is 9,001. Ordering cost remains constant, does not change, plus Q, which is 9,001 divided by 2. We multiply by the carrying cost per unit per annum, which is now 20%, and the purchase price in this case is 13 shillings. Then we add the purchase cost, which is 30,000 units. We multiply by the purchase price, which is 13 shillings. And then we calculate. This equals 8,332 plus 11,701 plus, and this will be plus 390,000, and the total cost will be equal to will be equal to 410,033. So once we have computed the total cost for that, we need to advise the management. So which order quantity will be the optimal quantity at which the firm should purchase its products. So where we do not have any discount given, the total cost is equal to 655,100. At order quantity 7,001, the total cost is 486,565, and at order 9,001, the total cost is 410 and 33,000. And therefore, we advise the firm. Can now advise the firm. So how do we advise? The firm should buy at order 9,001. The firm should purchase at order, should purchase the order quantity. The firm should purchase the order quantity of 9,001 to 10,000 units. Why should it do so? Because the firm will save the difference between the total cost where no discount is given and the lowest total cost, which is at order 9,001. So we have 655, 100 minus 410 and 33, which equals 245,067. So if the firm is to purchase at order 9,001 or between 1,000 and 10,000 units, it will be able to have the minimal cost, which will be at 410,333, and therefore it will save the difference at which it has been buying and that which it ought to buy, which is now 245,067. That's our part A of question number 2. We move on to question number 2, part B. Part B of question number 2. The question reads, Pendo Limited makes 3 types of metallic doors: security, house, and office, which are made from the same basic materials, steel bars and iron sheets. The standard unit cost and selling prices of the 3 types of doors are as below. So we have security, we have house, and then we have office. So we've been given information on direct materials, direct labor, and then unit selling price. Additional information, note 1, the sales for the month of December 2018 are as follows. The door type and then units. For security is 200 units, house is 200 units, and office is 160 units. Note 2, owing to an industrial dispute, suppliers of the iron sheets have estimated that only 5,124 square meters of iron sheets are available for the period. The iron sheets cost 1,000 shillings per square meter. Required, advise the management of Pendo Limited on the production mix of the 3 types of doors.
Welcome to Manifested Publishers.
Hello, candidates. Welcome back to our today's revision session. We are going to answer question number 2 of the May 2019 Fundamentals of Finance. The question is in 2 parts, A and B. I read question A. It says, firms strive to achieve objectives which at times overlap with each other and in some cases conflict with each other. With reference to the above statement, discuss 4 overlaps that could arise in the course of a firm's effort to achieve its objectives. 8 marks. Candidates, we know firms do business with the main aim of increasing shareholders' wealth or increasing profitability. But this question says that there are times when objectives overlap with each other and in some cases conflict with each other. So we have to identify some of these areas where there are overlaps, 4 areas, and let's do it. This is May 2019 question 2A. Question 2A. Four overlaps that could arise in the course of a firm's effort to achieve its objectives. Overlaps or conflicts that could arise, in the course of a firm's of a firm's effort to achieve its objectives. The first obvious conflict is that one of conflict between growth and profitability. Growth and profitability. To grow, candidates, to grow or to expand, to grow or expand, or to expand, for a company to grow or to expand in size, a business will need more money, which reduces profit. If you have invested in a company, at the end of the accounting period, the company will pay all the expenses, will pay all the taxes, will pay all the preference shareholders, will pay all the debenture holders, will pay interest. Then whatever remains is expected to be paid to the investors or the shareholders. At times, that money that shareholders expect to be paid in form of dividends, that money may be plowed back. So that is a conflict. Shareholders may need that money, but the company may also need the money for expansion, because profit or retained profit is a source of income. So that is a conflict. As much as a firm would want to expand, then that firm will require more money, and one of the cheapest sources of raising capital is internal source, and that is a conflict. Then number two, we can say shareholders wealth maximization, shareholders wealth maximization objective and managers' interests. The objective of maximizing wealth is key to the shareholders. At the same time, the managers, who are the custodians of the resources of the company, may want to increase their salaries, may want to increase their perks, and that is a conflict, because in case the management pays more in terms of the director's remuneration, then that will reduce the amount of wealth that should be allocated to the shareholders in form of dividends. So there is that conflict between shareholders' wealth maximization and the manager's interests. And the manager's interests could be the director's remuneration, manager's compensation, the allowances that the managers pay themselves, and so on. So there is that objective of maximizing the wealth of shareholders vis-a-vis the welfare of managers. This is a conflict, and sometimes we refer to it as the agency problem. There is always an agency problem between shareholders, who are the principal, and the managers, who are the agents. Then number three, the third point, is the corporate social responsibility towards the surrounding community, towards the surrounding community at the expense of the company's objective of wealth maximization. Sometimes there arises conflict as to whether the company should invest in corporate social responsibilities or to just focus on the key objective of maximizing shareholders' wealth or taking into account the interests of the other stakeholders. So that is an overlap, because remember, the resources are not unlimited. The company has limited resources. So choosing between investing in corporate social responsibilities and sticking to the key objectives of the company, that is an area where conflicts can arise. Number four is a cost-cutting measures such as job cuts, cost-cutting measures such as job cuts may be beneficial to the company, but detrimental or harmful to the employees. Whereas a company may choose to reduce the operational costs by firing or laying off employees, that may be beneficial to the company. The company may save on costs, but on the other hand, that will be harmful to the employee. So the objective of reducing the costs and the objective of satisfying employees who are key stakeholders. Employees are key stakeholders in a company. So there has to be a balance. As much as the company may want to lay off the workers, the company may be in a very difficult situation because of the harmful effects occasioned to the employees occasioned by such measures. So these are overlaps that could arise in cause of company's effort to achieve its objectives. Then part B says Umbo Limited is evaluating two mutually exclusive projects, A and B. Both projects are expected to cost 8 million shillings. However, an additional 1 million shillings investment in working capital will be required if the firm were to invest in project A and 1.5 million shillings for project B. Full stop. Project A has an estimated useful life of 5 years, while project B has an estimated useful life of 4 years. Estimated net operating cash flows from each investment in each year are given as follows. So we have year 1, year 2, year 3, year 4, year 5. Then there are the cash flows, project A and project B respectively. Additional information. Number 1, the resale values of project A and B at the end of their useful life are estimated at 200,000 shillings and 300,000 shillings respectively. Number 2, cost of capital is projected at 14%. Required 1, net present value of project A and project B, 10 marks. 2, advise the company on which project to undertake, 2 marks. So net present value present value method is a technique that we use in evaluating capital projects, evaluation of capital projects. And we have two projects, and these projects are mutually exclusive projects. That means if project A is undertaken, then project B will not be undertaken. And we can see the details are provided there. And we need to calculate the NPV for project A first, then project B. We know NPV is equal to the difference between the cash inflows and cash outflows, net present value. We get the present value of cash inflows and present value of cash outflows. The cash outflows here, we are told the initial capital which you have provided. Then we also have the investment in working capital. That is an outflow. There are two categories. Then the inflows provided estimated net operating cash flows or estimated net. That means that the necessary deductions have been made, like depreciation and other costs. So what we have here are just net, which we will discount. We are going to discount and get the present value of this net operating cash flows. Then the difference will be the NPV, that is NPV, net present value. We are answering question Roman 1. This is B Roman 1. Let me just indicate it. B Roman 1. Roman 1. The NPV, it says NPV for project A. Let's start with project A. NPV for project A. NPV for project A, we have the number of years. We have the cash, net operating cash flows. These are cash inflows. Then we will discount these cash inflows using the present value interest factor, 14%. N, is it 14%? The discounting rate is, yes, 14%. And then we'll have here the present values. The figures are in thousands, so we have thousands. Yes, the cash outflows, the discounting. That's how we do it. Very important. Year 1, year 2, year 3, and year 4. We have project 1 goes up to year 5. Year 5, the first cash flow 2.5. Then we have 3 million, 3.5, 2.8, 2.8 million, and 2 million. So the present value we check from the tables provided, 14% 1 year, 14% 1 year. This is 0.8772, next 0.7676, this is 0.7695. Year 3, I have 67, 0.67, 6750. Next I have 0.5921, then 0.5194. So these are the discounting factors. So I'll take my machine and and get the present values. Get the present values. This is 25 times 0.8772, 29, 2193, 3000 times 0.7695, 23, 08.5, 35 times 0.6750, 23, 62.5, and I have 28 times 0.5921, 16, 57.88, 2000 times 0.5194, 5194 is 138.8. So these are the present values after discounting the cash inflows. This money will be received at the end of year 1. So we need to get the present value by discounting, bring it to the present value terms. So we're done for the 5 years. Then at the end of year 5, again, there is the resale value of this project. We have the resale value. This should be the machine resale value. The note number 1, the resale value of project A and B at the end of the useful life is 200,000 and 300,000 respectively. So this is 200,000. We discount at 0.5194. These are 5 years. So we multiply 200,000 times 0.5194. This is equal to 10,3.88. So these are the total cash inflows. So we get the total cash inflows. Total cash inflows, we are going to add 2193 plus 2308.5 plus 2362.5 plus 1657.88 plus 1038.8 plus 10.88, total 9664.56. These are total cash flows. Total cash flows. Then this is cash flows expected. Then we deduct we are going to deduct from this. We are going to deduct the initial investment. Initial investment, we have the initial. We have the initial capital, then investment in working capital, which we read here. Both projects are expected to cost 8 million. So we'll have 8 million. We deduct 8 million. We deduct the however, an additional 1 million investment in working capital will be required in project A. This is 1 million. We again deduct 1 million. These are cash outflows. So we deduct the cash outflows. That is 9 million. The total here is 664.56. 6. That is the NPV of project A. So let's now do the NPV for project B. NPV for project B, the same manner. We are going to have the years. We're going to have, these are 4 years. 4 years. Then we have the cash flows. Then we have the present value interest factor. Then we have the, that is at 14%. 14%. Then we'll multiply, we will discount to get the present value. Year 1, 2, 3, 4, 5. The cash flows from the question 3.5, 3.5. 3.5. This is an annuity candidate. This is an annuity. This is an annuity. This is an annuity. 3.5 in thousands. 3.5. 3.5. 3.5. There are 4 years. The discounting factor 0.8772. This one here, 0.765, 0.6750. Then year 4, 0.5921. So we'll multiply the cash out inflows by the present value interest factors to get the present value. To get this present value here, I have 35 times 0.8772. The answer here is 3070.2. Then I have 35 times 0.7695 is equal to 2693.25. These are thousands. And then 35 times 0.6750 is equal to 2362.5. Then I have 35 times 0.5921 is equal to 2072.35. Then at the end of year 4 candidates, just like in project A where there was a resale value of 200,000, at the end of year 4, remember the resale value is 300,000. We discount it at the this rate is a discounting factor of 0.5921. So I'll have 300,000 times 0.5921. So 7.63. The total will be 2072.35 plus 2362.5 plus 2693.25 plus 3070.2. Total 10,375.93. These are total cash inflows. So we're going to deduct the cash outflows. These are less cash outflows. Cash outflows. The first one was the initial capital of 8 million. point here, we deduct. Then we deduct the working capital. Working capital. The working capital. At the start, we have a working capital. Project B, from the information there, is 1.5 million. It's 1.5 million. 1.5 million. Deduct 1.5 million from that amount. 8. This is 8 million minus 1.5 million. 1.5 million. The total here is 875.93. So that is our NPV for project B. Now, part 2 of part B required the candidates to advise the company on which project to undertake. This is Roman 2. Advise which project to undertake. Under the NPV technique, the project that yields the highest NPV should be undertaken. We've been informed in the question these two projects are mutually exclusive, meaning if one project is undertaken, the other one will be foregone, will not be undertaken. But if the projects were not mutually exclusive, then it is advisable that the company undertakes both projects because they both yield a positive NPV. Under the NPV technique, the decision criteria is that the project with the highest NPV should be undertaken if you are comparing more than one project. But if you only have one project, then the decision criteria is that if the NPV is positive, then the project should be undertaken. But if the NPV is negative, that project should not be undertaken. If the NPV is 0, then the investor will be indifferent. That means can either undertake the project or reject the project. So negative NPVs projects with negative NPVs are rejected. Projects with positive NPVs are undertaken. If you have more than 2 projects which are mutually exclusive, the one with the highest NPV that should be undertaken. But if the projects are not mutually exclusive, if the projects are independent, then the company should undertake both projects. So in this case, these are mutually exclusive projects. Therefore, project B should be undertaken, and the reason is undertaken because it yields the highest NPV, the highest NPV, and that will mark the end of that question. Is 2 marks. This can earn you 2 marks. Then the other one is marks, which means 5. Okay, these are marks. This is 10 marks. Then part A, how many marks? These are 8 marks, 0.2 marks. These are 3, 4, 8 marks. So 8 plus 10 plus 2, 20 marks. In an exam, if you have such a question, you can see here I have repeated in an exam because of time. Have this column in the second project. Just have it in one row. You don't need to repeat this column. Have here 1 year column, the cash flows. This is uniform, the other side. You only apply this to this, like that. Then you have another column where you have the cash flows for project B. Then you apply the same present value interest factors to the first, and that can all be to do practice. You need to practice more questions. When you do that, you will move very fast. So that is the solution to question 2, and that is a question from the topic capital budgeting decisions under certainty. These are, we also summarized many questions in this book, which you need to go and practice. In May 2017, there was a question. Land Limited is considering its capital budget for the following information relates to 4 mutually exclusive projects. So here they are. Additional information: the farm selling 20 million and the cost of capital 10 million. The cash flows are assumed. Advise the company on the project to undertake using the following investment appraisal techniques: NPV and profitability. To practice 2 projects. Here there are projects: project P1, P2, P3, P4. Then in 2016 again, there is a question requiring each of the following investment evaluation criteria. There is the NPV, there is the internal rate of return, and the payback period. So these are one question you are supposed to advise based on 3 techniques. In advising on investment projects to undertake using the internal rate of return. Internal rate of return, what is the criteria? You need to know the criteria, because you cannot advise if you have no information about the criteria. Then May 2016, here there are 5 projects. The management of Raha Limited is evaluating 5 investment projects whose expected cash flows are shown below. Project B, C, D, E. Then cash flows are given, tax and depreciation. The required rate of return is 16%. Using the NPV approach, determine the projects that should be undertaken, assuming capital would be available when required. In the other case, there was a limit to capital. In May 2017, the firm has a capital budget. The capital that is needed will be available. The capital would be available when required. Then what else do we have? There are enough questions for other than the past paper questions. We have analyzed and summarized other questions, help you in revision. Questions on testing on IRR. We have questions testing on NPV, additional questions on NPV, additional questions on payback period, another question there on payback period. We have additional question here on the accounting rate of return, right? There is a question, then you are supposed to advise based on the accounting rate of return. Then there is also another question on IRR and NPV, SERE 25% or cost of capital and requiring initial investment of shillings. Annual savings will be 70,000 shillings for the next 4 years. Required. Calculate the IRR of the project at 25%. These are good questions for your revision, and I can go on and on. We did a good work in doing this book, candidates. We have looked for questions. These are 23 questions. The last question: Salem Limited has 150,000 shillings to invest in a project which will generate 5 cash flows are shown. The company's expected interest rate of this % per annum required. Calculate the PI of the project using the present value annuity factor. So make sure you bond with this book, which is known as a revision partner. This book is meant to be your partner indeed. Times for revision, and those who are coming out continuous revision when revising. Thank you for and in our next lesson, answer the next question, question number 3. In the meantime, go answer all these questions. Okay, answer these questions, and we have on our website shown you how to revise. Don't just answer all the questions once. Space your revision. If you answer 2 questions today, tomorrow answer 2 questions, but make sure it's spaced until exams. And after you've done that, then attempt question number 3 before attending the next lesson. When we'll be answering here on the board, we'll be marking. So thank you and bye-bye. Hello, I greet you all from wherever you are, and I'm glad to welcome you to the revision of auditing and assurance paper, September 2021. In our last session, we answered question 1. Today, we will proceed to suggest solutions for question number 2. I'll first answer question 2A, which says, distinguish between reasonable assurance engagement and limited assurance engagement. 4 marks. Distinguish between reasonable assurance engagement and limited assurance engagement. Now, candidates, what is an assurance engagement? An assurance engagement is defined as an engagement in which a practitioner aims to obtain sufficient appropriate evidence in order to express a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the subject matter information. All right? That's the meaning of assurance engagement. And just to help you understand, candidates, what's the meaning of assurance in this context? Now, assurance, candidates, is a measure of the level of certainty that the auditor has obtained at the completion of the audit. It is a measure of the level of certainty or the level of confidence that the auditor has obtained at the completion of an audit. The question is, distinguish between reasonable assurance engagement and limited assurance engagement. That is the question. Distinguish. This is question 2. Question 2A. Distinguish. Distinguish between reasonable assurance engagement and limited assurance engagement and reasonable. Candidates, distinction sometimes can be made on the basis of the definition of terms. So by defining reasonable assurance engagement and defining limited assurance engagement, that can earn you a mark. So what's an assurance, reasonable assurance engagement? Candidates, a reasonable assurance engagement is defined as an engagement in which the practitioner reduces engagement risk to an acceptable low level. Let me have the distinctions in form of a table. Let me have them in form of a table. So that here we have reasonable, assurance engagement, and limited assurance engagement. I've just defined reasonable assurance engagement as an assurance engagement in which the practitioner reduces engagement risk to an acceptable level. The practitioner here is an auditor. So the first distinction is that the practitioner reduces the assurance engagement risk to an acceptable low level, in the circumstances of the engagement as the basis for a practitioner's conclusion. A limited assurance engagement, on the other hand, is a reduction in assurance engagement risks to a level that is acceptable in the circumstances of the engagement, but where that risk is greater than that for an reasonable assurance engagement. So for limited, the engagement, the audit, or let me say the assurance engagement risk is higher compared to the reasonable assurance engagement. The assurance engagement risk for a limited assurance engagement, the engagement risk is higher or greater than for reasonable assurance engagement. Why? Because the basis, it forms the basis for a negative form of expression of the practitioner's conclusion. That is the first distinction. That one is on the basis of the assurance engagement risk. In the first instance, it is low. In the second instance, is high. And we'll be seeing why that is the case by just looking at the second distinction. The second distinction is in relation to the level of testing. The level of testing. In the reasonable assurance engagement, analytical procedures are performed to identify material misstatements. Analytical procedures are designed and performed in such a way that the tests or the procedures can identify material misstatements. Now, for the limited assurance engagement, analytical procedures may be designed, but in this case, it's not for the purpose of identifying material misstatements, but to support expectations regarding the trends, the relationships, and ratios, and not to identify material misstatements. So here, analytical procedures are designed and performed to support expectations, regarding the direction of trends, regarding direction of trends, etc., and so on. The analytical procedures, which are just testing. Testing is designed, procedures are designed not to identify material misstatements, but to support expectations regarding direction of trends and also relationships and ratios, rather than to identify misstatements with the level of precision expected in a reasonable assurance engagement. Here, the level of precision is higher because of the level of testing. Many documents, many tests are carried out when carrying out reasonable assurance engagement compared to limited assurance engagement. And that's why the risk is higher in limited assurance engagement as compared to the reasonable assurance engagement. That is the second distinction. The third distinction, number 3, gives a positively worded assurance opinion or report. Reasonable assurance engagement gives a positively worded assurance opinion. For example, it can say that having examined the financial statements of company A and ABC Limited, it is in our opinion that the statements portray a true or fair view, or it does not portray a true or fair view. That's a positively worded assurance. But for limited assurance engagement, it gives a negatively worded assurance opinion. Gives a negatively worded assurance opinion. It gives a negatively worded assurance opinion, for example, that nothing has come to our attention, that the financial statements have not been prepared according to the framework. That is a negatively worded opinion. That nothing has come to our attention, that the financial statements have not been prepared according to the framework. But this one, the opinion is positive. It states that, for example, that having examined the financial statements of ABC Limited, it is our opinion that the statements do not portray a true or fair view. That's a positive. It can be a positive in that sense. But for the limited assurance engagement, the opinion is negatively worded. That's why it gives a low level of assurance. It gives a low level of assurance. It gives a low, that's another distinction, low level of assurance. in a limited assurance engagement, as the name suggests, it gives a low level of assurance, and the reasonable assurance engagement gives a higher level of assurance. Reasonable assurance engagement gives a higher level of assurance as compared to limited assurance engagement. It gives a higher level of assurance that audited information is free from material misstatements, or that audited information is not free from material misstatements. So these are the distinctions the examiner was not specific as to how many distinctions to give. If that is the case in an exam, if you have points, make sure you give as many points as you can, because here, be guided by the marks. Be guided by the marks. In my case, I assume that this would earn half a mark, 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 half a mark. So these are 4 marks. 4 marks. So that is how to earn 4 marks. Then question 4, question 2B, I'm going to answer question 2B. International Standard on Auditing, ISA 705, modifications to the opinion in the independent auditor's report sets out the different types of modified opinions required. With reference to the above statement, discuss 3 ways in which an auditor's opinion may be modified. 6 marks. You can see here, candidates, the examiner was clear on the points. It says 3 ways, 3 ways, 3 ways, all right, in which an auditor's opinion may be modified. This is part B. Ways in which an auditor's opinion may be modified. This question tested the candidate's knowledge on ISA 705, which is in relation to modifications to the opinion in the independent auditor's report. And candidates ISA 705 establishes 3 types of modified opinions. Number 1 is the qualified opinion. Number 2, adverse opinion. Number 3, disclaimer of opinion. There are 3 types of modified opinions. Number 1 is the qualified opinion. Qualified opinion. Now, the first one is qualified opinion. The second one I said is adverse opinion, and the third one is disclaimer of opinion. So let's first look at the qualified opinion. Candidates, under the qualified opinion, the auditor expresses a qualified opinion when he or she, having obtained sufficient appropriate evidence, concludes that misstatements, either individually or in the aggregate, are material but not pervasive to the financial statements. Qualified opinion, I repeat, is where the auditor, having obtained sufficient appropriate evidence, concludes that misstatements are material, where he concludes that misstatements are material misstatements are material either individually or in aggregate, but not pervasive. But not pervasive to the financial statements. But not pervasive to the financial statements. Or this is one, or two, that or number two, that the auditor is unable to obtain sufficient appropriate audit evidence. Not able to obtain sufficient appropriate audit evidence, where the auditor is not able to obtain sufficient appropriate audit evidence on which to base his opinion, but the auditor concludes that the possible effects on the financial statements of undetected misstatements, if any, could be material but not pervasive. So a qualified opinion is issued in two circumstances. Number one, where the misstatements are material but not pervasive to the financial statements, or where the auditor is not able to obtain sufficient appropriate evidence upon which to base his or her opinion, but the auditor concludes that the possible effects on the financial statements could be material but not pervasive to the financial statements. That is a qualified opinion, which is a modified opinion. The second modification is adverse opinion. Adverse opinion. Adverse opinion. When is an adverse opinion issued or given? Now, this is where the auditor you can say, expresses an adverse opinion when he or she, having obtained sufficient appropriate audit evidence, concludes that misstatements, either individually or in aggregate, are both material and pervasive to the financial statements. So an audit opinion is issued where the misstatement is both material and pervasive to the financial statements. And this can either be individually, material individually, or can be in aggregate. The third modification is disclaimer of opinion. Disclaimer of opinion. Disclaimer of opinion is another modification. Now, candidates, the auditor, we can say, shall disclaim an opinion when he is unable to obtain sufficient appropriate audit evidence on which to base his or her opinion, and that the auditor concludes the possible effects on the financial statements of the undetected misstatements, if any, could be both material and pervasive. Could be both material and pervasive. So in that case, the auditor disclaims his or her opinion. We can say he does that in extremely rare circumstances, involving multiple uncertainties, where the auditor is faced with multiple uncertainties. That is when we can say he can disclaim his or her opinion. And the auditor may conclude that notwithstanding having obtained sufficient appropriate audit evidence regarding each of the individual uncertainties, it is not possible to form an opinion on the financial statements due to the potential interaction of the uncertainties and their possible cumulative effect on the financial statements. So a disclaimer of opinion, in long and short of it, is issued where the auditor is not, where he is not in a position to form an opinion on the financial statements. It is issued where the auditor is unable to form an opinion on the financial statements. Where the auditor is unable to form an opinion on the financial statements. The reason could be limitation of scope. It can be uncertainties where he does not have sufficient evidence upon which to base his or her opinion. Then he can issue a disclaimer of opinion where he is not in a position to give an opinion because of various uncertainties. Then the auditor shall disclaim his or her opinion, all right? Where it is not possible to form an opinion on the financial statements due to the potential interaction of uncertainties and their possible cumulative effects on the financial statements. So these are three modifications. That is part B. With reference to the above standard, discuss three ways in which an auditor's opinion may be modified. These are the three ways: qualified opinion, and we've stated two circumstances here, 1, 2. Then there is the adverse opinion. Then there is disclaimer of opinion. These are 6 marks. 6 marks. Now moving on to part C, which says define the term going concern as per International Standard on Auditing, ISA 530. C Roman 1, C Roman 1, C Roman 1, define going concern. Define going concern. Now, candidates, under this basis of accounting, the financial statements are prepared. The financial statements are prepared on assumption that the business will continue. The business will continue for a foreseeable future. That is the going concern concept. Under the going concern basis of accounting, candidates, the financial statements are prepared on assumption that the entity is a going concern and will continue its operations for the foreseeable future, and will continue its operations for the foreseeable future, will continue its operations, will continue its operations, will continue its operations for a foreseeable future. And candidates, going concern assumes that an entity, in other words, will continue in business for the foreseeable future with either the intention nor the necessity of liquidations or ceasing trading or seeking protection from creditors. And therefore, assets and liabilities are usually recorded on the basis that the entity will be able to realize its assets and discharge its liabilities in the normal way of doing business. That is the going concern. How many marks? 4 marks. Are they 4 marks? These are just 2 marks. 2 marks. 2 marks. 2 marks. Then that is C1. C2, propose 4 responsibilities of auditors with respect to going concern. Responsibilities. Now, the first responsibility of auditors in respect to going concern is to gather sufficient, appropriate evidence, to gather sufficient and appropriate evidence regarding and conclude on the appropriateness of management's use of going concern basis of accounting. It's important for an auditor to ensure that he has appropriate evidence that the management has complied or prepared the financial statements based on the going concern basis. And we say that the going concern basis assumes that the financial statements are prepared on the assumption that the business will continue its operations for the foreseeable future. So that is one responsibility of auditors in respect to going concern. It's important to check if management has used the going concern basis of accounting. It should gather sufficient appropriate evidence to ascertain that the management has prepared the books on the basis of the going concern accounting, okay, in the preparation of the financial statements. Are the financial statements been prepared on the going concern basis? That's a question that the auditors should endeavor to answer, and that's the responsibility that they need to ensure that the company has prepared the financial statements based on the going concern assumption. The second responsibility is to conclude based on the audit evidence obtained whether a material uncertainty exists about the ability of the entity to continue as a going concern. That is the responsibility of the auditors, to conclude whether a material uncertainty exists, to conclude whether a material uncertainty exists, whether a material uncertainty exists about the entity's ability to continue as a going concern. The third responsibility is in relation to risk, to assess risks faced by the organization, because risks can pose a danger on the ability of an organization to continue doing business in the foreseeable future. So that is auditor's responsibility, to assess if there is any risk that the organization faces that can threaten the going concern of the company. So these are three responsibilities. Three responsibilities. How many marks? These are responsibilities of an auditor. 1, 2, 3. These are three responsibilities. Candidates were expected to give propose four responsibilities. Let's have the fourth one. The fourth responsibility is can be in relation to post-balance sheet events. The auditors have a responsibility to assess post-balance sheet events, assess post-balance sheet events. We can add another responsibility in relation to going concern is to identify factors affecting going concern. They have a responsibility to identify factors affecting going concern. The sixth responsibility can be report to the audit committee. Report to the audit committee. The auditors have a responsibility to report to the audit committee if the auditor believes that the going concern assumption has not been used appropriately. These are additional responsibilities. Additional responsibilities. So any 4 here would earn the 4 marks. That's part C. Part D, discuss 4 ways an internal audit function of a government entity would achieve independence in conduct of its function in relation to the internal audit guidelines for national government entities in your country. D, what is the question? Ways an internal audit function would achieve independence. Ways an internal audit function would achieve independence. We'll begin with the head. The head of the internal audit function, the head of the internal audit function should report administratively to the accounting officer. The head of the internal audit function should report administratively to the accounting officer of the entity and functionally to the audit committee. And functionally to the audit committee. For example, candidate, when it comes to matters of administration, like availability of resources, staffing, and so on, those functions can be, the head of the internal audit function can liaise with the accounting officer. But when it comes to performance of the function of the internal audit function, then the head of the internal audit function should report to the audit committee. By doing that, then the internal audit function would achieve independence, The second way in which internal audit function can achieve independence is that the accounting officer should ensure that the organizational structure of the internal audit function facilitates the entity to accomplish its internal audit functions, okay, or responsibilities. The accounting officer, here we've said that the head of the internal audit function should report administratively to the accounting officer. The second point is that if the internal audit function is to achieve independence, then this accounting officer should ensure that the internal audit function is facilitated, it is staffed, resources are made available, the organization structure, okay, is the administrative structure of the internal audit function facilitates the entity to accomplish its responsibilities. Another point is that another way in which an internal audit function would achieve independence is that the internal auditor should have unrestricted and prompt access to all records. Unrestricted should have unrestricted and prompt access to all records. The internal audit function can be independent if it has not just unrestricted but also prompt access to all records. Prompt access to all records. The third way, number 3, the third way in which the internal audit function can function independently is that the internal auditor shall respect the confidential nature of information and use such information with discretion and only insofar as it is relevant to reach an audit, internal audit opinion. This is in relation to confidential information. Confidential information. Confidential information. Another way is that all internal audit activities should remain free of influence. Free of influence. Should remain free of influence. All the activities of the internal audit function should be free of influence by any element in the organization, including matters of audit selection, matters of scope, matters of procedures, matters of frequency, timing, and also report content in order to permit maintenance of an independent and objective mental attitude that is necessary in rendering reports. So these are ways, 4 ways in which audit function of a government entity would achieve independence. 4 marks. 4 ways, 4 marks. 1, 2, 3, 4. 4 marks. 4 marks. Thank you, candidates, for attending today's session. We've answered question number 2 that was done in September 2021. In our next session, we are going to answer question number 3, which is again in 3 parts, A, B, and C. Make sure you attempt it before attending our next session. God bless you. Bye-bye.
Welcome to this session of revision. This is block release revision. I am Mr. Clement Kenodia. I'll be taking you through revision in auditing and assurance. Today, we are looking at November 2017 questions. And right away, we start with question number 1. It has got 3 sessions, A, B, and C. Checking them through. A. Auditors carry out various audit assignments. In relation to the above statement, explain 4 non-assurance assignments that auditors undertake. This question number 1 is tested from topic number 1, which is on assurance engagements, where the examiner requires us to highlight 4 examples of non-assurance assignments. We talk of assurance engagements where practitioners are required to give an opinion, non-assurance engagements where practitioners are not required to give an opinion at all. So highlighting them, this is question number 1, November 2017. Question number 1. We are answering part A, which requires us to highlight 4 non-assurance assignments. They include Roman number 1, compilation of financial and non-financial information. This is basically preparing financial statements because we are not required to form an opinion at all, so it qualifies to be a non-assurance engagement. Roman number 2, we talk of agreed upon procedures. Agreed upon procedures engagement. Basically, this is where the practitioner will be called upon to indicate, for instance, how an entity acquired an asset, how an entity disposed an asset without forming an opinion. Roman number 3, we talk of management and consultancy services. When you are offering management and consultancy services to the client, again without forming any opinion. Roman number 4, item number 4, when you perform tax issues and compilation of the same without being required to form an opinion. We can highlight the 5th point the examiner required for risk assessment. Risk assessment, when you're called upon to maybe update the risk profile of the client, capturing the risks which the client is exposed to. We can even capture Roman number 6, the bookkeeping engagements. A common feature of all these types of engagements is that the practitioner is not required to form an opinion. When they are required to form an opinion, then they cease to be non-assurance engagement. We categorize them, we classify them under assurance engagements. That's part A of this question. Part B, testing on totally different topic, reads, Describe 3 circumstances in which the management of an organization might request the auditor to change the terms of an audit engagement. I take it again. Describe 3 circumstances in which the management of an organization might request the auditor to change the terms of an audit engagement. This is coming from topic number 3, which discusses planning and conduct of an audit. And during audit exercise, when the client calls upon an auditor to take up an engagement, auditors are required to prepare an engagement letter. Engagement letter is captured so well, this is question number 1, part B. Engagement letter is captured so well in International Standards of Audit 210, engagement letter. Engagement letter. Just a reminder, it's a letter which will be prepared by the auditor to the management, indicating acceptance of the engagement. Now, the examiner is asking us to capture instances where the auditor may be required to change the terms of an audit engagement. So we already have an engagement letter, but there are circumstances which may require that the auditor changes the terms of the engagement letter. They include, number 1, when the auditor feels that the client misunderstanding the contents of the engagement letter. Engagement letter with regard to the scope and objectives to be achieved. So if the auditor feels that the client misunderstood the scope and the objectives to be achieved in audit, then the auditor will be required to draft a new one which puts it very clear on the issues of misunderstandings. Roma number 2, when there are change in professional pronouncements. Yes, change in professional pronouncements which affect the nature and scope of the audit. So when we talk of change in professional pronouncements, we are talking of changes in international accounting standards, changes in international standards of audit, change in local registrations, which affect the audit in one way or another. We need to draft a new one to incorporate those new changes. Roma number 3, we can talk of change in management or change of management. Change of management, basically stroke ownership. Yes, when there is change of ownership, it means we have new management in place. And this new management in place are not privy. They are not privy to the previous arrangement. So the auditor will be required to draft a new one incorporating the new management. Roma number 4, examiner required 3 points. We can always add another one here. When there is change in size or operations. Change in size or operations in the client's operations. So again, there could be either internal changes, external changes, which might require that we draft a new engagement letter. That's question number 1B, checking on instances where the auditor may be required to change the terms of an audit engagement. Part C, it reads, Kisomo Kizuri is a charity organization that raises funds for educational projects. Charities in the country from which Kisomo Kizuri operates have recently become subject to new audit and accounting regulations. Your firm has been appointed as Kisomo Kizuri's new auditors required. Analyze 5 audit tests you might carry out on the income and expenditure from fundraising events. I take it again. Analyze 5 audit tests you might carry out on the income and expenditure from fundraising events. This is a question tested from topic number 4, internal control systems of an entity. And just to remind you, we said that internal control systems are policies and procedures put in place by management for purposes of achieving management objectives. Those are the controls we are looking at. This is part C. This is part C. And now we're being told this is a case study. It's a case study relating to Kisomo Kizuri, which is a charitable organization. They are collecting some funds, and we are required to indicate audit tests that we may carry out on the income and expenditure. So to ascertain whether what has been captured in the books of accounts, basically income statement of Kisomo Kizuri, portrays true and fair view, which tests as auditors do we need to carry out? So we are required to capture audit tests. Audit tests in the income statement of Kisomo Kizuri entity. Number 1, very important, to get first-hand information about how the fundraiser is taking place, we need to attend the fundraising. Attend the fundraising activity. The relevance of this test is to ensure that you get the first-hand information on how it is being carried out, the transparency with regard to conducting of this fundraising activity. That's very important. You are getting primary evidence which you corrected yourself as an auditor. Number 2, very important, perform the cash count. Perform the cash count. The persons responsible in correcting the funds, they will maintain a record of how much they are correcting. So as an auditor, you need to perform the calculation once more to correspond, or basically to compare with what has been captured in the records, to test on the accuracy. Roman number 3, we need to inquire or examine the bank pay-in slip and bank statements. We want to confirm, have they deposited all the monies corrected during the fundraising? We want to assess the transparency and accountability. Were they able to deposit all the monies corrected in the fundraising activity? Roman number 4, check through the income statement. Check through the income statement against the budget. Before any spendings, before correcting any revenue, an entity will have prepared a projected cash flow statement capturing inflows and outflows. So what we are doing in our stage number 4, we are comparing or checking through the figures captured in the income statement against the budgeted in the income statement. Any discrepancy, any differences, we need a proper explanation from the responsible official. Then lastly, Roman number 5, what you're supposed to do, examine records of income statement. Examine records of income statement to confirm authorization. Of course, income statement will capture revenues and expenditures. So we are concerned with the expenditures. Who confirmed? Is there proper authorization and approval to spend in Kisomo Kizuri Charitable Organization has a responsible official authorized or confirmed expenditure of funds in this entity. That's what the examiner was looking for. Basically, that question was awarded 10 marks to be able to capture these 5 points. To take you very fast of what you've just captured, question number 1, November 2017, part A, testing on assurance engagements. The examiner was looking for 4 non-assurance assignments that an auditor can undertake. A special feature of non-assurance engagements, practitioner is not required to form an opinion. They include compilation of financial and non-financial information. Number 2, agreed upon procedures engagements. Number 3, management and consultancy services. Number 4, tax issues and compilation of tax-related issues. Number 5, risk assessments. And number 6, bookkeeping engagements, where no opinion is being formed. This was tested from topic number 1 on assurance engagements. We have part B, which was testing on topic number 3, planning and conduct of an audit, where we are required to highlight, the students were required to capture instances where the auditor may be required to draft a new engagement letter, which includes number 1, when there are issues of misunderstandings which needs to be clarified. So the auditor will prepare another engagement letter demystifying or shedding more light on the nature, scope, and objectives of the audit. Loma number 2, changes in professional pronouncements which affects to a great extent the nature and the scope of the audit. Change of ownership, because the new ownership is not privy to the previous arrangement. We need to prepare a new engagement letter incorporating the new management. Again, where there is change in size or operations in the client's business, basically which affects again the nature and the scope of the audit, we need to draft a new one incorporating those new changes in the client's operations. Part C of this question, internal control systems, which is our topic number 4 in our syllabus. We have Kisomo Kizuri, a charitable organization which is raising funds, and we are required to indicate the audit test that we are required to carry out in the income statement. Number 1, very important, to be able to gather primary evidence, we attend the fundraising activity to confirm how it is being carried out, the transparency, and the persons who are taking charge during the event. Number 2, we are performing cash count to verify whether it corresponds with the figures captured in the records maintained. We are testing the accuracy. Number 3, we are examining the bank pay-in slips and the bank statement. We want to confirm the much deposited in the charitable organization's bank. Of course, it should tally with the cash collected. Number 4, we are checking through the income statement against the budget. Very important that if there are any variances, any discrepancies, we need to seek explanation from the responsible officials. And lastly, number 5, we examine the records of income statement to confirm authorization. Very important that responsible senior officials of an entity should confirm or else should commit the organizational resources by way of approval and authorization. We come to the end of session 1, where we've answered question number 1, November 2017. I remain yours, Mr. Clement Kenodia. In our next session, we'll be handling question number 2. Thank you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Ningwiri, and today we are discussing about the financial modeling and data analytics paper which came out in March 2023 as a pilot paper, question 23. The reads as follows. Company XYZ issued a bond to finance its expansion plans. The bond has a face value of 1,000, a coupon rate of 5% per annum, and a maturity date of 31st December 2028. The bond pays a semi-annual interest payments. The bond is trading at 950 as at 31st December 2022. The time to maturity as a result is 6 years. Using Excel, build a financial model that includes the following statistical and analytical aspects. A. Calculate the bond's yield to maturity using Excel. B. Calculate the bond's modified duration using Excel's duration function. C. Using Excel's data table feature, plot a graph that shows the bond's price sensitivity to changes in interest rates, assuming the range of interest rate changes from -2% to 2%. Plot a line chart that shows the bond price as a function of the interest rate. The x-axis should show the range of interest rates and y-axis should show the bond price. Save the chart on the worksheet. So we'll move over towards the right of your screen right here where the solution, and we can be able to answer part A right here. So A. We're told to calculate the bond's yield to maturity using Excel. So what we're going to do is that we're going to come over here and first of all indicate the values that we actually need. We need the face value there. Then we are going to also be required to put in the bond price. We'll also be required to get the coupon rate there. Moving on, we need then to also get the annual coupon. Then we move ahead and indicate the current date. And then we put in the maturity date. We also need the years to maturity. And finally, we'll need now to compute the yield to maturity. So we double click there, then we put it in form of a table like so. Come right here, we can click all borders, and then the outside border we can be able to put a thick outside border like so. So we can then now put in the values as required over here. This is where we want our answer and what we've been requested to compute the yield to maturity using Excel. So we come over here and perhaps put maybe a very light color that shows that that is going to be our answer. So the face value, in this case, we're going to put 1,000. That. The bond price, we're told that the bond is trading at 950. So 950. That. And then we're saying that the coupon rate, a coupon rate of 5% per annum, so 5% and per annum. So just put the coupon rate, so this is annual, 5, so you can just put it as percentage, and right over here, we just click on percent, right here, 5, so that's 5% per annum. So the annual coupon is just going to be, we're just going to multiply that value, which is the coupon rate, and then we multiply against the par value. Against the par value or the face value right there. So that's the annual coupon. So then we slot in the current date. From the question, we can see that we have been given the maturity date as at 31st December 2028. The bond pays semi-annual interest payments like that. The bond is trading at 950 as at December 31st, 2022. So the current date is 31st December 2022. So 31st December 2022. That. So that's the date there. The maturity date is given to us over here as 31st December 2028. December 2028. That. And so once we have the maturity date, we then need to see the years to maturity. How many years are remaining towards maturity? So we pick the maturity date over here. You can see it's 6 years. It's actually given to us here in the question. So it's 2022 to 2028. That. So 6 years too, like that. For us to be able to compute, then we can just move towards the right over here, the screen. This. For us to compute the yield to maturity, what we need to know, the yield to maturity, TM, is given as, we will first of all need to get the coupon rate, C, and then we add now this component that is over here like that. We're going to get the face value, then we subtract the present value or the current price, so minus PV right there, and then this part that is in brackets, it should be divided against N, which represents the years to maturity, N, like that, and this entire part right here like that should be divided. Use this feature over here, just underline like that, or you can just use the borders. We divide that against face value plus present value and this is being divided by 2 over 2. That's how we calculate the yield to maturity. So just come over here and margin center over here like this, and then we put it towards the center there. So that's how we compute the yield to maturity. So let's put it right in this box over here. So we need the coupon rate over here plus the coupon rate there, and then we add the face value. So we need to first of all open a brackets over here like this, plus then we open a bracket right over here like this again, because this component will be divided, this component over here will be divided by N over here. So the face value that we subtract the present value, which is the bond price over there like that, and then we are dividing that by N like that. So this one we divide by over the number of years, which you're seeing N represents the number of years to maturity like that. So we're saying it's going to be this part over here like this. So just put it like so, open the brackets over here like that, and then that part so that part is being divided by that part like that. So this component over here, this minus that, we're dividing it by that value over here. So we close the bracket right over here again, and then we divide that numerator against face value. You can just over here, just following this formula here. So we open the brackets, face value plus present value, which is what we're seeing is the current price, plus the current price over 2. So just to confirm if everything is okay, so we talk about 06 over here. It's supposed to be 07. Yes, it's supposed to be 07. We talk about the annual coupon. See, the C represents the coupon, annual coupon. So we put 07 there. 07. That, yes. Then plus 04 minus 05. So 04 minus 05, just going by this, divided by n. So we divide by 010. 010 is this value over here. This thing is the number of years. And then we divide all of that by 04, which is in the face value, yes, plus present value over 2. So we just enter. So that's what we have as our yield to maturity. Moving on, we can then move on to part B. Calculate the bond's modified duration using Excel's duration formula, or function rather. So here, we move on to the right. Come here, B. Talking about the modified duration. So you can just talk about modified duration. Modified duration. How do we compute the modified duration using Excel? We just come right here to the formula bar right here. We click on that and we say duration. We click on duration. We just type in duration and we enter. So this is duration, and the narration of this duration is mentioned down here. Returns the annual duration of a security with a period with periodic interest payments. We do not want that. We want M duration. Returns the Macaulay modified duration for a security with an assumed par value of 100, and this is what we want, M duration. So we say okay. So the settlement represents today's date, or the current date, and we click it there. Then we click right back over here. What is the maturity? It's the maturity date right there. The coupon represents the coupon rate, not the annual coupon rate. There, click that. And then the yield. The yield is what we've computed right over here to the yield to maturity. What are we told in terms of the frequency of payment? We're told in terms of the frequency and payment is that it is semi-annual. Moving towards our life, the bond pays semi-annual interest payments. So we put over here 2, like that. If it is 1, there are 2 payments in a year. So if it is 1 payment, then we put 1 payment like that. But now in this case, which there are 2 payments in a year, we put that component here. The basis it just represents the day count basis and how you're going to compute the modified duration on daily basis and so on and so forth. So just leave it blank like that. You say okay. So this is the modified duration, and of course it is in terms of years. For a one-time parallel change in the yields will cause the duration to change by 5.08 years. That's the interpretation. We can move on to the left side here and see what we're being asked. Using Excel's data table feature, plot a graph that shows the bond price sensitivity to changes in interest rates, assuming the range of interest rate changes from -2 to 2%. So that's what we are going to do right over here. We will need then, first of all, to determine the bond price. The bond price we already given, and that's why it doesn't have a formula over here. How else do we compute the bond price? The bond price is representative based on the face value here. So we can put a formula over here and say that we can get the 950 in a different way. So we say we put plus 1000, or we put plus this value over here like that, and then we are subtracting the interest payment or the coupon payment. So we open the brackets, we take that value times coupon rate. which is annual. That, we close the brackets, and we get the 950 like that. To be able to use the Excel's data table feature, we will need to have the range of interest rates over here. Rates. And we are told from the question right here, it's from -2 all the way to +2. So we can use intervals of maybe say perhaps 0.5. So we have -2. Of course, this is in percentages, so we can just go down right like that up to any place right down there, and then we highlight and we click on this. So the interest rates will be in percentages. So we'll have -2%. Then we'll have -1.5. I'm just using 0.5 as just to indicate the a range that is maybe reasonable. Then here we have go all the way like that. So it's going to be like that. So we're saying a -1.5, so we have -1%, and then we have -0.5. It's just 0.5. Then here we have 0. Then we have 0.5, 1, 1.5, 2. That. So these are the interest rates that are changing. Center them, just like so. And we need then to see the impact on the price of the bonds. So here we will now go to the Excel's data table feature. But before we do that, we need to just link it with this bond price right over here. Why are we linking it? When we move over to data tab right here, and we can be able to now go to what if analysis, and we'll be able to see data table. There are two types of data tables. There is a one variable data table, and there are two variable data table. In this case, because we only want to see the effect of changes of interest rates on the price, we are only going to use a one variable data table. So we click on the data table feature over here, and we try and see what is increasing moving towards the right row, moving towards the right. There really is nothing that is moving towards the right. But what is increasing moving towards in a column feature over here? We are saying that we want to input this component that is right here, which you're saying is the bond price here. Let's see what is going to happen. But before we do that, I want us, we first of all highlight this. We should have first of all highlighted that. Then we come to what if analysis, data table, row input, there's nothing that's increased towards the row. Column input, we want to see the impact on the prices. So we put the price over here of 950. We say okay. So in this case, the price comes over. You need to be very careful, guys, when using the Excel feature data table. So let's undo that, and we put over here, now we delete that, we put the 950, so plus that value. I want to show you the impact of the data tables of how you're supposed to run it. So once you put the 950 there, pick the value from the information right over here, or the formula right over here, the bond price. So what we do is that for us to run this on a data table feature, we need to then come to what if analysis, data table. This is a one variable data table, meaning that we are only going to put in the column values here. Why not the row value? The row value is not increasing in any form or changing in any form, moving towards the right. It's the column. Which column is changing? Interest rates right here. So we come to column, and then we move back up right over here and go to coupon rate, that is interest rate. And then we say, okay. You see the magic that happens now? We can see the interest rates over here are increasing, and at -2%, the bond price will be 10.20. If it's -1.5, the bond price will be 10.15, and so on and so forth like that. For us to be able to prove, we can then rerun this and put over here 5%, which is the current annual coupon rate over here, 5%. So let's see what price it will give us. The price should be 9.50. At 5%, the bond price should be 9.50. So let's see. We put over here 5%, like that, and then we just do away with this. For example, come back home, format painter, come there. So if we were to run it again, we highlight there, this has to be arranged like so, where the price is slightly above the interest rate. So we highlight that part like that. We come to data, we come to what if analysis, data table. The column is the one that is changing, interest rate is what is changing here. So you're saying the interest rate is the same as the coupon rate here. So we say, okay. You can see clearly that at this point here, we have the prices, at interest rate 5%, the price of the bond is 9.50. And that is exactly what we have here. The bond price is 9.50 at coupon rate at 5%. Now we can then move on to part D. Plot a line chart that shows the bond price as a function of interest rate. The x-axis should show the range of interest rates. The y-axis should show the bond prices there. So let's plot it. So what we need to do then, ladies and gentlemen, is that we highlight this information right over here. We move on to the insert tab over here, and then we click on the scatter graph over here. So once you click on the scatter graph over here like this, this is the graph you should be able to have over here. You rename it to bond prices, like that. And indicatively, you can see that the interest rates have been indicated right over here. But you can be able to now add the chart titles. So let's include the chart titles to make it complete. Bond prices, and here we're talking about the interest rates. And there's that relationship, inverse relationship between the prices and interest rates. So we have now answered part D. Plot a line chart that shows the bond prices as a function of interest rates. The x-axis should show the range of interest rates. The y-axis should show the bond price. Save the chart on our worksheet, and you can see the interest rates, and we had been taking our data from over here up to this point. We're not interested in this 5% right over here, because we need to be consistent in our data. So the data right here begins from -2, which is over here. The bond price you can see is M120 all the way through to M2 here, where we have the bond price as 980 right there. So this brings us, ladies and gentlemen, to the end of the question 23. We hope you have enjoyed the class. Thank you and God bless you.
Hello learner, it's another session. We meet again. I want to welcome you to today's lesson, and today we'll be doing lesson 2 under that topic, just to bring you up to speed with what we are doing under this topic, we're discussing the entire process of identifying a good business opportunity. Remember, we did mention that at any given time, an entrepreneur has many ideas at their disposal, and they are the task of determining which of those ideas qualifies as the best opportunity for investment. We will have a recap of the steps involved in the process of identifying a good business opportunity. We said that process involves 3 steps. The first step being idea generation. The second step in that process being idea evaluation. And the third step being idea validation. Please note our discussion in lesson number 1 was idea generation. So our lesson number 2 is going to cover the other 2 steps in that process, which is idea evaluation and finally idea validation. We will start by looking at idea evaluation. In the first step, which was idea generation, the entrepreneur's objective was to generate as many ideas as possible so that they do not restrict themselves to implementing an idea that might not be the most optimal idea for them. So at step number 1, we ended up with like 10 ideas, for example. Now, we said it is literally impossible for the entrepreneur to implement so many ideas at the same time because of a lot of constraints that the entrepreneur faces, including resource constraints. So essentially, the entrepreneur believes that these are attractive ideas. They all qualify as potential ideas for implementation. But then again, the entrepreneur must determine out of these ideas which ones are worth considering. So the aim of step number 2 is to cull down those ideas to a smaller, manageable number. So an outcome of step number 2, we will end up with at least like 2 ideas, from which now they will eventually select the best idea. So how do we go about narrowing those 10 ideas into manageable number of ideas? We will do that through the process of idea evaluation. Please note, a good business idea, an attractive business idea is that which an entrepreneur accepts as a basis of an investment decision. So an attractive business idea is that which an entrepreneur accepts as a basis of an investment decision. You do not want to invest your money, your time and resources in an idea that is going to fail. Chances are out of these 10 ideas, not all of them the entrepreneur can implement and run successfully. Others, some of the ideas, some other people, because of some competencies they possess, they may be able to implement them. That is why we're calling them good ideas. Then The entrepreneur here is seeking those ideas which are within his or her reach and which they will implement with ease and without struggling. So what that means is that all good business ideas do not qualify or will not always qualify as good business opportunities. Please note that business idea evaluation is the process of assessing which of these attractive business ideas qualifies as a potential business opportunity. Now, for an idea to qualify as a good business opportunity, meaning for it to be a basis of an investment decision, it must meet a particular criteria, a very simple criteria, and that is the criteria of feasibility and viability. So you can note that a good business opportunity is that which meets the criteria of feasibility and viability. These two will be the basis of eliminating some of these ideas. Now, what is feasibility and what is viability? At the normal meaning of the words feasibility and viability, feasibility means practical. Practical meaning that which can be done, which can be done. Viability means ability to generate a return. Ability to generate a return. It simply means profitable. So what that means is that some of these ideas are not workable. They are not practical for the entrepreneur. And some may not generate a sufficient return to the entrepreneur's investments. Then the question we ask ourselves, what will make an idea here feasible and viable? This brings us to a very important area, characteristics of a viable business opportunity or of a good business opportunity. Please note the terms idea and opportunity. An idea is transformed into an opportunity if it is accepted for investment, if it is accepted for implementation. If it doesn't, then it remains an idea. Now, the characteristics of a good business opportunity are what makes an idea viable and feasible. So we will define the characteristics as the qualities that make an idea an idea feasible and viable. What are these qualities? We will list them down first. The first one is profitability. The second one is demand or market scope. The third one is growth and expansion. Flexibility. We also love legality, followed by availability of finance, availability of skills, skill availability, and resource availability. These are the qualities that will make a business idea to qualify as a good business opportunity. What are they about? We are saying an important criteria for a business idea to qualify as a business opportunity is viability, which we are defining as the ability to generate a good return. So one important requirement that the entrepreneur must consider, he is an entrepreneur going to get a sufficient return for their investments. Will that idea help enable them make a good profit? There is a relationship between profitability and all these other factors, or most of them for that matter. For example, demand or market scope. If you introduce a concept into the market and there is nobody who is willing and who has the purchasing power, then it means you will make a very low level of sales, which might not be sufficient to cover your costs, and therefore denying you of good profits. So for an idea to qualify as a good business opportunity, there must exist some level of demand. There must be people out there amongst the population who either need to use or to buy and use that particular concept. Growth and expansion also has an implication on profitability. You do not want to tie yourself to the kind of an idea that cannot be expanded in terms of scale. Whether it is increased productivity, whether it's in terms of available space, whether it's in terms of machinery capacity, right? Or whether in terms of product diversity. A good business opportunity is that which, with time, you can always increase its scale. The fourth requirement is flexibility. Business conditions change every other time, including customers' tastes and preferences. Today, customers have these kind of specific needs. Tomorrow, those needs will have changed so that they desire other things. A good business opportunity is that which is dynamic. It can allow you to make changes and align what you're offering with the needs of the market. So in short, this can be viewed as responsiveness to the market needs. Legality. All businesses are conducted within a legal framework, and it is important that the entrepreneur complies with the regulatory framework. It is therefore not advisable for an entrepreneur to embrace an opportunity which violates the law, or in other words, which is going to be considered illegal, because this again will give rise to compliance risks. Availability of finance. Remember I said out of these 10 ideas, they are all good ideas, but not to everyone. Some may require heavy capital investment that the entrepreneur cannot raise. Maybe such capital requirement may be raised by others. A company which has a larger capital base may be able to finance such an idea. But from where the entrepreneur stands, they are not able to raise the amount of capital requirement. So it is important that the idea that the entrepreneur picks is within reach as far as financing the idea is concerned. Skill availability again, different concepts require the input of different types of skills. Know-how. You don't want a situation where you're starting a business and you will be importing the skill you need to manage that business, because maybe you cannot find skills locally. This is going to be very costly for you, and they will reduce the amount of profit that you will expect to earn from that kind of venture. Then there is resource availability. In business, you need input resources. Most importantly, raw materials. Would rather be specific here and talk of raw materials. It is important that for the business to remain competitive, it is able to secure affordable raw materials. And those materials should be available in abundance, so that you do not run for 2 years and then the raw materials are depleted, so that you cannot continue with operations. So these factors here, or qualities, will be what the entrepreneur will consider in eliminating some of these ideas, so that they end up with 2 ideas. Effectively, after this assessment, the entrepreneur will find out that only 2 of the 10 ideas that they had generated will fit or will have these qualities present. And effectively, the entrepreneur can now proceed to the last step in that process, which is idea validation. And that now brings our discussion to the last step in that process, which is idea validation. Now, what is idea validation? You have now 2 ideas with you. You want to pick one. Which is now what you will venture or implement. You do not want to base your decision on guesswork. you want the decision to be an informed decision. So now you are taking your assessment of the remaining two ideas further. From just saying that an idea seems to be profitable, that an idea seems to have a good market scope, that an idea the amount of capital requirement is within my reach. I can raise that amount of profit. So that here you are quantifying those characteristics. In absolute terms, you are now going ahead to determine, to compute the amount of profit you expect to earn from each of these ideas. You want to quantify the level of demand. You tell us, in a month, I expect to have a turnover of this much. In a year, I expect to make this level of sales. You're telling us this kind of an idea requires this amount of capital investment. You're quantifying it in monetary terms or monetary value. So idea validation is a thorough screening of those ideas that meet the criteria of a good business opportunity. And the reason for this is you want to be very sure that you're basing your decision on objective information. So we are defining idea generation as a thorough screening of those ideas that possess the qualities of a good business opportunities, of a good business opportunity. Now, this process requires you to go out of the office, to leave your desk, and go and find out reality on the ground. Go out to the market, determine the customer's preferences, determine the customer's purchasing power, determine the target population in terms of its size, in terms of population growth, in terms of its composition, gender, men versus female, adults versus children, because these variables are important when it comes to demand for the product. You're going out there to determine what is the cost of the raw materials that you'll be using. And in terms of quantity, are they sustainable? Can you use them for a considerable period of time without shortages or experiencing shortages for that matter? Now, the most common method used by startup entrepreneurs to validate business ideas is market research. So, the main method used in validating business ideas is market research. And this brings us to the item market research. What is market research? Market research is going to be defined as a systematic process of gathering, organizing, and analyzing market information or important market information that will enable an entrepreneur remove the guesswork from those ideas. So, a systematic process of collecting, organizing, and analyzing important market information What is the aim of market research? You're conducting market research so as to remove the guesswork associated with a new idea or a potential business idea. And it is therefore the most sure way of telling that a business idea qualifies as a good business opportunity. All serious entrepreneurs will not introduce any new product in the market without having commissioned a thorough market research. What is the kind of market information or variables does market research seek to understand? The important information that the entrepreneur is looking for are important information. The entrepreneur wants to understand about the market. And which will inform whether to proceed with the ideas or not. Will include, among others, that is customers' purchasing power. Customers' purchasing power. The entrepreneur will also want to understand customers' taste and preferences, which determine demand for the product. The entrepreneur is also interested in determining competition levels. They're also interested in understanding the cost of inputs. They are interested in understanding government regulations to determine whether the idea is legal or not. Government regulations. The entrepreneur also wants to understand skill availability. You're also interested in understanding customers' location. Again, customers' location is important in the choice of where to locate your business. It's also important in determining how easy is it for those customers to access your products. It has an implication on how you intend to distribute your product. Because the more effective your distribution approach is, the more you're likely going to make increased sales. So essentially, when you look at these things that market research is trying to investigate, are what constitutes the qualities of a good business opportunity. Now, we will now look at the market research process. This process involves a certain set of steps. So, market research process. Or you can call it market research steps. This is a systematic process that follows systematic set of steps. The first step in the market research process is problem identification. That step is followed by research design, formulation. Once a research design has been formulated, you go to the field to collect the raw data collection. The data needs to be processed through the data analysis step. And finally, from the analysis, you'll be able to draw important conclusions. So, research reports. Now, the reason you want to carry out a market research is because there are things you do not know as of now. To you as an entrepreneur, that represents a problem, represents a situation that requires answers. This is a very important step in the market research process because this process is costly. It involves resources. Most times the entrepreneur does not have the capacity to conduct the market research, so that they will engage the services of market research firms, which will be at a fee. It will be very unfair for an entrepreneur to commission a research based on a wrong problem, because the entire process will be an exercise in futility. You will end up getting information, but information on the wrong subject. So the entrepreneur must take time to clearly understand what exactly do they want to know about the market. What is the question that needs to be answered must be clearly defined. Once the problem is now very clear, the entrepreneur formulates a research design. And what is a research design? A research design is the framework that the entrepreneur will use in conducting the entire market research. It is in the form of a blueprint, capturing each and every aspect of the market research process. Within this blueprint, the entrepreneur will have the timelines. You know, you cannot conduct market research for eternity. If you do that, then when will you ever implement the idea? Time is always a scarce resource, just like any other resource in business. So you must specify the time within which the exercise will be undertaken. You will, again, within the blueprints, identify the resources that will be needed in terms of people, You need people to go out there to collect data in the field. In terms of facilities, you may need space in the business premises. You may need facilities like computers, which you will be using to feed in the data and process it. Within the blueprint, you will identify the methods you will use to collect data and the market research tools. If it is questionnaires, if it will be interviewing, you will provide for them. And every other thing that will be involved. So this is a document, a blueprint. Once it is complete, moving forward, it will act as the guideline. You will only be referring to what you have provided for in the research design. Once a research design is complete, now the researcher is ready to go out to the field and collect the raw data, the first-hand data that they need. And once enough data has been gathered, obviously it will depend on the time allocated in the research design for collection of data. It might be 2 weeks, it might be a month. Then that data is meaningless because it is very raw in nature. There is nothing much the entrepreneur can tell from all these large amounts of information that they have collected in the fields. So they will come back to the office and start organizing that information in a manner that makes sense. Break it down and using both qualitative and quantitative techniques, analyze it. The outcome of the analysis is inferences. The entrepreneur will be able to draw inferences. There will be findings from that information. Now, the information will make sense to the entrepreneur. It will have meaning. They will know what it represents. And finally, those findings and the entrepreneur's conclusions will now be compiled into a market research report. And on the basis of that report, the entrepreneur will be in a position to determine of the two ideas which is the best for implementation. And the entrepreneur will have an idea to proceed and implement. This brings us to the end of the topic, entrepreneurial opportunity development. Having successfully been able to identify one business idea for implementation from the very many ideas that the entrepreneur had generated. Thank you, and see you in our next lesson.
Welcome learners to today's session where we're going to look at the pricing and valuation of options using the Black-Scholes-Merton model. In this class, it's after having learned and appreciated the various factors that affect the value of an option, and having after appreciated how we value an option using the binomial tree or the binomial model, one period binomial model. In our today's class, we are going to concern ourselves with pricing and valuation of options in the continuous time that dividends or the returns on a security, the underlying security like dividends from a share, are paid in a continuous manner. The risk-free rate occurs in a continuous manner. So, welcome. So today we are going to look at the Blaskos-Merton model. Commonly abbreviated as the BSM, BSM option valuation. Like we have said in our introduction, it evaluates options in a continuous manner. And when I mean continuous, time changes. And how does time change? It can change in one way. One, through discrete means, 1 day, 1 week, 1 month, and such other time graphs. Continuous meaning it changes in the tiniest of the form. We are trying to incorporate these small or instantaneous changes. So remember, we have been using the discrete values before. Now we will be using what? The continuous time. Now, after that, we will need also to understand in the BSM model, what are the assumptions? What are the assumptions? The first assumption we need to use in the BSM model is that returns on the underlying asset, like the dividends, follow a log-normal distribution. Yeah, returns follow a log-normal distribution. What do you mean by log normal? By log normal, we mean that logarithmic continuously compounded return is normally distributed. And I know from your quantitative analysis in your prior section, you understood the bell-shaped curve that represented the normal distribution. The second assumption concerns itself about the continuously compounded risk-free rate is continuously compounded risk-free rate is constant and known. Is constant and known. Yeah, so it does not vary. We know it prior with a lot of certainty. Yeah, borrowing and lending occurs at what? The risk-free rate. That is where the rate used to borrow and lending. It is done at the risk-free rate. Volatility of returns of the underlying asset is constant and known. So we say volatility is constant and known. Yeah. The next is that the markets are frictionless. Markets are frictionless. What do I mean that markets are frictionless? I mean that these markets, do not have undue government intervention. In that, for example, there are no taxes. Yeah. Having said that there are no taxes, we also assume that continuous trading is possible. So continuous trading is possible. Yeah. And then we're also saying that there are no arbitrage opportunities. No arbitrage opportunities. Yeah, and many other characteristics of what? A perfect market of a perfect market. Those can be they can be the reason why we are saying markets are frictionless. We also have that the continuously compounded yield on the underlying asset is constant. Continuously compounded yield on underlying asset is constant. Yeah, meaning that the dividends that are paid by the share, for example, the bond pays what? Coupons. That coupons are paid what? In a continuous manner, and they are known and constant. The last but not the least is that options that are valued using the Black-Scholes method model are what? European options. So options valued herein, options valued are European options. Yeah. So what do we mean by European options? We know that there are two types of options, the American option. The American option is one that can be exercised anytime before maturity over the life of the derivative contract. An European option is one in which that exercising can only be done at expiration, at the end of the contract. So the BSA model does not value American options. What is the formula then? What is the formula for BSM? The formula for BSM is given by the following. We have one for the core, yeah. The core value, the core option value is given by SO, the price of the underlying, and D1, yeah, minus XE RFC multiplied by the time times ND2. That is the value of the call option. What is the value of the put option? The put option value is given by X, the strike price, E RFC T, N 1 minus D2 minus SO N 1 minus ND2 D1, sorry. That is the price of the put option. What is D1? D1, we know this is the value obtained from the normal distribution table. This value is obtained by ln, the natural logarithm of S over X, the price of the underlying divided by the strike price plus the risk-free rate, yeah, the risk-free rate plus 0.5 over our volatility measured through standard deviation and variance times the time over the variance and T. So what are these options there? Where we know that D2 is given by D1 minus volatility over the time, volatility multiplied by the square root of the time. where we are saying CO and PO are the prices of call and put respectively. Are prices of call and put respectively. Yeah. We are also saying T is the time to expiration. T is the time to expiration. We are also saying SO is the current price of the underlying, the current price of the underlying. Then what is sigma? This represents the annual volatility of asset return. The annual volatility of asset returns. We are also saying that RFC, this is a continuously compounded risk-free rate. The continuously compounded risk-free rate. We are also saying that N, yeah, I leave here blank because this N can mean either ND1 or ND2. This gives us the cumulative standard normal probability. Cumulative standard normal probability. Yeah, and it can be either ND1 or ND2. Example, the stock of XYZ Limited is currently trading at shillings 50. Suppose the return volatility is 25% and continuously compounded risk-free rate is 3%. Calls and puts with a strike price of shillings 45 and expiring in 6 months are trading at shillings 7 and shillings 1 respectively. Calculate the value of calls and arbitrage profits where applicable. If our ND1 is 0.779 and our ND2 is 0.7230. So in our solution, we will need first of all to define the terms. So we are required to calculate the value of the put and the call. So we are told that ND1 is given by 0.779. We are also told our ND2 is given by 0.7230. We also said that currently trading at shillings 50. So our SCO, currently trading at shillings 50, is our SO is equals to 50. Yeah, the current price of the underlying. We have also been told, suppose the return volatility is 25%. Annual volatility of the asset return. So our sigma is 25% or 0.0 to 0.25. We also been told, and continuously compounded risk-free rate is 3%. Continuously compounded risk-free rate, RFC, is equals to 3% or 0.03. We are also been told cost and put to the strike price of shillings 45. So our X, yeah, our X here now need to be what? We define our X here as the strike price. Strike price or the exercise price. Or the exercise price. Our here X, yeah, is 45. We have also been told that expiring 6 months, our T is equals to 6/12 are trading at 7 and 1 respectively. So these trading prices will form a benchmark from where we will calculate our values and compare with what is currently being observed in the market. So the value of the call option will be given by this formula. So we know our SO is 50, yeah, and we also know multiply by our ND1 is 0.779, yeah, minus, we know that our X is 45, yeah, times E negative 0.03 multiplied by 6/12 times our ND2 is 0.7230. This gives me 50 38.95 minus 32.05. 6.90. So that gives me, this gives me a theoretically computed price of shillings 6.9. And our question read, calls and puts with a strike price of 45, expiring 6 months, are trading at shillings 7.0. Therefore, we can say, because the market value of the call is shillings 7.0, the arbitrage opportunity exists. Why does it exist? When you compare shillings 7.0 minus shillings 6.90, it gives you an opportunity for shillings 0.1 per call. Per call. Now, our second requirement of the question is to get the value of the put option. For us to get the value of the put option, because we are told there is in the formula 1 minus ND2, 1 minus ND1. We therefore need to get, first of all, the 1 minus ND1 will be given by 1 minus 0.779, which will give me 0.221. 1 minus ND2 will be given by 1 minus 0.7230, which will give me 0.277. So our value for the put will be given by our x is 45. Our e remains negative 0.03 times 6/12, our time, multiplied by 0.1 minus ND2, 277, minus our SO is 50, yeah, and N minus ND1 is 0.221 is equals to this gives me 12.28 minus 11.05 to give me shillings. $1.23. Now the question tells that calls and puts with a strike price of 45 expiring 6 months are trading at 7 and shillings 1 respectively. So we see that the market is offering the put at shillings 1. Our theoretical calculation from the BSM model offers shillings 1.3. So an arbitrage opportunity exists, which is shillings 1.23 minus shillings 1.00 to give me shillings 0.23 per call. 23 per call. So we can say because the market price of the put option is shillings 1, the arbitrage profit can be earned by selling the theoretical put, that is going long the board position and short position the shares. Yeah, going long the board position and short the position the shares, and therefore you make an arbitrage gain of shillings 0.23 per call. Having appreciated that, having also looked at the assumptions of the model, we can look on two distinct things that concern themselves with Black-Scholes-Merton model. What is remaining now is for us to look at the option Greeks, and we also look at the shortcomings of what? The Black-Scholes model, the shortcomings of the Black-Scholes model. So, what are option Greeks? Yeah, option Greeks is something simple for us to comprehend. There are 5 inputs to the BSM model. These 5 inputs concern themselves with the asset price. Yeah, from the asset price, we have the exercise price and the asset volatility. We have the exercise, and then we have the asset return volatility. We also have the risk-free rate and the time to expiration. The risk-free rate and time to expiration. So option Greeks emanate from the 5 inputs, of BSM model. Yeah. So for us to understand option Greeks, we must understand the Blaskos-Merton model and understand what? The inputs. And these are the inputs. So the relationship between each input except the exercise price, excluding this price. These other 4, they give us what we call the relationship with what? With the option price. The relationship, I repeat myself, the relationship between each of these inputs of the BSM model, except the exercise price, with the option price, either the put and the call, they give us what we call option Greeks. That relationship is captured in the option Greeks. And then what are these option Greeks? To understand the option Greeks, the first is called the delta. Yeah. So we have the option Greeks here. One of the option Greeks is called the delta. What is delta? Yeah. In delta, we say this describes the relationship between the changes in the asset prices and changes in the option prices. Core options are that the underlying asset price increases, the option value increases. So it is positive. So delta basically measures the change in the asset price, changes in asset price, and how it impacts the option price. Remember, when we are looking at the factors that affect what? The factors that affect the option price, we saw that the increase in the underlying for the core. Remember that for the core, we said the value in the money is given by the maximum of 0 st minus x. So the increases in the underlying asset price increases the value of the core. For the put, we saw that is the maximum of 0 x minus st. Yeah. So vice versa holds that the increases in the asset price decreases the value of the put. So delta is positive for the core option and negative for what? For the put option. So it measures that changes. The next is the gamma. And what is gamma? Gamma measures the rate of change in delta as the underlying price changes. So it captures the curvature of the option value versus the stock price relationship. So gamma, this is how well delta captures the change in asset prices, the change in asset prices for changes in option values. Yeah, that is gamma. The next option Greek we have is called the vega. In the vega, we are talking about the V, the volatility. So It measures the sensitivity of the option to changes in volatility of returns on the underlying asset. Both call and put are more valuable holding all factors equal. What we are saying, or else equal, the higher the higher the volatility, the vega is positive for both calls and puts. So the higher the volatility, it benefits the call option and benefits what? The put option. So we have said this one measures the sensitivity of the option price to changes in volatility. Sensitivity of option price to volatility. Yeah, sensitivity of the option price to volatility of the returns. So it is positive for both what? Put and call. The last one we have is theta. Yeah, we have is theta. It measures the sensitivity of the option price to the passage of time. As time passes, call option approaches maturity, its speculative value declines, or else being equal. This is called time decay. This is true for most put options holding other factors constant. As time elapses, isn't it? The speculative value decreases because there is nothing much, there is no time left for either an up or down move. Sensitivity of option price, sensitivity of option price as time passes. We have a last one which measures the sensitivity of the asset prices to the risk-free rate, is called the row. The row. This measures the sensitivity of option price to changes in interest rates. Interest rate, and specifically the risk-free rate. Yeah, that change is measured by that. What then can an individual or a consultant be asked is the weakness of the Black-Scholes model? What are the shortcomings of BSM model? The shortcomings of BSM model concern themselves with what? The assumptions. And these are the assumptions that the returns, one, follow a log-normal distribution. In the real world, yeah, not all returns follow what? Log-normal distribution. And therefore, when this assumption is what? It does not hold, then the output of the BSM model become challenging. We have also that the risk-free rate is constant and known. Risk-free rate, yeah, the rates in the market keep on changing and they cannot be known in advance. Therefore, the characteristic that we can't know the rates in advance today contributes to the weakness of the BSM model. We have also that markets are frictionless. Yeah, markets are perfect. Markets in themselves are not perfect because taxes are paid. Capital gains tax, interest, withholding taxes on interest and dividends, isn't it? Yeah, continuous trading is not possible. Around the world, different stock exchanges or securities exchange operate on different time zones. We have the day that the securities exchange open, and we have the time they close. So, and arbitrage opportunities are ever there in the market, so that the assumption the market are frictionless makes that the BSM model to have what? A weakness. We are also seeing that the continuously compounded yield on the underlying asset is constant. The yield, the dividend being paid by a share, remember, one of the functions of a financial manager, is to make a decision of dividend payout, isn't it? It's not a particular period that you are going to pay. It's not all the times that you are going to pay what? A constant dividend. Sometimes companies need to reinvest. So the assumption that the underlying asset gives a yield that is constant over different period of time does not what? Practically hold, therefore contributing to a weakness in the BSM model. We are saying also another assumption is that the model values options that are European options. In our study, we have known that there are two types of option. There is the European option and the American option. So there is a possibility that some of the options will be exercised before maturity, and therefore BSM model does not what? Value American option. So it is a weakness. Having said that, we come to the end of our study session today, whereby we have learned that option pricing using the binomial, using the BSM Black, Scholes and Merton model. We started with the assumptions. We have gone to the formula and the ingredients of the formula. We have seen how to value a call option and a put option. We have seen an example calling for us to identify the input to the BSM model and compare to what the market is giving. After our comparison, after our theoretical computation, we have found out that the market is giving a different rate or a given value. So we have said, by the fact that our valuation gives us a different value and the market with another, then an arbitrage opportunity exists. We have been able to identify that. We are also gone at length to look at option Greeks. Where do option Greeks come from? We have said, except the exercise price, and we have included the interest rate, we have delta, gamma, vega, and theta. Rho is also one of them. Also, we have noted that the assumptions of BSM model, they are the ones that contribute to the weakness, the shortcomings of the model. And therefore, we come to the end of pricing and evaluation of option. In our next study session, we will look at the various types of risk a financial manager faces. Thank you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tomboya Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learners, welcome to Manifested Publishers e-learning portal. My name is Celestine Wandabusi. I've been handling question 1, 2, 3 of May 2021 Management Accounting, and in today's session I'm introducing you to question number 4 of the same paper. My instructions are: have your calculators with you, ensure you participate so that we move together. So question number 4 comprised only part A, B, and C, but it was just about one topic, that is process costing with the opening work in progress. So let's do this question number 4. It reads, the following information is available for process 2 of Winam Fabricants Limited for the month of September 2020. Opening stock is 4,800 units valued at 165,000 shillings. The degree of completion for materials is 70% for labor, 60%, and for overhead is 60%. Additional information, note number 1, transfer from process 1 amounted to 30,600 units valued at 306,000. Note number 2, additional costs incurred in process 2 include direct materials 134,400, direct labor 394,200 shillings, and production overheads was 525,600. Note number 3, the unit scrapped amount to 2,400 units with the following degree of completion. So materials 100%, labor 40%, and overheads 40%. Note number 5, transfer to process 3 amounted to 27,600 units. Note 6, there was a normal loss of 10% of production in the process. And note number 7, the units scrapped were realized at 10 shillings per unit. Required. Part A, statement of equivalent production. So we want to begin with part A. Statement of equivalent production units. Statement of equivalent production, which is in units. Statement of equivalent production in So for us to prepare the statement of production, which is normally in units, you need to understand what an equivalent unit is. An equivalent unit is the notional complete unit in the production process. In process costing, we normally have raw materials input in the production process, and at the end of that process, we normally have output. So when the process is beginning, like from process 1, the output will comprise of completed, that is fully completed units, and work in progress, that is closing work in progress, which is later transferred to the next step or next process. So according to this question, we've been given details on process 2, meaning we had process 1. So in process 1, we had output, which was fully completed, and we had units which were yet to be completed, though they had been processed, and those are the units which we refer to closing work in progress, and it normally becomes opening work in progress in the next process. So an equivalent unit is a notional completed unit. So for us to prepare the statement of equivalent production, which is in units, we need to identify those elements from which we compute the fully completed and the semi-fully completed units. And therefore, we have main elements that we'll look at, and there we'll use this table as follows. So we'll have a space for details. Then I'm beginning with the total. We'll have to show the total units. Then we have units from the previous process, which I can refer to as input units from process 1. account. Then we have added materials. Added materials. We have labor. And we have overheads. So our table will comprise these elements. So that's our table. So we have to show the total units. We have to know the input units from process 1, added materials, labor, and overheads. So whenever we are given opening work in progress, we have two methods that we normally apply. One is first in, first out method, and the second method is weighted average. So the question required us to use first in, first out method. In first in, first out method, we are looking at what were the units that came in first. Those are the ones that need to be processed first. So whenever we have the output, we assume that the output consists or comprises of those units of the opening work in progress, and what remains will now be part of the added materials that were input in the process, in the manufacturing process in that particular period. So that is first in, first out method. And therefore, in first in, first out method, the input units from process 1 are assumed to have been transferred from the previous, and therefore we are not accounting them in this period. So the opening work in progress will not have any amount under the input units from process 1. We put a dash. We don't account for that. So we already do for added materials, for labor, and for overheads. And another thing you need to note when using first in, first out method, the complete notional units will be the remaining percentage. When you look at that question in our in our first part, we had degree of completion. So for materials, it was 70%. So to calculate the equivalent unit, we are not using 70%, but we'll use the remaining percentage from 100, which in that case is 30%. The same for labor was 60%. The remaining will be 40%. And for overheads was 60%. What we use to calculate equivalent units is the remaining, which will be 40%. So from there, we can now identify the elements that are included in the computation of equivalent units. And we are beginning with the opening work, opening work in progress. We were told that opening stock was 4,800 units. So the total is 4,800 units. And then we are not accounting that in the input units from process 1, but we were given the degree of completion for materials, that's added materials, labor, and for overheads. So for added material, we can use this space for workings. I'll use this other part, workings. Opening work in progress. For added materials, this will be the remaining percentage, which is 30%, multiplied by the total units of 4,800 this is 30% of 4,800. This will give us 1,440. So these are units. So under added materials, we'll have 1,440 units. And then we do the same for labor. This will be, the remaining percentage for labor will be 40% multiplied by 4,800. And this will give us 1,920 units. So for labor, we have 1,920 units. Remember, these are units. It is all in units. In units. It is in units. And then overheads will also be measured in terms of units. So for overheads, the percentage is 60%, and therefore the remaining percentage is 40%. So we calculate again for overheads. This is our working number 1. This will be 40% multiplied by 4,800, which will also be 1,920 units. So those are the equivalent units based on opening work in progress. And then we need to calculate the units that should have been received and completed. Received and completed. And then output to process 3. So we've not been given units that were received and completed, but we have output to process 3, which is a fully completed unit that is making up an equivalent unit. In note number 5, you are told that transfer to process 3 amounted to, the total is 2,700. 27,600, not 2,700. It's 26,007. Transfer to process 3 is 27,600. 27,600 units. So if transfer to process 3 is 27,600 units, the question is, how many units were received and completed? Remember, we have an opening work in progress of 4,800, and what was transferred to process 3 was 27,600. So we can be able to calculate the units that were received. This is our working number 2, received and completed. Received and completed units equals transfer to process 3 minus opening work in progress, which is equal to, for the total, 27,600 minus 4,800. 27,600 minus 4,800. This will give us 22,800 units. So the units that were received and completed in the process are 22,800 units. So once we have calculated the received and completed units, it means that all the elements within that process received the same amount, which is 22,800. So you simply record 100% of this on each element, 22,800 on units input, 22,800 to added materials, 22,800 to labor, and 22,800 to overhead. So it is applied at 100% of all the elements. And then we simply get the total. We show the total. We can be able to know the output from the input units. This was 22,800. Output for added materials is the total, that is 1440 plus 22,800, which will be 24,240. And then for labor is 1920 plus 22,800, which will be 24,720. And then for overheads will be 24,720. From there, we calculate the normal loss. Working 3 is normal loss. So in the question, we were told that normal loss is at 10%, not number 6. There was a normal loss of 10% of production in the process. So that means normal loss will be equal to 10% of the input materials and the materials that were input in the process. This is not number 1. Transfer from process 1 amounted to 30,600. So process loss is calculated on input materials. We get 10% of 30,600, which will be equal to, this will be equal to 3,060 units. When we are accounting for normal loss should be ignored. Normal loss should be ignored. It is only affecting the total units, but it should be ignored. So we have normal loss. So normal loss under the total, we have 3,060, but we ignore it. So you put dashes on other elements of that process. We also need to know whether there is any abnormal loss or abnormal gain, and therefore we need to do an analysis. This is not for working number 4. We have opening, work in progress, and this was equal to 4,800 units. Add output from, we add output from process 1, that is input. We add input units, that is from process 1, and these were 30,600 units. So 30,600 units. We less normal loss. We've already calculated normal loss in our working number 3, which is 3,060 units. We subtract that. We also subtract closing work in progress, which we are told in note number 4 that it was 5,400. So subtract that. We subtract this. And then this will help us to get expected output to process 3. To process 3, so we have 4,800 plus 30,600 minus 3,060 minus 5,400, which equals 26,940 units. We have the actual output, which is given according to the question in note number 5, and is 27,600 units. So this means that the actual output is more than the expected output, meaning the normal loss was less than what was expected, and therefore the difference will give us what we are referring to as abnormal gain. Abnormal gain. The difference is 660 units. So once we have known that, we bring it to our table. We have abnormal gain. Abnormal gain will affect all the elements, but it will be subtracted. So the total is 660, but we subtract it. We subtract it from each element.